Hello students, greetings of the day. Welcome to marathon session of economics or finance. So in this session or series of videos, I will be completing revision of all the chapters. Okay, all right. So let us take up the first chapter, that is national income accounting. Okay, before proceeding any further, in these marathon classes, I will be going through fast track material. When it comes to fast track material, when it comes to economics or finance, fast track material is more than sufficient to appear in examination. Okay, so if you don't have time to go through main material given by masterminds, then you prefer fast track material. Okay, let us see the first concept, national income. So what do you mean by national income? National income is defined as the net value of all economic goods and services produced within the domestic territory of a country plus NFIA. That is the definition. So net value of all economic goods and services produced within the domestic territory in an accounting year. Till this we are talking about NDP. To NDP, if you add NFIA, you will get national income. Okay, that is the meaning of that sentence. Now, United Nations has developed a system of national accounts in order to maintain equality when it comes to calculation of national income. United Nations came up with a system of national account to provide a comprehensive, conceptual and accounting framework for compiling and reporting macroeconomic statistics for analyzing and evaluating the performance of the economy. In order to analyze the performance of an economy, we need to have some information. So how to prepare that information, how to calculate it, how to present it, that is given by United Nations under system of national accounts. Okay. So measurement of national income in India is done by national accounts statistics. National income estimates done annually and quarter, just like company accounts are prepared annually as well as quarterly. In the same way, national income accounting is also prepared annually and quarterly. Now, when it comes to national account statistics in India, it is compiled by National Accounts Division of Central Statistical Office, which works under Ministry of Statistics and Program Implementation. So basically, we have Ministry of Statistics and Program Implementation. Below this, there is Central Statistics Office. Below this, under Central Statistics Office, there is National Accounts Division, which is responsible for preparation of national account statistics. Okay. So what are the amendments brought in by government recently? Ministry of Statistics and Program Implementation revised base year from 2004 to 5, from 2004-5 to 2011-12. So earlier 2004-5 was taken as base year. Now we have shifted from 4-5 to 11-12. Revision of National Account Statistics in January 2015. GVA at basic prices instead of factor cost. So earlier we used to calculate GDP at factor cost. Now government has decided from January 2015 onwards, government has decided to shift from factor price to basic prices. Okay. So what do you mean by basic prices? There's a formula given there. Market price minus tax on product plus subsidies on the product. So we know the formula for factor cost, right? So factor cost. So what do you mean by basic price? So we know the formula for factor cost, right? So how to convert factor cost into market price? Factor cost plus net indirect taxes, you will get market price. So this can be elaborated as factor cost plus indirect taxes. Net indirect taxes means it is nothing but difference between indirect tax minus subsidies. Then you will get market price. Again, in indirect taxes we have two types: indirect tax on product, okay, and indirect tax on production minus, same as for subsidies also, subsidies on product minus or plus subsidies on production. Subsidies on production, that is equal to market price. Now when it comes to basic price, what we do is that we only consider those taxes and subsidies which are on product, here product, not production. Okay, so here product. Okay, so if we add, so how we do it? So let us change it, market price. So instead of deducting the entire indirect taxes and adding entire subsidies, what we are doing is that we are only deducting indirect tax on product minus or plus subsidies on product, then you will get basic price. So earlier when it comes to factor cost, we used to take into consideration both indirect taxes on product as well as production, subsidies on products and subsidies on production. But when it comes to basic price, we are only taking into consideration taxes and subsidies which are related to product. So what do you mean by indirect taxes on product and what do you mean by indirect taxes on production? See, if taxes are based on output, it is called as indirect tax on product. If taxes are independent of output, it is called as indirect tax on production. So if taxes are imposed based on number of units produced, it is called as indirect tax on product. Indirect tax on production means here tax is independent of output. It does not matter how many units are you producing, you have to pay. Whether you are producing or not, it does not matter. You have to pay these taxes. Okay. So government has shifted from GDP, from factor cost to GDP at basic prices. So regional account, just like national accounts is prepared, just like national income is calculated at country level, in the same way income is calculated at state level, which is called as state income estimates. Okay, right. So regional accounts, it helps decision making at regional level. So just like India needs a national income to take decisions, in the same way states also submit their budget, so they also need information at state level to take appropriate decisions. All states and union territories of India compute state income estimates and district level estimates. Okay, state income or net state domestic product. How to calculate net state domestic product? Money value of all volume, money value of volume of all the goods and services produced in a state within a year accounted without duplication. So whatever the value of goods and services that is produced in the year within the state without duplication will be considered for calculating net state domestic product. Okay. So state level estimates are prepared by state directorates of economics and statistics, DES, directors of economics and statistics, right? Next, CSO, Central Statistic Office, assist state level directorates of economics and statistics in adopting concepts and methodology that is to be used. See, the CSO does not want states to use one type of method and center to be using another type of method. So in order to maintain some sort of parity between the methods and concepts adopted by both state and central level, CSO will intervene and will try to guide DES, that is Directorate of Economics and Statistics of each state, so that everyone is following same method and same concept. Okay. In the preparation of national income estimates, certain activities cut across state boundaries. See, if an activity is restricted to one particular state, whatever the income that is earned from that activity can be allocated to that particular state. But sometimes what happens is that an activity is spread across different states. For example, railway zone. A railway zone consists of 2 or 3 states. So whatever the income that is earned by that zone is earned by all the 3 states. In such a case, it becomes very difficult how much amount is to be allocated to each respective state. So in such a case, what we will do? Estimate, so such kind of activities where they are spread across different states are called as supra-regional sectors. It means the activity is not restricted to one particular state, it is spread across different sectors, that is called as supra-regional sectors. Okay. So when it comes to allocation of money, allocation of income to one particular state out of these supra-regional sectors, how it is done? Estimates of supra-regional activities are compiled for economy as a whole. So it is taken for the nation as a whole and on some reasonable basis allocated to different states. For example, when it comes to income of railway zone, how it is allocated to each state? It depends on number of passengers traveling from each state. Footfall, it is called as footfall. Footfall. Okay, there is nothing but number of passengers traveling from each state. So how to calculate per capita state income? How to calculate per capita state income? How can we calculate? Once we have calculated net state domestic product, we will divide it by mid-year projected population of the state. Net state domestic product divided by mid-year population of the state. So this is the concept regarding national income. Okay, first concept. Next, second concept, concepts of national income. While calculating national income, we use different concepts. What are those? GDP, GDP at market price, GDP at factor cost, real GDP, nominal GDP. Next, GNP. What is the difference between GDP and GNP? Next, net domestic product, net national product. So till this, it is one set, one particular set. And from there on, personal income, disposable personal income. net national disposable income, gross national disposable income, private income, per capita income. It's a different set. Okay, let us understand some basic concept, then you can easily basic terms, then you can easily understand these concepts. Okay, right. First one, gross means what? Gross means includes depreciation. Net means excludes depreciation. That means depreciation is not considered. Okay. So how to write the formula? If gross is given, how to convert it to net? I want a net and gross is already there. So gross means depreciation already there, right? So you subtract depreciation. So gross minus depreciation is equal to net, or net plus depreciation equal to gross. So this is one set of concept that we need to remember. If we have this clarity, we can easily convert from gross to net and net to gross. Okay. Next, second one, domestic. Domestic means what? Goods and services produced in the country or in the domestic territory. In the domestic territory of the country. Whatever the goods that are produced within the domestic territory of a country are considered while calculating domestic. It does not matter whether these goods are produced by Indian companies or foreign companies. As long as these goods are produced within the political boundaries of India, they are considered while for calculating domestic. When it comes to national, goods and services produced, goods and services produced by Indian citizens or resident of a country, that is India. Goods produced by residents of a country or Indian citizens are considered for calculating national. See, when it comes to domestic, we give importance to territory. We give importance to territory. But when it comes to national, we give importance to Indian citizens. And when it comes to national, it does not matter whether these goods are produced within India or outside India. As long as goods are produced by Indians, whether in India or outside India, it will be considered for calculating national. As long as goods are produced by Indian citizens, whether in India or outside India, it will be considered for calculating national. But when it comes to domestic, we give importance to political boundaries. We are not at all concerned whether these goods are produced by Indian companies or foreign companies. As long as goods are produced within the country, we will take them into consideration for calculating domestic. But when it comes to national, what we do is that we only focus on goods that are produced by Indian citizens, either in India or outside India. So goods produced by Indian citizens, either in India or outside India. So only those goods will be considered, okay, for calculating national. So in simple terms, this is Indian boundary, okay, South India. So here we have Tata company somewhere here, and here we have Hyundai company. When it comes to calculation of domestic, we consider the goods manufactured by both the companies. Okay, even the Indian company, Tata is an Indian company and Hyundai is a foreign company. When it comes to calculation of domestic, we take into consideration the production of both the companies. But when it comes to national, this is India, Tata is somewhere here, Hyundai is here, and this is Australia. In Australia also there is a company called Tata company. Okay, it has an office there. When it comes to national, we only consider the goods manufactured by Tata company in India and Tata company outside India. Tata company in India and Tata company outside India. We do not take into consideration the goods manufactured by Hyundai company in India. because even though it is manufactured in India, it is not an Indian company, it's a foreign company. That is the difference between domestic and national. So what is the relationship between these two? How to form an equation? Okay, right, let us see. So when it comes to domestic and national, how to convert domestic from national, national from domestic? The equation is a domestic plus NFIA equal to national. Domestic plus NFIA equal to national. So what do you mean by NFIA? It means net factor income from abroad. Sir, how to calculate net factor income from abroad? It is nothing but difference between Indian companies producing outside India minus foreign companies producing goods in India. That is difference between these two is nothing but net factor income from abroad. So domestic plus NFIA equal to national. And we have already seen how to convert from market price to factor cost. So these are the terms we need to remember. Then only we can easily understand how to convert from GDP to GDP market price to GDP at factor cost. How to convert GDP market price to NDP factor cost. Okay. So these are the terms that we need to remember. Let us see the question. So the first one that we will discuss is gross domestic product. So gross domestic product can also be called as gross value added or gross value added market price. See, GDP or GDP at market price or GVA mean the same. Means the same. Okay, that means in an examination there is no need to mention market price specifically. If the examiner simply mentions GDP, he is talking about GDP at market price. But when it comes to factor cost, it is to be specifically mentioned. It is to be specifically mentioned. Let us see the definition of GDP or GDP at market price or GVA. Market value of all final goods and services, gross of depreciation, that means depreciation is already included, produced within the domestic territory of a country during a given time period. So GDP means market value. See, when you express the value of a good, you express it at market price. You express it at market price. If someone asks you what is the value of that car, you will say cost or price. You will always mention it price. So here also, when we are trying to calculate the value of the goods produced, we always do it at market price. So market price of all at final economic goods and services, gross of depreciation already included, produced within the domestic territory. Since we are talking about GDP, we are only concerned about goods produced within the domestic territory of a country during a given time period. So formula, GDP at market price equal to value of output minus value of intermediate consumption. Generally, this formula is under product method. So value of output minus value of intermediate consumption equal to summation of value added. So if you take into consideration the value added of all the producing units in the country, you will get GDP or value added under product method. With that, you can calculate net national product at factor cost. Okay. So GDP, what does GDP include? Only final goods and services produced in the current period. Value added by production process, only goods that are produced in the current period are considered. Goods which are produced in previous year are not considered because they are only considered in the previous year. So if we start considering goods produced in previous year, it will lead to double counting. So in order to avoid that, we will ignore whatever the goods that are produced in previous year. Value added by production process, we know what is meant by value added, value of output minus value of inputs or value of intermediate consumption. Gross investment is considered, fixed investment plus inventory investment. What do you mean by fixed investment? Investment includes capital goods. Inventory investment is investment in inventory, nothing but net changes in inventories of final goods awaiting sale or of material used in the production. Note, inventories are treated as capital as addition to inventory stock of final goods and material belong to GDP and currently produced output. Just like capital goods, inventories are also treated as capital. Just like capital goods, inventories are also treated the same. So if there is any change in inventory level, it means it means there is investment in inventory. Okay, so whatever the investment that you have made in inventory, it will be considered while calculating GDP under expenditure method. Okay, production boundaries of GDP, discounting of capital consumption or depreciation is considered. Okay, so these are to be things that are to be included. Okay, next, GDP excludes. So while calculating GDP, what shall we exclude? Intermediate goods, nothing but input goods. Non-economic activities are ignored. Market transactions of second-hand goods. Why we not consider second-hand goods? Because these goods will be considered, these goods were already considered in the year of production. For example, car produced in 2020 is again sold in 2022. Since it is sold in 2022, it does not mean that there is expenditure on the expenditure belongs to this. The expenditure belongs to this car in the year for the year 2022. Actually, the expenditure belongs to the year 2020 itself, because car is manufactured in the year 2020. A car is manufactured in 2020. It is again sold in 2020 itself. So it already recorded in year 2020. Again, is sold in 2022 to some other person. Since the same car is sold in 2022 again, does not mean that you will add up while calculating GDP in 2022, because it is already considered for calculation of GDP in the 2020. So all second-hand goods will be ignored because all those goods are produced already in the year of production. Transfer payments, these payments shall not be considered. Why, sir? What is the reason for that? Because these transfer payments do not lead to any sort of production activity, so they will not be considered. Financial transactions and unreported output generated through illegal side. Any sort of illegal transactions will not be considered. Any sort of illegal transactions will not be considered. Okay. Next, real GDP or GDP at constant prices. Real GDP or base year GDP or GDP at constant year prices. Here, what we do is that we will take a year as base year and current year production will be multiplied with base year prices. For example, we have taken the base year as 2011-12. So whatever the goods that are produced in year 2022 will be multiplied with the prices in the year 2011 and 12. So if the current year production is multiplied with base year prices, it is called as real GDP or GDP at constant prices. Now, what is the advantage of it? See, when you are calculating GDP at base year prices, we can be rest assured that even though there is change in year, there will be no change in prices, because whether you are producing 2021 or 2022 or going to produce in 2023, you have to multiply the output produced in those respective years with the base year prices. That means the GDP, real GDP will not change because of change in prices. It will only change when there is change in quantity or production. So if someone wants to know whether there is change in GDP or not, it is very easy or advisable to use real GDP, because real GDP only changes when there is change in output. Okay. So the value of goods and services produced in a particular year will be multiplied with base year prices. It changes only when the quantity of output changes, because there is no scope for price to change, because no matter in which year you are producing, the goods will be multiplied with base year prices. Okay. So that is about real GDP. Next, nominal GDP or GDP at current year prices. Here, nominal GDP or GDP at current year prices means the current year production will be multiplied with current year prices. Now, there is a problem in this regard. When it comes to nominal GDP, it may change. When it comes to nominal GDP, it may change because of change in prices or because of change in quantity. So we can't be sure why nominal GDP is changing. It may be because of change in prices or change in quantity. So in order to overcome this sort of headache, what we are doing is that instead of doing nominal GDP, we are using real GDP. Okay. Now, gross domestic product at factor cost. What do you mean by GDP at factor cost? Now, we know GDP at market price. How to calculate GDP at factor cost? That means we have to simply convert from market price to factor cost. Now, how to do it? From market price, we need to subtract net indirect taxes. That is nothing but we need to subtract indirect taxes and add subsidies. Then you will get GDP at factor cost. Okay. Let us see the definition. The production and income approach measures to domestic product as cost paid to factors of production. So under income method, whatever the cost, it is paid to factors of production. If we sum all those things, it will be nothing but GDP, it will be nothing but national income under income method. Okay. So domestic product factor cost. So how to calculate domestic product factor cost? Whatever the income that is earned by domestic factors of production, if you sum it up, you will get a domestic product factor cost. So how to calculate? GDP at factor cost equal to compensation of employees, operating surplus, mixed income of self-employed. To that we need to add depreciation. See, gross means depreciation is already there, so it does not mean that we have to add it again. But when it comes to income method, there is an exception to this rule. Generally, gross means depreciation is already there, right? So there is no need to add depreciation again. But when it comes to income method, if someone is asking us to calculate GDP under income method, we need to add gross separately. What is the reason for that? See, here compensation of employees means we are talking about wages, right? Rent, interest, profit. Mixed income is where we are unable to differentiate what is salary income and what is profit. We will call that as mixed income of self-employed. Okay. So wages, rent, interest, profit, all these are paid after adjusting depreciation only. That means whatever the revenue the company has earned, first it will adjust depreciation. Once depreciation is adjusted, then only it will pay all these, it will incur all these expenses. So in wages, depreciation is not there. In rent, interest, profit, depreciation is also not there. So generally when it comes to income method, the formula starts from NDP at factor cost. Nothing but compensation of employees plus operating surplus plus mixed income of self-employed. In all these items, there is no depreciation because depreciation is already adjusted. That's why in income method, the base formula starts from NDP at factor cost. Why it is called factor cost? Because these are incomes to the owners of factors of production, but it is cost to the firm, right? That's why wages, rent, interest, profit, mixed income, all are called as cost. So NDP at factor cost. Now when calculating GDP at factor cost, since there is no depreciation in NDP, we haven't deducted it. See, when it comes to other methods, if you want to shift from gross to net, what we need to do? We need to subtract depreciation from gross. Then you will get net. So in income method, NDP means depreciation is not at all there. So if you want to calculate GDP, what you have to do? You have to add depreciation again. So NDP at factor cost plus depreciation. NDP at factor cost plus depreciation. So in product method or expenditure method, GDP means we will not add depreciation separately because we say that depreciation is already there in the price of the good. Okay, when you are expressing price of the good, already depreciation is added there, right? So in expenditure method and product method, when it comes to calculation of gross GDP, gross domestic product, we will not add depreciation separately. But when it comes to income method, if someone is asking us to calculate GDP at factor cost under income method, we need to add depreciation separately. Why, sir? Because when it comes to wages, rent, interest, profits, in all these items, there is no depreciation at all because depreciation is already adjusted. Once depreciation is adjusted, then only whatever the balance that is left, out of that the company will pay wages, rent, interest and profits. So wages, rent, interest, profit, in these items depreciation is not there. So if someone is asking us to prepare gross, we need to consider all these items, wages, rent, interest, profit, mixed income, and we need to add depreciation separately since depreciation is not there. Okay, the same thing is mentioned here also. Compensation of employees, operating surplus, mixed income of self-employed, as depreciation is not there in wages, rent, interest and profit, we need to add depreciation separately. This is GDP at factor cost. Next, gross national product or nothing but GNP or GNP at market price. So if you have GDP at market price, you can easily calculate GNP. How? Add NFIA to GDP. So market, let us see the definition. Market value of all final economic goods and services, gross of, that means depreciation already there, produced within the domestic territory of a country by normal residents during the accounting year. That means still here we are talking about GDP. To that GDP, if we add NFIA, we will get GNP. So GDP at market price plus NFIA equal GNP. How to calculate NFIA? Indians producing in foreign countries minus foreigners producing in India, or Indians earning in foreign countries minus foreigners earning in India. So this NFIA can be positive or negative. If NFIA is positive, then GNP will be greater than GDP. If NFIA is negative, then GDP will be greater than GNP. Okay, that is about gross national product. Next, net domestic product at market price. So how to calculate net domestic product at market price? If you have GNP at market price, if you have GDP at market price, we will simply subtract depreciation from that. You will get NDP at market price. He is asking us to prepare NDP at market price. GDP at market price is given. So what is the difference between GDP and NDP? In the first letter is the difference. So how to convert gross to net? By simply deducting depreciation from gross. So market value, let us see the definition. Market value of all final goods and services produced within the domestic territory of a country by its normal residents and non-residents during an accounting year. Till here GDP at market price, less depreciation, NDP at market price. Okay, that is the reason why I have explained those terms. Difference between gross and net, how to shift from gross to net and net to gross. Difference between domestic and national, how to shift from domestic to national and national to domestic. Next, net domestic product at factor cost. How to calculate net domestic product at factor cost? If you have GDP or if you have NDP at market price, you can easily convert to NDP at factor cost. See, When it comes to NDP at factor cost, it is nothing but summation of domestic factor income net of depreciation. So whatever the income that is earned by individuals, if you add all those things, you will get NDP at factor cost. Because it may be income for a landlord, but it is an expenditure or cost to the company, right? See, what I'm saying is that whatever the revenue the company earns, out of that revenue, first some amount is kept aside as depreciation. Whatever the balance is left, out of that balance, wages are paid, rent is paid, interest is profit is paid. That means in these wages, rent, interest and profit, there is no depreciation. Okay, so the same thing is explained here. NDP at factor cost on the income method. How to calculate it? Compensation of employees. Whatever the compensation the employees are receiving, we need to consider it. Operating surplus. How to calculate operating surplus? Rent, interest, profit. Then mixed income of self-employed. What do you mean by mixed income of self-employed? Generally, a self-employed person will not be in a position to differentiate what is his labor income and what is his capital income. For example, as a self-employed, I have invested 1 lakh. Against it, I got 1 lakh 50. I have invested 1 lakh. Against it, I got 1 lakh 50. No, that means what is the excess I got? 50,000. Out of this 50,000, what is my business profit and what is the amount of salary that I need to collect? Because I have invested 1 lakh and I am working. It is not only my business, but also I am working as a laborer in that business. So I am playing a dual role, one as a laborer and another as an investor or entrepreneur. So I have invested 1 lakh, I got 1 lakh 50. This 50,000 is profit, right? Good. But out of this 50,000, what is your labor income and what is the balance that can be called as profit? That I will not be in a position to differentiate. So all such incomes where it is difficult to differentiate, what is labor income and what is capital income, it is also be considered. That is called as mixed income of self-employed. So this formula is under income method. This formula is under income method. Okay. Next, net national product at market price. How to calculate NNP at market price? If GNP at market price is given, simply subtract depreciation, you will get NNP at market price. So let's see the formula. Market value of final economic goods and services produced by normal residents within the domestic territory of a country, including till this point it is GDP. To that, if you add NFI, you will get GNP. From GNP, if you subtract depreciation, you will get NNP. So depending on the data, we have to decide what are to be adjusted. See, in order to calculate NNP at market price, GDP at market price is given. In the problem, GDP as market price is given. So how to convert this GDP at market price to NNP at market price? Simple. The first difference is GN, right? So we have to convert from gross to net. So we subtract depreciation. Next difference is domestic and national. I have to convert domestic to national. So I will add NFIA. Then simply I will get NNP at market price. I will get NNP at market price. Okay. So the same thing is given here also. So depending on the data available, we have to choose the formula. If GNP at factor cost is given, then how to convert it into NNP at market price? Simple. First subtract depreciation. If you subtract depreciation, what will happen? You will get NNP at factor cost. Now I have to convert factor cost into market price. How to convert factor cost into market price? I will simply add net indirect taxes. So depending on the data, we have to choose the appropriate formula. The last one, net national product at factor cost or national income. How to calculate national income? See, national income or net NNP at factor cost, both are one and the same. It is nothing but the sum of domestic factor incomes and NFIA. Whatever the income that people have earned in India, to that if you add NFIA, you will get income earned by Indian citizens. Nothing but NNP at factor cost. So factor income earned in the domestic territory plus NFIA, you will get NNP at factor cost. Okay, so these are one set of concepts. Question number 2 or concept 2 is not yet completed. This is one set of concepts which will be useful for us calculating NNP at factor cost. Okay, right. So from here on, we will learn some more concepts. Okay, right. Hello students, greetings of the day. Let us continue the marathon session. Okay, so in the previous class, we have discussed till national income, that is NNP at factor cost. Let us start from personal income. Okay, let's continue from personal income. So what do you mean by personal income? The term personal means households. So whatever the income that is received by households or non-profit institutions serving households is called as personal income. See, here we focus on income that is received. That means income that is received through production process as well as in the form of transfer payments. Okay, So what is the formula for personal income? National income plus income received but not earned minus income earned but not received. My advice is, instead of remembering this formula, let us focus on another formula. Right. So when it comes to personal income, it is better to focus on this formula. So personal income means we are talking about income received by households, right? So in any kind of economy, we have three economic agents: consumers, producers, government. Consumers can also be called as households. So we are talking about only the income that is earned by households. So we are not at all worried about the income that is earned by producers, that is firms or government. Okay. So what my advice is that instead of remembering this formula, it is better to remember this one, that is national income minus items related to government are to be subtracted minus items related to firms are to be subtracted. Items related to government is to be subtracted, as well as items related to firms are to be subtracted. Nothing but income items, whatever the items that are given in particulars, or whatever the transactions that are given in particulars related to government and firms are to be subtracted. And to this add transfer payments. Then you can easily get or calculate personal income. So it is much better to use this formula. And what do you mean by national income, sir? It nothing but NNP at factor cost. NNP at factor cost. Okay. So from that we will subtract whatever the income that is earned by government and whatever the income that is earned by firms. And we will add transfer payments. Then you will get personal income. So it is better to follow this formula. Next. So already given below, what do you mean by income received but not earned? Transfer payments. It is received but not earned. So we have already added in our formula. And what do you mean by income earned but not received? Retained earnings related to firms, indirect business taxes related to firms, corporate income taxes related to firms, and contribution of employees towards social security schemes. It is yet to be earned, yet to be received. It is earned but not yet received. Okay. This is about personal income. So it is better to focus on this, then it will be very, very easy for us to calculate. Okay. And moreover, when it comes to personal income, we focus only on the income that is received. Only on the income that is received. Next, disposable personal income. What is the formula for disposable personal income? See, disposable personal income means nothing but when we subtract direct taxes or personal income taxes from personal income, we will get disposable personal income. So how to calculate disposable personal income? The formula is given. And do remember one thing, this is not the only formula for disposable personal income. In fact, when it comes to disposable personal income, the complete formula is personal income minus personal income taxes minus other compulsory payments. Other compulsory payments made to government. If this item is also given in the problem, you have to subtract that. Then whatever the income that is left, that can be used for consumption and savings. So that is about disposable personal income. Okay. Next, coming back to domestic income. What do you mean by domestic income? See, the entire economy can be divided into one, public sector, another one is private sector. Public sector means we're talking about government, right? And private sector means we're talking about consumer and producer. So once you calculated domestic income of public sector, and if you subtract it from domestic income of the entire country, you will get domestic income related to private sector. Let us see income from domestic product accruing to public sector. So how to calculate domestic product accruing to public sector? Nothing but government. The formula for that one is income from property, entrepreneurship accruing to the government, administrative departments, and savings of non-department enterprise. That means what are the sources of revenue to the government? Especially when we're talking about production activity. Okay. Production activity. See, government may act as an owner, may act as an entrepreneur, or may act as an investor. Whatever the money it is receiving in these capacities should be considered. Then it is called as income from domestic product accruing to public sector. Once you have calculated income from domestic product accruing to public sector, if you subtract that from NDP at factor cost, it's nothing but net domestic product at factor cost, you will get income from domestic product accruing to private sector. Okay, right. Next, coming back to private income. How to calculate private income? See, personal income means we are talking about income that is received by households. Private income means here that is the income that is received or earned by both households plus firms, consumer and producer. So if we sum up the income earned by both households and firms, then you will get private income. To that we will add transfer payments. The same thing is given in definition also. It is a measure of income, both factor income as well as transfer income. It is both factor income as well as transfer income. Okay, so factor income means productive income, transfer income means non-productive income. Okay, which accrues to the private sector, which is related to the private, which is earned by the private sector, which is related to the private sector. Okay, for all sources, from all sources within and outside the country. Okay, so what is the formula for that one? How to calculate private income? Private income is nothing but factor income from domestic part accruing to private sector, nothing but NDP at factor cost related to private sector. To that we need to add NFIA, and to that we need to add transfer payments. Sir, what do you mean by transfer payments here? Transfer payments means merely transferring money from one person to another person. Transferring money from one person to another person. It does not involve any sort of production activity. That's why we will not consider it while calculating national income. But while calculating personal income, private income, national gross national disposable income, net national disposable income, in all these cases we will add transfer payments also. So here also same thing. So till this point, so this is factor income from domestic part accruing to the private sector plus net factor income from abroad. Till this point it is productive income and remaining is transfer payments. Okay. There is one more formula for private income. There is nothing but national income minus private income means we are talking about income of households and firms. That means from national income, if we subtract income of government, we will and add transfer payments, we will get private income. So the same thing is done here. National income minus income from domestic part accruing to government sector. So once you have subtracted income accruing to government sector from national income, private income earned through production activity is there. To that we will add transfer payments, you will get private income, both factor as well as transfers. Okay. There is one more formula for that one. What is the formula? Private income means it's summation of income earned by both households and firms, right? So if we add corporate taxes and distributed profits to personal income, then you will get private income. These two are related to firms. These two are related to firms. That's why if you add it to the personal income, you will have the income earned by both firms as well as households. Okay. Next, per capita income. How to calculate per capita income? Generally, the formula for per capita income is national income divided by total population. But sometimes in examination, they will ask you to calculate per capita income at one particular concept. There is nothing but calculate per capita income at GDP market price. So you have to calculate, you have to use the formula GDP at market price divided by total population. If they ask you to calculate per capita income at NDP market price, you have to use the formula NDP at market price divided by total population. So these are the basic concepts that we need to remember. Okay. So once we have completed the concept, let us look at the concept called GDP deflator. What do you mean by GDP deflator? To what extent we have to reduce GDP to adjust inflation? Why we are reducing GDP? Because the increase in GDP because of inflation. That's why we need to adjust inflation. That means to that extent we need to reduce GDP. That's what is called as GDP deflator. So let us see the meaning of that. The calculation of real GDP gives an useful measure of inflation known as GDP deflator. GDP deflator is used to deflate or take out of GDP or take inflation out of GDP. That is what the purpose of GDP deflator is. In order to know the true performance of the country, okay, we need to calculate real GDP. Real GDP changes only when there is change in output. Real GDP changes only when there is change in output. So we focus on real GDP. So if you subtract inflation from nominal GDP, you will get real GDP. So subtracting inflation from nominal GDP, nothing but reducing GDP, right? That is called as GDP deflator. That is called as GDP deflator. The deflation measures the change in prices that has occurred between the base year and current year. So in the prices in base years will always be equal to 100. And the prices in current year are equal to 120. That means we need to reduce the GDP by 20. So if GDP deflator is expressed as nominal GDP to real GDP of that year, nothing but formula is nominal GDP real GDP into 100. We always say that real GDP is equal to 100. Base year prices are always equal to 100 now. So what is the index of nominal GDP? Formula is nominal GDP into 100 by real GDP. You will get GDP deflator. Okay. Next, price index used to convert nominal GDP real GDP. The formula for that one is nominal GDP equal to real GDP into price index by 100. See, above he is asking us to find out the price index for nominal GDP. Here, if price index is given, he will ask us to find out nominal GDP. The formula here is nominal GDP equal to real GDP into price index by 100. See, price index of nominal GDP is given. Real GDP price index is always equal to 100, right? So the roles will be reversed. For example, here he is asking, here we are trying to find out price index of nominal GDP, right? In the below formula, that is price index formula, what we do is that real GDP is equal to 100, and if the price index is equal to 120, what will be the nominal GDP? The formula will be 120 into real GDP by 100. We will get nominal GDP. The same thing is written here. So the formula is same, but the objectivity will differ. Okay, and to find inflation rate between 2 consecutive years, see, GDP deflator of 2 consecutive years is given, but you need to find out the inflation rate between these 2 years. Then what will be the formula? GDP deflator in year 2 minus GDP deflator in year 1 by GDP deflator in year 1 into 100. Okay, so these are the formulas that we need to remember. No need to by heart these formulas. It's very, very simple to understand and remember. Okay, next, when it comes to net indirect taxes, the formula is indirect taxes plus subsidies, right? So indirect taxes minus subsidies. So when it comes to net indirect taxes, the formula is indirect taxes and subsidies. The difference between the two is nothing but net indirect taxes. Net indirect taxes are again divided into tax on product, tax on production. Subsidies are again divided into subsidies on product, subsidies on production. Now we need to understand the difference between tax on product and tax on production, subsidies on product and subsidies on production. What is the difference between the two? So as I said earlier, tax on product means taxes which are dependent on output. In the same way, subsidies on product means subsidies which are dependent on output. That means these taxes and these subsidies are applicable based on the amount of output that we have produced. And whereas production taxes and production subsidies, they are not dependent on output. They are related to business activity. That means what? Whether you are producing goods or not, you have to pay these taxes and you will get these subsidies. Okay, so what are the examples for production taxes? Land revenue, stamps and registration fees, tax on profession, factory license fee, tax paid to local authorities, pollution tax, etc. All these taxes have nothing to do with output. That means whether you are producing or not, if you have a place of business, you have to pay these taxes. When it comes to production subsidy, what are those subsidies? Subsidies to railways, villages and small industries. See, if you are established a plant in a backward area, you will get some subsidies. You haven't started producing goods, yet you will get some subsidies. That means these subsidies have nothing to do with output. Such kind of subsidies are called as production subsidies. Now, what about production tax and production? What about product tax and product subsidies? See, product tax means these are the taxes which are dependent on output, and these are the subsidies which are dependent on output. So examples of product tax, best example GST. Okay, if GST is applicable only on goods and services produced, okay. So if there is no production of goods and services, there will be no GST applicable on such goods and services. Okay, and what are the examples of product subsidies? Subsidies on food, petroleum, fertilizer subsidies, all these are the subsidies. Okay, so there is a difference between product tax, production taxes, product subsidies, production subsidies. Okay, you people need to remember that one. Now coming back to methods that are used for calculating national income. In the previous class, we have clearly seen that basically there are 3 different methods for calculating national income: product method, income method, expenditure method. Now Product method is based on production activity. Income method is based on distribution activity. Expenditure method is based on disposition, nothing but exchange and consumption activity. So we require different sets of data to use these methods. Okay. Now most of the developed countries use income method because most of the people there file the returns. But when it comes to India, country like India, we use different methods in different sectors. Okay. Let us see one by one. Let us see one by one. What are those? So first method is value added method or net output method or product method or industrial origin method. This is based on production activity. Now what sort of data is required to calculate national income under this method? Here sum of net value added by all the producing sectors. So here we need to have net value added. Sir, what do you mean by net value added? If we have net value added of all the producing units in the country, we could easily calculate national income under this product method. Sir, what do you mean by net value added? Net value added is nothing but difference between value of output minus value of intermediate consumption. Sir, what do you mean by intermediate consumption? Nothing but value of inputs. Output minus input is nothing but value added. Output minus input is nothing but value added. Okay. So this is the formula. If value of output is not given, we can use one more formula, that is sales plus change in stock. Change in stock means closing stock minus opening stock minus intermediate consumption. So if you add up the value added, if you add up the GVA or GDP, see GVA or GVA at market price or GDP means the same. It means when it comes to market price, there is no need to mention it specifically, but when it comes to factor cost, you have to mention it specifically. So once we have calculated value added company, if we sum up the value added of all the companies, we will get this one. Now how to calculate NNP at factor cost? Once you have calculated GDP at market price or GVA at market price, first we will subtract depreciation, then we will add NFIA, then I will subtract net indirect taxes, then I will get NNP at factor cost. So while calculating national income under this method, what are to be included, what are to be excluded? Okay, inclusions: own account production of fixed assets, production for self-consumption, imputed rent of self-occupied implicit cost or imputed rent of self-occupied houses, production boundary, all these are included. This method is specifically used in India or applicable in India to agriculture sector. Okay, next, the second method is income method or factor income method or factor payment method or distributed share method. This is based on distribution activity. What do you mean by distribution activity? Payment of rewards to owners of factors of production is called as a distribution method. This is called a distribution. Payment of rewards to owners of factors of production. Sir, who are owners of factors of production? Landlord is owner of land, laborer is owner of labor, investor is owner of capital, entrepreneur is owner of organization. So landlord would like to receive rent against land that he has provided for production activity. Okay, laborer is not providing services for free, so he wants wages. Investor has not invested money in the organization for free, so he wants interest. Okay, and coming back to entrepreneur is not providing his services for free. So what he's doing? He is providing all those services, he's taking all those risks to earn profits. So whatever the money that is paid to the landlord in the form of rent, labor in the form of wages, investor in the form of interest, and entrepreneur in the form of profit is called as factor payment. Nothing but distribution of money. So here distribution means payment of rewards to factors of production, payments of rewards to owners of factors of production. So in order to calculate national income under this method, what data is required or what kind of data is required? Total factor income generated in the production of goods and services. Total factor income. So whatever the factor income earned by individuals in the country, we will add all those things. Okay. So what is the formula for that one? See, when it comes to income method, generally the formula starts with NDP at factor cost. What is the formula for that one? Compensation of employees plus operating surplus plus mixed income of self-employed. So this is the base formula in income method. Basing on this, you can calculate GDP at market price or GDP at factor cost. If you add depreciation to that, you will get GDP at factor cost. See, you have to remember one thing. Here, compensation of employee means basically we're talking about wages, right? Operating surplus means rent plus interest plus profits. Now, what do you mean by mixed income of self-employed? See, in certain cases, the person will not be able to differentiate what is his labor income and what is his capital income. For example, I am running my own business. In that business, I am working in two capacities. One as an entrepreneur, one as an investor, and then as a laborer. Because I am called as self-employed, right? So I am working in my own business. So I am a self-employed person. So I have invested 1 lakh in the business. I got 1,50,000. That means 50,000 is my surplus, right? So out of this 50,000, what is the profit and what is the share of profit and what is the percentage of wages? I can't differentiate it. Okay. So since you are unable to differentiate it, it does not mean that you can ignore it. Even such kind of incomes are to be considered because the percentage of this mixed income of self-employed is more in India. Okay, because most of the people are self-employed. So they are only concerned about how much amount of money I have invested and in return how much I am getting. Okay, so if I invested 1 lakh, I am getting 1,50,000. 50,000 is my surplus, right? So he is happy with that. But he will not be in a position to differentiate out of this 50,000 what is my labor income and what is my capital income. So generally the formula starts with NDP. That's why we will consider this one also. Mixed income of self-employed. Okay. To that, if we add depreciation, then you will get GDP at factor cost. Once you have calculated GDP at factor cost, it becomes very easy to calculate NNP at factor cost. Okay. So while calculating income method, what are to be included and what are to be excluded? It is clearly given here. Incomes from primary factors of productions are to be included. Labor, capital, mixed income of self-employed is to be included. Commission, brokerage of sale of second hand. See, we do not consider the sale value of second-hand goods, but we need to consider commission and brokerage of sale of second-hand goods. And imputed services of factors. That means if I am providing my services, if a director is working, if a person is working as a director in his own organization, it does not mean that he is working for free. We should pay him wages on some reasonable basis. Then only we will get to know the true profits of the company. Okay. So these are to be included. And when it comes to exclusion, what we need to exclude? Transfer incomes are to be excluded. Income from sale of second-hand goods are to be excluded. Illegal incomes are to be excluded. Interest paid by government on public debt by one firm to another and consumption loans. All these are to be excluded because this does not lead to any sort of production activity. That's why we are ignoring it. And when it comes to India, where this method is used in small scale sector, nothing but industrial sector. Okay, that is about distribution method. Now coming back to disposition. What do you mean by disposition, sir? See, expenditure. The third method is expenditure method, which can also be called as income disposal method or outlay method. And this is based on disposition. Disposition means we are talking about exchange plus consumption. Together is called as disposition. So in order to calculate national income under this method, what kind of data or what type of data is required, Nana? Here under this method, we will calculate national income by summing the expenditure incurred by all the three economic agents. So sum of expenditures of three spending units, who are those? They are nothing but households, firms and government. So what is the formula here? Generally, when it comes to expenditure method, the formula will be GDP at market price. See, expenditure means price into quantity, right? So here we take into consideration market price. If someone asks us what is the expenditure incurred on that good, I need to express it at market price because I will be purchasing that good at market price, right? So the expenditures will be mentioned at market price. That's why we consider GDP at market price. So it includes the expenditure incurred by consumer, nothing but consumption expenditure. It includes the expenditure incurred by firms, nothing but investment expenditure. It includes the expenditure incurred by government, nothing but government expenditure. And moreover, we are living in a globalized economy. That means Indians may be demanding foreign made goods and foreigners may be demanding Indian made goods. So out of this total consumption expenditure, there may be certain goods which are imported goods. So as we are talking about calculation of national income of India, whatever the amount of money that is spent on foreign made goods should not be considered or should be deducted. So in this consumption expenditure, some portion will be done on, some portion of expenditure will be done on imported goods, right? So we have to subtract it. And when foreigners are buying our goods, obviously the production in our country increases. So demand for exported goods should be considered, should be added. So what I will do, I will add exports. I will add exports. So consumption expenditure plus investment expenditure plus government expenditure plus exports minus imports is nothing but GDP at market price. Is GDP at market price. The same thing can be done in another form also. Consumption expenditure and government expenditure together can be called as final consumption expenditure. Okay, investment expenditure is nothing but gross domestic capital formation. Capital formation means you're talking about investment. And X minus M, exports minus imports, is nothing but net exports. So the same formula is given below. Final consumption expenditure, it includes the expenditure of consumer as well as government. Gross domestic capital formation is there, and net exports is also there. So NNP at factor cost equal to GDP at factor cost. So if GDP at market price is already there, how to calculate NNP at factor cost? GDP at market price minus, first we will subtract depreciation, then I will add NFIA, and then I will subtract net indirect taxes. Where this method is applicable? This method is used in construction sector. So in India, we use different methods for different sectors. Okay, right now. And the last. Sir, overview of the chapter. That means in this chapter, we will talk about usefulness and significance of national income. In the end, okay, GDP measures, ignore the following items in terms of welfare. So GDP is always focusing on quantitative aspects, but not on the qualitative aspects. Okay. Next, conceptual difficulties and challenges. Let us see one by one. Okay. So the same question is asked in examination, only write all the points. Any 6 points, depending on the weightage. If it is asked for 3 marks, any 6 points. 2 marks, 4 or 5 points. Okay. So usefulness and significance of national income history. In what way this national income accounting will be useful to us? First one, evaluate short-term performance of the company. Just like books of accounts or finance statements are used to evaluate the performance of a company. In the same way, national income accounting will help us in evaluating performance of a country for a year or for 6 months or so. Okay. It indicates the level of economic development, to what extent the country has developed. It determines the pattern of demand for goods and services. So just by understanding national income, just by going to national income, we can understand what type of goods. Basically, if the national income keeps on increasing, we can say that demand for luxuries keeps on increasing. And if the demand in the national income keeps on decreasing, we can say that demand for luxuries keeps on decreasing. Okay. So in this way, national income will help us in predicting the pattern of demand for goods and services. Enable the firm to forecast the future demand of their products. Okay, it will help us. It will help the firms to forecast what sort of demand my goods will have. Used in economic forecasting. So this can be used. This national income data can be used for future planning. So economic forecasting, future developmental trends of the economy. Government fixes various sectors. So once national income is prepared, government can come to a conclusion which sector is lagging behind and which sector is rapidly growing. So sectors which are lagging behind, keeping those sectors in mind, government may frame some specific policies for those sectors. It influences political judgment of success and economic program. National income data along with monetary data guides to make policies for growth, and so along with national income, we need to take into consideration monetary data also. With the help of these two data, government will be in a position to frame policies that help us in growth and controlling inflation. It helps us in analyzing inequalities. Okay, because when we calculate national income, we can easily understand who are earning more and who are earning less. So this kind of analysis will help us in finding out inequalities. And if there are inequalities on the higher side, then the government can take policies to reduce those inequalities. Determine share of nationals contribution to international body. So basically, every country needs to contribute to IMF and World Bank. So how much amount is to be contributed? That depends on your national income. So these are the usefulness and significance of national income. Let us see what are the points that are ignored while calculating GDP, and in what way it is a drawback of GDP. See, GDP per capita income does not take into consideration the welfare of people. It is only focusing on numbers but not on the welfare. Okay, if the GDP of a country is increasing, does not mean that income of everyone is increasing. Who knows? Only top 10% people are getting richer and remaining all are suffering maybe because of poverty. So GDP means we talk about income of a country, right? If GDP is increasing, it does not mean that everyone's income is increasing. Okay, so top 10 may be contributing more than 50% of GDP and remain 90% may be contributing only 40% of GDP. It's not a good thing for the economy. That means there are huge amount of inequalities in the economy. Quality improvement due to quality aspects or quality improvement due to technological and managerial innovations are completely ignored. Okay, that means the impact of technology on the society, on the production, that is completely ignored. Non-economic contributions to well-being. Generally, what we say is that all non-economic activities shall not be considered by calculated national income. But these non-economic activities also lead to well-being of the people, which in turn affect the production of the productivity. So, some economists argue that we shall not ignore non-economic contributors because it will affect the well-being of the people. Things contribute to economic welfare such as leisure time, fairness, gender equality, security, all these are ignored. All these play very, very important role in your productivity. If no break is given and people are asked to produce goods continuously, your efficiency may decline. But for every 4 hours, if a break is given, you can regenerate yourself and increase, and this may lead to increase in productivity. If no break is given to people and you are asked to work 8 hours continuously without any break, definitely there will fall in efficiency and fall in productivity. So leisure time is very, very important, but unfortunately effect of leisure time on the productivity, such kind of things are not considered here. Next, economic bads. There is no difference between goods which are good for the society and goods which are bad for the society. We are only concerned about whether goods are produced or not. Okay, goods are being produced, but if these goods are good for the society or not, that kind of distinction is not maintained or is not considered while calculating national income. Okay. Next, what are the conceptual difficulties when it comes to measurement of national income? Okay. So, conceptual difficulties related to measurement which are difficult to resolve. First one, lack of agreed definition of national income. There is no proper definition for national income. Some says they want to follow product method and some says they want to follow income method. Accurate distinction between final goods and intermediate goods. Basically, when people fail to maintain books of accounts properly, it becomes very difficult to define which one is a raw material, which one is input and which one is output. Issue of transfer payments. Some economists argued that transfer payments are to be considered for calculated national income because even though they do not lead to production activity directly, but they definitely affect the production activity indirectly. Services of durable goods. When it comes to valuation of services of durable goods, it becomes very, very difficult because how much is to be valued? Because service, right? So how much is to be valued? So sorry, it is very difficult to define the value for services. Difficulty of incorporating distribution of income. When books of accounts are not properly maintained, it becomes very difficult to know how much each person is earning. Valuation of new goods at constant prices. See, if the good that we are manufacturing is produced for the first time, then such kind of goods cannot be valued at some base year prices. Okay, for example, according to the Indian government, the base year is 2011-12, if I am not wrong. Whatever the good that I am manufacturing 2022 is already produced in 2011-12, then it becomes very easy to find out the real GDP for that good. But if whatever the good that I am producing is produced for the first time in human history, then it becomes very difficult to calculate the value of such good at constant prices. Now, valuation of government services, just like the valuation of services of durable goods, valuation of government services is always difficult because generally government services are undervalued most of the time. So these are the conceptual difficulties. Now, what are the challenges or problems that we face by computation of national income? Inadequacy of data, non-monetized sector, like barter system. Okay, if people start exchanging goods among themselves, then it becomes very difficult to calculate national income. Absence of recording income due to illiteracy and ignorance. Lack of proper occupational classification. Accurate estimate of depreciation. Okay, problems of double counting in national income computation. All these are the challenges. Okay. Now, what do you mean by production boundary, sir? What do you mean by production boundary? Whatever the activities that we perform on a good till it reaches consumer or customer are considered as activities under production boundary. So it covers production of all goods and services Whatever the activities that we are performing on goods and services till it reaches consumer are called as production activities, and they're covered under production boundary. So it includes what? Production of agriculture, all sorts of agriculture, forestry and fishing items or natural resources that nature provides to us will be considered under production boundary. Production of agriculture, forestry, fishing, which are used for own consumption of producers. Production of all individual or collective goods or services that are supplied or intended to supply to units. So whatever the goods that I am producing, if I am thinking about supplying these goods to other manufacturers, that also comes under. That means, see, here the case is supplier. Here the case is supplier getting resources from Mother Nature. Point number B meaning is manufacturer providing goods and services to distributor, or one supplier providing his finished raw material to other manufacturer. Point number B. Point number C. Sometimes the manufacturer, instead of selling the entire output to outsiders, he will retain some amount of output with him so that he can use the same in his manufacturing process. Okay. So all these activities come under production boundary. So whatever the activities that are performed on a good or a service till it reaches the customer are called as production boundaries. So raw material, supplier collecting raw material from Mother Nature comes under production boundary. Supplier processing that raw material and supplying to manufacturer, that also comes under raw material. Manufacturer uses that raw material to produce finished goods. Okay, and his objective is to sell the same in the market. That also comes under production boundary. Sometimes what manufacturers do, instead of selling the entire output, they will retain some amount of output with them so that they can use it in their own factory as repairs and maintenance, or some for own consumption. That also comes under production boundary. So this is the meaning of production boundary. Okay, you have a list of formulas given below. So you can go through the list of formulas and easily understand all the formulas. Okay, right? So that's it. With that we have completed this chapter. Hello students, greetings of the day. So let us discuss the Keynesian theory of determination of national income. Okay, right. So what is the meaning of this chapter? Here Keynes is trying to determine equilibrium income of a country. The Keynes is trying to determine equilibrium income of a country. Okay. So Keynes took help of certain models to determine equilibrium income. So before going any further, let us understand some basics. So in any kind of economy, basically throughout the world we have the economies, the countries can be divided into three types of systems, right? Capitalist economy, socialist economy, mixed economy. So when it comes to type of economies, it will be classified into three types. Capitalist economy, socialist economy, mixed economy. When it comes to capitalist economy, how many agents are there in an economy? Economic agents. In any kind of economy, we basically have three agents, right? So just in the same way in capitalist economy also we have three agents: households, firms, government. And we all know that when it comes to capitalist economy, government plays a very nominal role. So no need to consider government, or no need to take government into consideration. The entire business activity or economic activity, the entire economic activity will be done by these two, households and firms. When it comes to socialist economy also, we have household, firms and government, but basically we ignore socialist economic countries because as of now, it is very rare to find socialist economic countries, okay? Okay, we have countries with socialistic ideology, but socialist economic countries is very, very rare. Now coming back to mixed economy, again mixed economy can be divided into two types: closed mixed economy and open mixed economy. When it comes to closed mixed economy, we have three agents: households, firms, and government. All the three play an important role. Okay, all the three will play an equally important role when it comes to this is a feature of mixed economy. When it comes to open mixed economy, we have four none. Along with these three, we have one more, that is foreign trade. Open mixed economies, we're talking about opening up the economy, we're talking about globalization. Okay, so one, households, second, firms, third, government, and fourth one, foreign trade. Fourth one is foreign trade. So household firm. So here the government will basically play a minimum role when it comes to capitalist economy. So basing on the active role played by household and firms, the Keynes came up with a model that is called as two-sector model. So basing on capitalist economy, Keynes came up with a model called as two-sector model, because in capitalist economy, almost all the economic activities are done by households and firms. Government will be there, but it will not interfere in the market. It will not interfere in the market. That's why, since only two agents are playing an active role, it is called as two-sector model. When it comes to closed mixed economy, here we have all the three playing an equally important role. So that's why it is called as three-sector model. And in open mixed economy, we have four different agents. So all will be paying an equal input. That's what is called as four-sector model. So these are the three models which Keynes used to determine equilibrium income. So in each model, Keynes is trying to find out equilibrium, national income. The income at point where aggregate demand is equal to aggregate supply. Whatever the income we have at the point aggregate demand equal to aggregate supply, that is called as equilibrium national income. So Keynes is trying to find out equilibrium national income in two sector, as well as in three sector, as well as in four sector. Okay, so now what do you mean by aggregate demand and aggregate supply? That too in two sector, three sector, and four sector. See, remember one thing. Aggregate demand means aggregate expenditure, and aggregate supply means we're talking about aggregate income. Aggregate demand means aggregate expenditure. To be more precise, it is nothing but planned expenditure. It is nothing but anticipated income. Aggregate demand means we're talking about the amount of money which the economy is planning to spend. And aggregate supply means the amount of money which the economy is anticipating to earn. Okay, so basically, Keynes is using ex ante terms. There are two kinds of terms. One is ex post and the one is ex ante. Ex post means we talk about actuals. Ex ante means we talk about anticipated. Okay, so Keynes considered ex ante terms only. So whatever the expenditure or income that we are talking about, all these are anticipated, not actuals. Expected, anticipated, not actuals. Okay. So aggregate demand means we're talking about aggregate, the amount of money which the agents are willing to spend. See, demand depends on spending, right? If the people are willing to spend means they are willing to, if the people are willing to spend means they are demanding goods. Okay. So aggregate demand means we're talking about aggregate expenditure. In the same way, aggregate supply means once goods are sold, whatever the money that the firm is expecting, it is called as aggregate income. Okay. Right. Let us see what do you mean by aggregate demand in two sector, three sector, and four sector. Okay. In the same way, aggregate supply also. So aggregate demand and aggregate supply. Aggregate demand means we're talking about aggregate expenditure. And aggregate supply means you're talking about aggregate income. Okay. So Keynes, what he's trying to prove? He's trying to prove that any kind of economic model, these two will be one and the same. Aggregate demand will be equal to aggregate supply. Let us see that. So in two sector model, when it comes to two sector model, two sector means we're talking about consumers, households means consumers, and firms means producers. Okay. So when it comes to aggregate demand, we're talking about consumption, expenditure, and when it comes to aggregate, when it comes to aggregate demand, we need to talk about the expenditure incurred by consumers and producers. So whatever the expenditure that is incurred by consumer is called as consumption expenditure, and whatever the expenditure that is incurred by producer is called as investment expenditure. And when it comes to aggregate supply, we are talking about aggregate income, nothing but Y, right? So whatever the income we earn in two sector model, it will be used for consumption and savings. Consumption and savings. So basically in two sector model, Keynes is trying to prove that aggregate demand is equal to aggregate supply, nothing but consumption plus investment is equal to consumption plus savings. And when these two variables are equal to one another, automatically consumption will be cancelled off. So what is left? Investment is equal to savings. So what Keynes is trying to say is that the point where aggregate demand is equal to aggregate supply, correspondingly investment will be equal to savings. So the point where, so in two sector model, the point where or income at which aggregate demand is equal to aggregate supply, correspondingly investment will be equal to savings. Investment will be equal to savings. That is two sector model. Now coming back to three sector model. In three sector model, we have how many agents? Consumers plus producers plus government. So all three we play an equally important role in a market. Okay, right. So when it comes to aggregate demand, we need to add up the expenditure of all the three agents. So consumer incurs consumption expenditure, producer incurs investment expenditure, and government will incur government expenditure. And whatever the money that is used, that is earned, it will be used for consumption as well as savings. And when it comes to government, the major source of revenue to the government is taxes. The major source of revenue is taxes. So whatever the income that is earned by firms or households will be used, producer and household will be used for both consumption as well as savings. When it comes to government, the major source of revenue or income to the government is taxes. So difference between two sector and three sector is government. So when it comes to aggregate demand, we add government expenditure. When it comes to aggregate supply, we add the major source of government is taxes. Now in three sector model, Keynes, what he is trying to prove? The point where aggregate demand is equal to aggregate supply, correspondingly I plus G is equal to S plus T. So the income at which aggregate demand is equal to aggregate supply, at that income correspondingly I plus G will be equal to S plus T. This is called as equilibrium income. This is called as equilibrium income. Okay, next. Coming back to four sector model. When it comes to four sector model, we have four agents: consumers, producers, government plus foreign trade. So difference between three sector and four sector is foreign trade. Okay, so when it comes to aggregate expenditure, here we use the formula that we learned in expenditure method, that is consumption expenditure plus investment expenditure plus government expenditure and net exports. Net exports means X minus M. It is aggregate demand. And aggregate supply is C plus S plus T. The same formula or equation can be written as C plus I plus G plus X equal to C plus S plus T plus M. T plus M. I plus G plus X. Now, as above, if we cancel out consumption on both the side, I plus G plus X equal to S plus T plus M. So, here also in 4-sector model, Keynes what he is trying to prove? He is trying to prove a point that the point where the income where aggregate demand is equal to aggregate supply, correspondingly I plus G plus X is equal to S plus T plus M. So, if you observe carefully, aggregate demand, aggregate supply, 2-sector, 3-sector, 4-sector, C plus I, C plus S, C plus I plus G, C plus S plus T, C plus I plus G plus X, C plus S plus T plus M. All these variables are called as injection. Injection means inflow of money into the economy, or the variables because of which production increases. It is called as injection. Injection into the economy, that means inflow of money into the economy. So, investment, that means we are investing in the economy, it's an inflow. Government expenditure, government is spending money on the economy, it is also inflow. Exports, if the demand for exports increases, automatically domestic production increases. When domestic production increases, it leads to inflow of money to the economy. Okay, so exports means we are selling goods out of the country, but we are receiving the money, right? So, we are getting money from abroad. Why? Because of sale of exports. So, whenever the inflow of money to the economy increases, or variables which lead to inflow of money to the economy is called as injection. Now, coming back to aggregate supply, savings in 2 sectors, savings plus taxes in 3 sector, and savings plus taxes plus imports in 4 sector is called as leakages. Leakages are those variables. Leakages are those variables which increase or which lead to outflow of income from the economy, or which lead to decrease in production. So, if variables lead to increase in production, increase in demand is called as injection. If variables lead to decrease in production, decrease in demand is called as leakage. It is called as leakage. So, injection, leakages. Okay, right. So, let us focus on 2 sector first. If you are able to understand 2 sector, that becomes very, very easy to understand 3 sector and 4 sector. We are able to understand 2 sector first, then we can easily understand 3 sector, and because the difference between 2 sector and 3 sector is government, the difference between 3 sector and 4 sector is foreign trade. So, just we keep on adding variables to 2 sector, 3 sector respectively. Okay, let us see one by one. So, when it comes to 2 sector, so before understanding these concepts any further, let us understand some basic terms or basic concepts. Okay, so basic terms or concepts that are very, very essential to understand the chapter further. First one is aggregate demand. We already seen aggregate demand. Aggregate demand means aggregate expenditure. That too in 2 sector. I am talking about 2 sector. So, aggregate expenditure means consumption expenditure plus investment expenditure. Now, coming back to aggregate supply. Aggregate supply is nothing but aggregate income. It is nothing but C plus S. Okay. So, whatever the income we earn, so that means this can be written as, this again can be written as Y equal to C plus S, right? That means whatever the income we earn, we will use it for consumption and saving. This we are talking about 2 sector. We are talking about 2 sector. That means as income increases, consumption increases as well as savings also increases. So, first let us discuss about consumption function. Sir, what do you mean by consumption function? It tries to explain the relationship between consumption and income. It tries to explain the relationship between consumption and income. That means what? As income increases, consumption also increases. As income increases, consumption also increases. The same thing can be written in fraction form also. That is C equal to F of Y. C equal to f of y. Now this equation was given by classical economist. This equation of function is given by classical economist. Now Keynes was not happy with that equation. What he said is that whatever the equation that is given by classical economist is correct but not complete. It is correct but not complete. What Keynes argued is that consumption will not always depend on income. That is, even when there is no income with us, we will be consuming goods. How, sir? By using our past savings. But unfortunately, classical economists did not take that kind of consumption into consideration. So what Keynes is saying is that, according to Keynes, what Keynes is saying is that total consumption, nothing but C, is equal to A plus B of Y. So C equal to A plus B of Y. Sir, what do you mean by A plus B of Y? So C is nothing but total consumption. A is nothing but autonomous consumption. Sir, what do you mean by autonomous consumption, sir? That is consumption which is not dependent on, consumption not dependent on income. Consumption which is not dependent on income is called as autonomous consumption. Okay, that means what? It is dependent on savings. It is dependent on savings. So what is the meaning of autonomous consumption? Even though there is no income, we still need to keep on consuming. Sir, when there is no income, how can you consume? By using your past savings. Okay. Now B of Y means consumption that is dependent on income. Consumption that is dependent on income. So what Keynes is saying is that whatever the total consumption you are incurring, out of that certain portion of consumption is dependent on income and certain portion is dependent on savings. So he modified the equation given by classical economists and came up with a new equation, that is C equal to A plus B of Y. C equal to A plus B of Y. That is total consumption is equal to autonomous consumption plus percentage of consumption on income. The same equation is just like Y equal to C plus Mx or Mx plus C, where you can clearly see that just like M is slope of this function, this equation, B is also slope. So therefore, M equal to B equal to slope of consumption function. Now if you draw the graph, what we do is that we will take income Y on x-axis and consumption on y-axis. Now, when it comes to equation given by Keynes, how the graph will behave? The graph will start from y-axis and will keep on rising upwards. This is called as C equal to A plus B of Y. C equal to A plus B of Y. Now, what is the meaning of that? Even when income is 0, we still be consuming some quantity. How, sir? By using our past savings. By using our past savings. And as my income increases from 0 to Y, consumption also keeps on increasing. So this can be clearly explained like this. So this is A and this is B of Y. B of Y. So consumption function given by Keynes can be expressed in this way. So B is slope, right? So M equal to B equal to slope of consumption function. So what is the formula for slope of consumption function? Delta y axis y2 minus y1 by x2 minus x1, nothing but delta y axis by delta x axis. Now on y axis we have taken what? Consumption, right? So delta C by, on x axis I have taken income, nothing but delta y. So simply stating B equal to slope of consumption function equal to delta C by delta y. Delta C by delta y. That is called as consumption function. Okay. So classical economists came up with a function, but Keynes was not happy with it. What Keynes argued is that the consumption function given by classical economist is correct but not complete. So Keynes tried to give a correct and complete function. So he elaborated the function as C equal to A plus B of y, where A is nothing but autonomous consumption, that is consumption not dependent on income, and B of y is consumption that is dependent on income. Certain percent of your income will be consumed, certain percentage of your income will be, B means here nothing but percentage, certain percentage of your income will be consumed. So how to represent the same graphically? I have clearly given it. And B means nothing but slope of consumption function. So what is the formula for slope? Y2 minus y1 by x2 minus x1, nothing but delta y axis by delta x axis. So delta C by delta y. Delta C by delta y. Okay, that is consumption function. And again, savings function. Savings function is very, very easy. It is nothing but S equal to f of y. That means as income increases, savings also increases. As income increases, savings also increases, right? That is savings function. Now, next point, marginal propensity to consume. Marginal propensity to consume. This is shorter written as MPC. Now, what do you mean by marginal propensity to consume? Percentage increase in consumption. Percentage increase in consumption due to 1% increase or change in income. 1% change in income. So percentage change in consumption or increase in consumption due to 1% change in income. So you can clearly see here is consumption is dependent variable and income is independent variable. Income is independent variable. So marginal propensity to consume means theoretically we can explain it as percentage change in consumption due to 1% increase in or change in income. So the same sentence can be mentioned in fraction form also, that is delta C by delta y. So MPC is nothing but delta C by delta y. We already seen this fraction above Nana, that is B. So MPC equal to delta C by delta y equal to B. Therefore, marginal propensity to consume is nothing but slope of consumption function B equal to nothing but delta C by delta y. That is marginal propensity to consume. Okay, next, marginal propensity to save. Marginal propensity to save. See, marginal means additional, right? So when there is 1 rupee increase in income, what will be the increase in your savings? Percentage change in savings due to 1% change in income. The same relationship can be explained in fraction form also, that is MPS equal to delta S by delta Y. And MPS can also be calculated in different way. See, we remember one thing. I think you people remember one thing. People remember. What I have said is that aggregate supply, that is Y equal to C plus S, right? That means whatever the income we earn, it will be used for consumption and savings. That means if there is increase in income by 1 rupee, there will be increase in consumption by MPC and there will be increase in savings by MPS. Generally, what I am saying is that whatever the income we earn, it will be used for consumption saving. That means if there is increase in income, there will be increase in consumption savings. If there is decrease in income, there will be decrease in consumption savings. That means if there is change in income, there will be change in consumption, there will be change in savings. So if there is 1 rupee increase in income, there will be increase in consumption which is represented by MPC, and there will be increase in savings, which will be represented as MPS. So 1 equal to MPC plus MPS, where we know that MPC is nothing but B and MPS is here. So from this we can calculate that MPS, therefore MPS equal to 1 minus B. 1 minus. So we can use the above formula or the below formula. So if MPC is already there, we can easily calculate MPS. If MPC is not given and delta S by delta Y is given, then we can use the above formula also. So marginal means additional. So when there is increase, when there is an additional increase of income by 1 rupee, what will be the additional increase in consumption? What will be the additional increase in savings? That is what we need to understand here. Okay, and two more concepts are there. Second one, average propensity to save, APS. It is nothing but calculated as total savings by total income. Total savings by total income. Okay, so average propensity to save. So what is the average amount of money you will save? So how to calculate it? What are your total savings and what is your total income? The ratio between the two. In the same way, average propensity to consume. How to calculate it? APC, nothing but total consumption by total income. So S by Y means APS, average propensity to save, and C by Y means average propensity to consume. Okay. So these are some of the concepts that we need to understand. Once we are thorough with these concepts, we can easily proceed to the 2-sector model, 3-sector model, 4-sector model, and try to understand the equilibrium income in these 3 models. Okay. So we'll continue the remaining in the next class. Thank you. So hello students. So in the previous class, I have explained briefly about the Keynesian theory of determination of national income. So let us go through our past track material. Okay. So what are the terms that we need to discuss, that we will use here? Okay. So first key terms, equilibrium. So what do you mean by equilibrium? A state of tendency. Like equilibrium. What do you mean by equilibrium? A state of no tendency to change their output, either output or income. So once we are in equilibrium, there is no need to increase the output or decrease the output, no need to increase the income or decrease the income, because we are at optimum level. Okay. So when it comes to equilibrium, how can we expect it? How can we explain it? Okay. So when it comes to equilibrium, we're trying to explain it in these ways. Okay. Aggregate supply equal to aggregate demand, or production plan of the firm equal to expenditure plan of the household. Aggregate expenditure equal to aggregate income, and expected value of the firm equal to realized value by the households. Okay. So equilibrium can be expressed in different ways. So generally we use this one now, that is aggregate supply equal to aggregate demand. Okay. Next. So in the Keynesian sector model, equilibrium is explained in 2 aspects. So here we will try to explain not only aggregate supply is equal to aggregate demand, but also try to explain leakages equal to injection. And we also need to understand what is the difference between equilibrium income and potential income. What do you mean by equilibrium income? The income which the economy tries to achieve in the short run is called as equilibrium income. And when it comes to potential income, what do you mean by it? The capability of the economy. The potential means what is the capability. Equilibrium means what we are trying to achieve. It does not mean that whatever our capability may be, we need to achieve it. Okay. So potential means we're talking about capability of the economy, and equilibrium means the income that we need to, that we try to achieve. Okay. Right. So ex post terms and ex ante terms. What is the difference between the two? Here, ex post terms means we're talking about the actual or realized economic values, and ex ante terms means we're talking about planned or anticipated. Okay. Anticipated. Okay. So Keynes used ex ante terms other than ex post terms. So ex post terms example for that one is actual GDP that we have produced. And ex ante terms means whatever the amount of output that we are planning to produce, what are the amount of consumption that we are planning to consume, and whatever the amount of investment that we are planning to invest. So ex post is actual and ex ante is anticipated. Okay. Now when it comes to determination of equilibrium income, see why Keynes need to come up with this theory. Okay. This was actually explained by classical economists, but Keynes was not happy with their explanation. What classical economists said is that at equilibrium point, full employment exists. When the economy is in equilibrium, there will be full employment. And they have assumed that wages will be flexible. Okay, Keynes was not happy with this assumption as well as the conclusion given by the classical economists that at equilibrium there will be full employment. What Keynes said is that wages are not flexible, wages will never be flexible. Okay, that means workers will not be willing to work for lower wages immediately. Okay, if a person loses a job, he will not accept a lower paying job immediately. He will wait for some time and try to find a job which pays him equally or more than that. Okay, so what Keynes said is that whatever the assumption taken by classical economists that wages are flexible, that is not entirely true. So when the assumption that is taken is not entirely true, automatically the concept given by classical economists will not be correct. So what Keynes said is that at equilibrium, even at equilibrium point, there will be unemployment. Okay, there will be unemployment. So that is what Keynes focused on. So economy could settle in equilibrium at any level of unemployment. That is what Keynes focused on. So these are some basic terms that we need to focus on. Next, let us first understand simple two-sector model without financial market. Okay, generally you will not find such kind of market in real world, but in order to help us all in understanding further models, Keynes came up with this model. So in this model, it's a two-sector model. That means we have only consumers and producers, and it does not have any financial market. When there is no financial market, automatically there will be no savings. Either on the part of consumer or on the part of producer. Okay, so these are the assumptions that we take while explaining this two-sector model without financial market. So two-sector model means we're talking about households and firms. Households will incur consumption expenditure and firms will incur investment expenditure. Households and firms do not save. No government sector, and hence no taxes, no transfer payments, and other government expenditure. In this model, the personal income of the household is equal to disposable income. That means since there are no taxes, Y is equal to YD. That means personal income is equal to disposable income. That means whatever the income the person has earned, that entire income is available for him to spend. Okay. Next, all prices, supply of capital, technology remains constant. All investment outlay is autonomous, and all investment is net. See here, what Keynes is saying is that investment is not dependent on income. Okay, since investment is according to Keynes, what he's saying is that investment is not dependent on income. That means if you want to invest, we can borrow from the market and invest it, right? So it does not depend. So it does not necessarily mean that it depends on income. So when income does not depend on income, it will be treated as autonomous and it will be treated as constant. Okay, that means even though there is change in income, there will be no change in investment. Okay, so that is what Keynes has taken here. Okay, and whereas income depends on investment. And economy is a closed economy. Okay, that means there is no foreign trade. So in such a situation, what will happen? See, first, households will supply resources to firms. Okay, so households will supply resources to firms. Okay, so dotted line from households to firms is nothing but supply of resources, wages, supply of resources, factors. Okay, and households are not supplying these factors of production for free. In return, they will be expecting some sort of reward. So what is that reward? Wages, rent, interest, and profit. Okay, so once household has supplied these factors, the firm needs to pay rewards against these factors. So wages, rent, interest, and profit. Okay, firms will use these factors to produce goods and services, and whatever the money that is earned by households in the form of wages, rents, and interest and profit will be used to purchase goods and services. So simply stating, whatever the money that is earned by households will be spent on goods and services, and whatever the money that is earned by firms by selling goods and services will be spent on producing goods and services. Okay, so simply stating, we can conclude that factor payments, that means whatever the payments made by firm is equal to household income, and whatever the income that is earned by household will be used for spending, that is equal to household expenditure, equal to total receipts of the firm, equal to value of output. So this is the equilibrium equation in two-sector model, simple two-sector model without financial markets. Okay, so this is about equilibrium. Now coming back to concept 3, Keynesian two-sector model with financial market, definition, formula of key terms. Okay, so let us see So I have already explained in the previous video. So in order to explain it in much better model, see what is the difference between concept number 2 and concept number 3. There we have considered two sector model without financial market. Here two sector model with financial market. If there are financial market, there will be savings. Okay, so you can see the columns that we have taken here: income, consumption, investment, savings. Aggregate demand is nothing but consumption plus investment. Aggregate supply is nothing but consumption plus savings. You know how to calculate APC, average propensity to consume, average propensity to save, marginal propensity to consume, and marginal propensity to save. Okay, so you can clearly see in the table that income keeps on increasing continuously, right? 0 to 100, 100 to 200, 200 to 300, income keeps on increasing continuously. And if you look at the consumption column clearly, even when income is 0, we are still consuming goods and services. We are still spending money on consumption. This consumption is called as autonomous consumption. That means even when you don't have any income, you need to consume. How you will consume? You will use your past savings to consume goods and services. Okay, so that is called as autonomous consumption. Okay, so we all know what is the relationship between income and consumption. As income increases, consumption also increases. In the same way, savings also increases. And we have assumed that investment is autonomous. That means investment does not depend on income. Even when there is no income, we can borrow money from the market and invest it in the business, right? So investment is autonomous, does not depend on income. Since it is autonomous, it is treated as constant. That means even though there is change in income, there will be no change in investment. Here we take investment as 50. Okay, and savings, we all know what is savings. Income minus consumption is savings. Okay, so when there is no income and you are consuming 50 rupees, that means this consumption depends on savings. So if there is no income and you are consuming, means to the extent of consumption, savings decreases. To the extent of consumption, saving decreases. So savings decrease by minus 50. Okay, and clearly in the next level you can see that income is 100 but consumption is 125. That means 25 is dependent on savings. That means savings will decrease by 25. And when income is equal to consumption, savings will be equal to 0. Savings will be equal to 0. Okay, so you can clearly see that as income increases, so does the consumption and so does the savings. But you have to remember one thing. Keynes, he has assumed that as income increases, consumption increases at a constant rate. Consumption increases at a constant rate. That means for every 100 rupees increase in income, consumption increases by 75. You can clearly see that. Difference between 50 and 125 is 75. 125 and 200 is 75. 200 and 275 is 75. That means for every 100 rupees increase in income, consumption increases by 75 rupees. So this is the table. And after completion, after filling the entire table, we can try to understand the relationship between different variables here. You can clearly see that the point where aggregate demand is equal to aggregate supply. The point where aggregate demand is equal to aggregate supply. Correspondingly, investment is equal to savings. Investment is equal to savings. The point where aggregate demand is equal to aggregate supply, correspondingly, investment is equal to savings. So wherever we find these two, at that level, whatever the income we have, it is called as equilibrium income. It is called as equilibrium income. Okay. So aggregate demand is equal to aggregate supply. That's nothing but investment is equal to savings. Investment will be called as injection. Savings will be called as leakages. Sir, what do you mean by injection? What do you mean by savings? Injections which lead to inflow of money to the economy. Leakages which result in outflow of money from the economy. Or simply stating, if a variable leads to increase in production, it is called as injection. If a variable leads to decrease in production, it is called as savings. Or if a variable leads to increase in demand, it is called as injection. If a variable leads to decrease in demand, it is called as leakages. So if there is investment, that means there will be increase in production, so injection. If there is savings, that means to that extent consumption decreases. If there are savings, that means to that extent consumption decreases. Because income is used for both consumption and savings, right? So if there is increase in saving, consumption decreases. So if there are savings, then to that extent consumption decreases. Consumption decreases means production also decreases. That's why savings are called as leakages. The point where aggregate demand is equal to aggregate supply, investment is equal to savings, then income is called as equilibrium income. Okay, this is about two sector. So basing on this relationship, we will draw the graph. We have already seen the consumption curve in the previous class. Okay, and these are the definitions regarding consumption function. So I have already explained you the function given by classical economists and the function given by Keynes. Okay, thereafter I have already explained average propensity to consume, marginal propensity to consume, savings function, average propensity to save, and marginal propensity to save. So basing on the above table, how to draw the graph? You can clearly see here is the relationship between consumption and income. The point where consumption is equal to income, savings is equal to 0. Savings is equal to 0. We already proved that in the above table. And the point where consumption is more than income, this is A, right? That means see, even at 0 level income, we are still consuming by A. So this consumption depends on savings. To this extent, the savings decreases. This will be minus A, nothing but. To that extent, savings decreases. Okay, right. Next, Keynesian two-sector model. So, Keynesian two-sector model. Determination of national income by using two-sector model. So, in two-sector model, we have two economic agents, consumers and producers, right? So in two-sector model, aggregate demand means we only focus on expenditure, that is that expenditure incurred by or planned expenditure of consumers as well as households. And when it comes to aggregate supply, we focus on income that is earned by consumers and households now. So when it comes to aggregate demand or aggregate expenditure, what is the equation? C plus I, okay. And what do you mean when it comes to aggregate supply? Aggregate supply means income. Whatever the income that is earned, it will be used for consumption and savings. So aggregate supply can be written as Y equal to C plus S. So aggregate demand is C plus I and aggregate supply is C plus S. Okay, right. So whatever the table that you have used earlier, okay, the same table can be used here also. Basing on the table, we can explain the equation. You can clearly see that C plus I line will be parallel to C. C plus I line will be parallel to C. Why, sir? Because investment is autonomous. So there will be a constant gap between C and C plus I. There will be a constant gap between C plus and C plus I. C and C plus I. So in panel A, in terms of aggregate demand, aggregate supply, clearly explained. You can look at the graph directly. So there are two panels. See, in panel 1, we talk about aggregate demand and aggregate supply. In panel 2, we talk about leakages and injection. There's nothing but savings and investment. Okay. So what Keynes is trying to prove, the point where aggregate demand is equal to aggregate supply, that is point number E. The point where C plus I is equal to C plus I. Correspondingly, the savings will be equal to investment. Savings will be equal to investment. Okay, so the economy will try to be at Y0 level only. So Y0 becomes equilibrium income. The economy will not like to be at Y2 level as well as Y1 level. So what will happen if the economy tries to be at Y2 level? You can clearly see at Y2 level, aggregate demand is more than aggregate supply. That means investment is more than what it should be. We have invested more than what it should be. That means it leads to wastage of resources. Okay, see at point E, aggregate demand is equal to aggregate supply. So when aggregate demand is equal to aggregate supply, if aggregate demand is equal to aggregate supply, that means resources are optimally utilized. Okay, there will be less wastage of resources. But if instead of producing at Y0 level, if you're producing at Y2 level, what is happening? Aggregate demand is more than aggregate supply. Aggregate demand is more than aggregate supply means there is overproduction. Overproduction means overinvestment. Okay, and if you're producing at Y1 level, the relationship between aggregate demand and aggregate supply is greater than aggregate demand. Aggregate supply is greater than aggregate. Concept 4 ఎక్కడి నుంచో ఉందో అదంతా కట్ చేయండి. Concept 4 ఎక్కడి నుంచో ఉందో అదంతా కట్ చేయండి. Okay, right. So next concept is concept 4, Keynesian two-sector model economy. Okay, so in this model, Keynes used two-sector. That means two-sector means there will be only consumers and producers. There will be no government as well as no foreign trade. Okay. So with the help of this model, Keynes is trying to prove equilibrium point. That is aggregate demand equal to aggregate supply. Sir, what do you mean by aggregate demand? It is nothing but ex-ante aggregate demand. It is we are talking about planned consumption expenditure and planned investment expenditure. So AD equal to C plus I. Okay. And when it comes to aggregate supply, we are talking about ex-ante aggregate supply or nothing but planned income. So whatever the income we will earn or whatever the income we will earn, we will use it for consumption and savings. So aggregate supply can be written as Y equal to C plus S when it comes to two-sector model. In two-sector model, what Keynes is trying to prove, the point where aggregate demand is equal to aggregate supply. This one. This is aggregate demand and this one aggregate supply. the point where aggregate demand is equal to aggregate supply, correspondingly, investment is equal to savings. Investment is equal to savings. And the economy will try to be at Y0 level itself. Why the economy will not be willing to produce at Y2 and Y1 level? If economy tries to produce at Y2 level, if the economy tries to produce at Y2 level, what will happen? At Y2 level, aggregate supply is more than aggregate demand. Aggregate supply is more than aggregate demand. That means there is overproduction. There is overproduction. Okay. And if the economy tries to produce at Y0, Y1 level, instead of Y0 level, it is trying to produce at Y1 level, then what will happen? Aggregate demand is greater than aggregate supply. That means there is underproduction. But at equilibrium point, aggregate demand is equal to aggregate supply. That means there is optimum production. Optimum production. So the economy will try to produce at Y0 level. And the graph you can clearly see that there is a constant gap between C plus I and C. And plane 2 also, I line is parallel to I. Investment curve is parallel, line is parallel to x-axis. The meaning of that one is investment is autonomous. That means even though there is change in income, there will be no change in investment. Okay, the same thing is explained here also. So you can clearly see. Next, Nana, deflationary gap or recessionary gap or inflationary gap. See, what do you mean by deflationary gap or recessionary gap? When we are in recession, we suffer from lack of production. That means the economy will be producing less than what it has to. This difference in production is called as recessionary gap. This difference in production is called as recessionary gap. The same thing is explained in a graphical manner. Okay. So you can clearly see C plus I. This 45-degree line is nothing but aggregate supply line. This C plus I1 is nothing but aggregate demand at full employment, when the economy is in full employment. C plus I1 is nothing but AD1. AD1 is nothing but aggregate demand at full employment. But in fact, you can clearly see that C plus I of 0, it is nothing but AD0. This is actual demand. This is actual demand. AD0 is nothing but actual demand. So you can clearly see that actual demand is less than the desired level of demand. Actual demand is less than the desired level of demand. So since the actual demand is less than desired level of demand, instead of producing Q, we will be producing M. We will be producing M. Okay. So that means the actual production, M is less than the desired level of output. That means economy producing less than what it can. So this difference is nothing but underproduction, and when it comes to demand point of view, that is called as deflationary gap. So demand should be at C plus I1, but it is at C plus I0. Since C plus I0, that is nothing but actual demand is less than demand at full employment, there will be underproduction. This fall in production or underproduction is called as deflationary gap or recessionary gap. Now the opposite will happen when it comes to inflationary gap. What do you mean by inflationary gap? Okay, you can clearly see here is C plus I1 is nothing but AD1. That is nothing but aggregate demand at full employment. That means when resources are fully employed, this will be the demand level. But as of now in the economy, the demand is at C plus I0. That is nothing but AD0, which is nothing but actual demand. You can clearly see from the graph that actual demand is more than what it should be. So actual demand is more than what it should be. That means what? See, economy can produce Q. At Q level, resources are fully utilized. Okay. So demand should be at CI1. But instead of being at CI1, demand is at CI0. Demand is at CI0. That means the demand is more than what it should be. So when demand increases, does production will increase? No, production will not increase, because we are already at Q level. We are already utilizing resources to the fuller extent. We can't use resources beyond this point. Then what is this increase, sir? This increase is nothing but nominal income. So this is real GDP and this is nominal GDP. This is real GDP and this is nominal GDP. Since nominal GDP is greater than real GDP, the difference is nothing but inflation. The difference is nothing but inflation. The same thing will be explained here. So the difference between the actual demand curve and the demand curve at full employment is called as inflationary gap. Since demand is more than what it should be, we are already producing at Q level, and this is the maximum amount of quantity that we can produce because resources are only available to that extent. So even though there is increase in demand, we can't produce any more. So what we will do, we will sell the same quantity at higher prices. There will be no increase in production, but we will be selling the same quantity at higher prices. So this selling the same quantity at higher prices is nothing but inflationary trend, right? That is what it is explained here. So this is about inflationary gap. Okay. So the same thing is mentioned clearly. At a new equilibrium, real output, real income, and employment will be same, but nominal output and income increase due to inflation. The output will be same, but since there is increase in demand, we are selling the same quantity at higher prices. At higher prices. Okay. So this is about inflationary gap and deflationary gap. So let us see some formulas now when it comes to two-sector model at equilibrium point. Aggregate supply is equal to aggregate demand. So aggregate supply is equal to aggregate demand means nothing but Y equal to C plus I. Okay, consumption equation. What is the consumption equation two-sector model? So C equal to A plus B of 1 minus B of A plus AI. So how to derive that formula? How we have derived that formula? See, in two-sector model, once we have solved equilibrium equation, we'll substitute the income in consumption equation. That is C equal to A plus B of Y. C equal to A plus B of Y. So in place of B, we'll substitute the equilibrium income equation. Okay, we'll substitute the equilibrium income equation, then you will get that equation. Okay. Next, investment multiplier. We all know what is investment multiplier. Whatever the amount of money that we have invested in the economy, it will not stay the same. It will keep on multiplying. It will keep on multiplying. That means changes in investment. 1 rupee money invested in an economy will lead to a greater change in income. Or change in income will be more than change in investment. As I said earlier, investment does not depend on income, but income depends on investment. So whenever there is change in investment, there will be change in income, and this change in income will be much higher than change in investment. This is called as investment multiplier. It is called as investment multiplier. So investment multiplier, investment multiplier K equal to delta Y by delta I. That means whenever there is change in investment, there will be change in income. Since we are talking about two-sector, in two-sector at equilibrium, in two-sector at equilibrium, I is equal to S, or I will make it much more clear to you people. Aggregate demand is equal to aggregate supply, nothing but I is equal to S. So the same formula can be written as delta Y by delta I equal to delta Y by delta S. This delta Y by delta S is nothing but 1 by MPS. Now MPS can be again elaborated as 1 by 1 minus MPC, and we all know that 1 by 1 minus MPC can be written as 1 minus B. So investment multiplier, depending on the data given, we may use different formulas. Okay, right. So we have already seen what is investment multiplier. The same thing explained graphically here. Okay, right. So let us see the graph. You can clearly see the change in investment is more than the change, the change in income. ఇక్కడ దాకా కట్ చేసేయండి, ఇవన్నీ కన్సిడర్ చేయొద్దు. ఓకే, రైట్. In the we have already seen what is investment multiplier. The same thing whatever we have learned earlier, the same thing explained graphically. Okay. So concept 5, multiplier and function of multiplier in terms of MPC and MPES. So what do you mean by investment multiplier? What we meant to say is that change in income will be greater than change in investment. See, whenever there is change in investment, it will lead to a greater change in income. This is called as investment multiplier. So we need to explain the same graphically. So it is change in investment, and this one is change in income. When there is change in investment, obviously it will lead to a greater change in income. That is called as investment multiplier. The same thing can be called as ripple effect or chain reaction or multiplier. Okay. When firms experience increased demand due to equal increase in disposable income, their output increases. The process does not stop here. It will generate a second round of increase in income. The process further continues as an autonomous rise in investment leads to an induced increase in consumer demand as income increases. Thus, process of multiplier can be compared with the ripple effect of water. See, if the government is investing in one particular sector, or if the investment increases in one particular sector, the output in that sector increases, as well as it will lead to increase in output in other sectors also. Okay, so see, I am working in a service sector. Whatever the income I earn in service sector, I will not spend only on service sector, right? I will spend goods and services produced in secondary sector. I will spend that money on agriculture sector also. Okay, so when the investment in one particular sector increases, output in that sector increases, income of the people also increases in that particular sector. Now, people who have earned, people whose income has increased in that sector, they will use that income to demand goods and services produced in different sectors. Basically, effect initiated in one particular sector spreads to other sectors also. This is called as ripple effect of water. Okay, next. So we have, with this we have completed two sector model. Let us discuss about three sector model. Okay, so what is the three sector model? So what is three sector model? What is difference between two sector and three sector? When it comes to two sector and three sector, the major difference is the government. Okay. So when it comes to two sector model, aggregate demand means C plus I, consumption expenditure plus investment expenditure. When it comes to aggregate supply, it is nothing but consumption plus savings. But when it comes to three sector model, aggregate demand means consumption expenditure, investment expenditure, and we will also include government expenditure. And when it comes to aggregate supply, we will consider consumption, savings, and major source of revenue for government is taxes. Okay. So if you look at the diagram given here, you can clearly see we have all the three sectors. That is, business is there, that is firm, government is there, and we have households also. Now, as usual, households will provide services to the businesses through factor markets. Against those services, the businesses will make payments. So this will be factor payment for the businesses, and it will become factor income for the households. It will become factor income for the households. Now, whatever the income the households have earned, they will use this income to purchase goods and services. So they will spend that money on purchase of goods and services which are available in product market. And what the firm will do, whatever the services it has received from household, it will use these services to produce goods and services. Okay. Once the income is earned by households, what they need to do? First, they need to make taxes. They need to pay taxes to the government. Sometimes they may receive transfer payments also. Deducting taxes and receiving tax payments, will call it as personal income. In the same way, when the firms sell goods and services, they will receive income, right? Whatever the income the firms have earned, they have to pay taxes from these incomes. And sometimes the government may give subsidies to the firms also. So we have to make these adjustments. Then only we will get the income of the firms. Okay, right. Sometimes government, since in three sector model, government is also there. Government will borrow from financial market when it has shortage of funds. Then it will borrow from the financial market. And sometimes government also purchase goods and services from a product market. And when government is acting as a producer, it will take factor services or factors of production from factor market. So earlier we had only two sectors, that is household sector and firm. Now we have government also. So when there is an addition of government, automatic dynamics of circular flow of income will change. Okay. So what are the assumptions that we have taken here? The first assumption is investment government expenditure is constant. Okay. So as you all know that investment is constant because investment is not dependent on income. And for the sake of convenience, Keynes has assumed that government expenditure is also constant. Even it is not true, but government expenditure is constant. That means it does not depend on national income. No foreign sector, because we're talking about three sector. That means we're talking about closed mixed economy. So there is no foreign sector. At equilibrium, in three sector model, at equilibrium, aggregate supply is equal to aggregate demand. There's nothing but Y equal to C plus I plus G. Okay. Circular flow of income is given here. Okay. So graphical representation. We all know the graph for two sector model. Here we will add one more line, that is C plus I plus G. Okay. Since just like investment expenditure, government expenditure is also constant. C plus I plus G will be parallel to C plus I. C plus I is parallel to C because investment is constant. And in three sector model, we have taken assumption of government expenditure being constant. So C plus I plus G will also be constant, parallel to C plus I, because I plus G is constant. Okay. All right. So you can clearly see in panel A, this is panel A and this is panel B. In panel A, we are trying to prove aggregate demand is equal to aggregate supply. In panel B, we are trying to prove injection is equal to leakage. So what Keynes is trying to prove? The point where aggregate demand is equal to aggregate supply, correspondingly injection is equal to leakages. Injection will be equal to leakages. Okay. If you look at the graph carefully, at point E1, aggregate demand is equal to aggregate supply. So here making a small correction, it is not C plus S, it is C plus S plus T, because we're talking about three sector, right? The C plus S plus T. So at point E1, aggregate demand, that is C plus I plus G, is equal to C plus S plus T, nothing but aggregate supply. And correspondingly, in plane B, you can clearly see that S plus T is equal to I plus G. That is nothing but injection is equal to leakage. That is what we are trying to prove. Whether it's two sector or three sector or four sector, where the aggregate demand is equal to aggregate supply, correspondingly injection will be equal to leakage. Okay, next. Since these are the formula orientations in the three sector model, at equilibrium, it is nothing but aggregate supply is equal to aggregate demand. Okay, and we have taken different conditions here. See, in a three sector model, personal income and disposable income are not one and the same, because government is there, right? So there will be taxes and transfer payments. When it comes to tax, we have two types of taxes. One is lump sum tax and the one is tax that is dependent on income. Okay. And along with these taxes, we have transfer payments also. So when we are taking a lump sum tax into consideration, what will be the equilibrium equation? Y equal to 1 by 1 minus b of a minus bt plus I plus g. How we got that? We have that clearly in our material. You can go through that material. Okay. Basically, what we are doing is that we are trying to solve equilibrium equation. Once we have solved equilibrium equation, we will get that equation, that is y equal to 1 by 1 minus b of a minus bt plus I plus g. Here in this case, consumption function is nothing but a plus b of y minus t, where capital T stands for lump sum tax. Okay, and when it comes to tax as function of income, here we're talking about c is equal to a plus b of y minus tax t of y. T of y. If we're taking lump sum tax and transfer payments into consideration, then what will happen? To that, we will make some necessary adjustments. C equal to a plus b of y minus, sorry, here it is, I forgot one more thing. We will take both tax that is dependent on income and lump sum tax. Okay, there is nothing but t. So here it will be t minus small t of y, that is tax that is dependent on income, plus transfer payments. So we have to make all these adjustments. Once we have simplified consumption function, if you substitute that consumption function into the equilibrium equation, you will get all these equations. Okay. So investment multiplier, we know the formula. Government expenditure multiplier is also same when it comes to investment multiplier. The only difference is that if you're discussing from firm's point of view, it will be investment multiplier. But if you're discussing from government point of view, it will be government expenditure multiplier. But remaining all the things will be the same. Only denotation will change. When it comes to investment multiplier, the formula is delta y by delta I. Here, when it comes to government expenditure multiplier, the formula will be delta y by delta g. Okay. Now, tax multiplier, what is the formula? 1 by 1 minus b of 1 by 1 minus b into 1 minus t. Okay. Right. Now, we have completed three sector. Now, let us discuss about four sector. What is the difference between three sector and four sector? Foreign trade. So, when there is foreign trade, all the transactions that happen in three sector will be there. Along with that, we will have exports and imports also. Exports and imports, inflow of foreign capital, outflow of foreign capital, all these things will be there. The same thing is explained in the graph also. Okay, so we have firms, we have government, we have households, and along with that we have foreign trade, the rest of the world also. So there will be exports, there will be imports, there will be movement of resources from one country to another country. So that means exports and imports not only in terms of goods and services, but also in terms of resources. Okay, so when it comes to four sector model, we need to focus on exports and imports. So what do you mean by exports? Exports are injection into the national income. Exports are demand for domestic goods by foreigners and depend on foreign income. They form a part of aggregate demand and are constant. See, exports are nothing but injections, because when there is increase in exports, automatically demand for domestic made goods increases, production also increases. If there is increase in production, it is called as injection. Okay, but the exports depend on income of foreigners, not on the income of Indians. Exports depend on income of foreigners. Since we are talking about national income of India, we are no way concerned about the income of foreigners. Okay. So that's why what we assume is that exports are autonomous, they're treated as constant. Okay. But when it comes to imports, imports are leakages, because when we import, when we demand more and more imported goods, demand for domestic made goods decreases. When demand for domestic made good decreases, production also decreases. So if the variable leads to increase in production, it is called as injection. If a variable leads to decrease in production, it is called as import. Okay. So imports are leakages from national income. Since imports are not a demand for domestic made goods, even though we are the one who are purchasing those goods, it is not the demand for domestic made goods, it is the demand for foreign made goods. And when we are trying to calculate or find the equilibrium income of a country, we should ignore all the items that are related to foreign countries. So imports means demand for foreign made goods. That means it is not at all concerned with India. That's why in our aggregate demand, since there is demand for imports also, we have to subtract it. See, if I am purchasing a good, in my total demand, there will be demand for domestic made good and there will be demand for foreign made goods, right? I need to consider demand for domestic made goods. That's why what I need to do from my total demand, I need to subtract demand on imports. That's why imports are subtracted. Okay, right. So that is the point. So we take the net difference. That is nothing but net exports. Exports minus imports. Because exports means demand for our goods and imports means demand for foreign made goods. That's why it is to be subtracted. So here the graph will be similar to that of three sector. But the only difference is that here the C plus I plus G plus X minus M line most probably lie above C plus I plus G. See, the difference between three sector and four sector when it comes to aggregate demand is net exports, right? Okay. So this net exports can be equal to, this net exports can be equal to 0 or can be greater than 0 or can be less than 1. These net exports can be equal to 0 or greater than 1 or less than 1. So what do you mean by net exports and how it will have effect on national income, equilibrium national income? Okay. See, aggregate demand in four sector is nothing but C plus I plus G plus X minus M. And aggregate demand in three sector is C plus I plus G. So the difference between aggregate demand in three sector and aggregate demand in four sector is X minus M, net exports. Now this net exports that is X minus M. It can be equal to 0, it can be greater than 1. I mean to say it means greater than 0, it can be positive. It can be greater than 0 or it can be less than 0, nothing but negative. This is positive and this is negative. Now X minus M equal to 0 means what? It means exports equal to imports. When exports are equal to import, that means there is no difference between aggregate demand in three sector and aggregate demand in four sector. So there will be no change in equilibrium national income when compared to three sector model. There will be no change in equilibrium national income between four sector and three sector. Okay. But if X minus M is positive, that means exports are greater than imports. Then definitely aggregate demand in three sector model will be less than aggregate demand in four sector model, or aggregate demand in four sector model will be less than aggregate demand in three sector model. So aggregate demand in four sector model will lie above aggregate demand in three sector model. In such a case, what will happen? The equilibrium national income in four sector will be much higher than equilibrium national income in three sector. And if exports minus imports is negative, that means what? Exports are less than imports. If exports are less than imports, then what will happen? In such a case, aggregate demand in four sector will lie below aggregate demand in this sector. That means equilibrium national income under four sector will be less than equilibrium national income in three sector. Okay, so this can be explained in three different graphs. Okay, so we need to understand the equations first in two sector, three sector, four sector. Then it becomes very easy for us to understand all the concepts. Okay, right. Okay, the same thing is explained here also. Okay, and in the material you need to make small correction. That is it is S plus T plus M. See, in four sector model, the point where aggregate demand is equal to aggregate supply, injections will be equal to leakages. is what we were trying to do, or we tried to prove in 2 sector, 3 sector, as well as in doing the same in 4 sector also, right? Next, so you can look at the graph here, and you need to focus on two lines, that is c plus I plus g plus x minus m, this one, and this one. This is nothing but c plus I plus g, c plus I plus g. Okay, just focus on these two lines. Okay, at point d, at point d, c plus I plus g is equal to c plus I plus g plus x minus. That means nothing but aggregate demand in 3 sector is equal to aggregate demand in 4 sector. This is aggregate demand in 3 sector, and this is aggregate demand in 4 sector. That means what? At when aggregate demand in 3 sector and 4 sector are equal to one another, it means what? Nothing but exports is equal to import. It means exports equal to, okay. And before that, you can clearly see that aggregate demand in 4 sector is lying above aggregate demand in 3 sector. So in this entire region, we can clearly say that exports are more than imports. And after point D, you can see that aggregate demand in 3 sector is more than aggregate demand in 4 sector. So here in the entire region, here in this region, okay, exports are less than imports. So basically, we will draw three different curves, but three different graphs. But here he has trying to explain everything in a single graph. Okay, I hope it is very much clear to you. You can clearly see point number E is equilibrium in 4 sector, and point number F is equilibrium in 3 sector. This is equilibrium in 3 sector, and this one is equilibrium in 4 sector. So since at point E4, aggregate demand, since at point E4, okay, equilibrium point, that is E4, exports are less than imports. We can clearly see that aggregate demand in 4 sector is less than aggregate demand in 3 sector. When this happens, equilibrium income in 4 sector will be less than equilibrium income in 3 sector. So this is equilibrium income in 3 sector, and this one is equilibrium income in 4 sector. Equilibrium income in 4 sector. Okay, so that is income determination. So once we have done it, Nana, then we can find the equilibrium equation in 4 sector model at equilibrium point. Okay, so we'll substitute, we'll first simplify the consumption function, then we'll substitute that consumption function into the equilibrium equation, that is y equal to c plus I plus g plus x minus m. When you mathematically solve it, you will get this equation. Okay, and just like investment multiplier, we also have trade multiplier. See, investment multiplier means we're talking about closed economy, right? That's why the multiplier will be 1 by 1 minus b. Okay, but when it comes to, see, the investment multiplier delta y by delta I is nothing but 1 by 1 minus b. But when it comes to foreign trade multiplier, there is nothing but delta y by delta x. That means here delta x is exports. So when there is change in exports, automatically there will be greater change in your national income. When there is change in exports, definitely there will be greater change in national income. So what is that change? How to calculate that change? The formula is 1 by 1 minus b minus m. 1 by 1 minus b plus m, or it can be written as like this, where small m stands for marginal propensity to import. Small m stands for marginal propensity to import. Okay, this is foreign trade multiplier. Next, concept 7, leakages, injections. We already explained what are meant by like leakages and what is meant by injection. Simply stating, leakages means it reduces the flow of income, it reduces the amount of money in an economy. Injection means it exogenous addition to the circular flow of income. Okay, right. So you can clearly see what is the effect of leakages. It causes responsible for the decline in income as leakage, are called leakages. So when the income decreases because of certain variable, that variable is called as leakages. The more the powerful the leakager, the less the value, the value of multiplier. And opposite will be in regards to injection. It is an expenditure on goods and services produced within the domestic territory, but not used by the domestic holders for consumption purpose. So what are the examples for leakages, savings, imports and taxes, injections, investment, government spending and exports. So simply stating, leakages will lead to decrease in flow of money in an economy. Injections will lead to increase in flow of money in an economy. Okay. When the income decreases, automatically reduces the flow of income. When the flow of income decreases, demand decreases, production also decreases. So instead of explaining all these things, I have tried to put it in a simpler way. If the production decreases because of a certain variable, it is called as leakage. And if the production increases because of a certain variable, it is called as injection. Okay. So this is about the chapter. And at the end of the chapter, a list of formulas are given. You can clearly see those list of formulas. I have already explained what do you mean by aggregate demand in 2 sector, 3 sector, and 4 sector. Aggregate supply in 2 sector, 3 sector, and 4 sector. Okay. And point where aggregate demand is equal to aggregate supply, we will get injections equal to leakages. Okay. The formulas are given here. Average propensity to consume, marginal propensity to consume, average propensity to save, marginal propensity to save. Okay. All these formulas. The 3 sector model formula, 4 sector model formula, and a list of formulas are given. If at least people can go through a list of formulas given at the end of the material. Okay, it will be useful for you people. So with this, we can close this chapter. The next chapter is monetary policy. Sir, what do you mean by monetary policy? Policy related to money is called as monetary policy. Okay, basically, monetary policy is taken by a monetary policy committee. Simply stating in keeping it in simple words, the policy that is taken by RBI is called as monetary policy. What do you mean by monetary policy? It includes all the actions. It includes all the actions of central bank aimed at directly controlling money supply. It includes all the actions of central bank. Central bank means when it comes to India, it is RBI. It includes all the actions taken by central bank of a country aimed at directly controlling the money supply and at regulating the demand for money by using its monetary policy instruments. Okay, so RBI at its disposal has several instruments, quantitative as well as qualitative. Sir, can you give some examples of these instruments? CRR, SLR, repo rate, reverse repo rate, priority sector lending, all these are instruments available with RBI or central bank of that country. It will use these instruments to control amount of money in an economy directly. Money supply means amount of money in an economy. And it will control indirectly the demand for money. Demand for money means cash in hand, the amount of money people are willing to hold as cash in hand. So just like any other organization or any other policy, monetary policy also has certain objectives which it wants to achieve. These objectives are classified or mentioned below. Okay, objectives of monetary policy in India. What are the objectives of monetary policy when it comes to India? Maintaining price stability, nothing but controlling inflation. Adequate flow of credit to productive sectors. See, government has identified which sectors are productive and which sectors should be given priority. Now, central bank should make sure that these sectors are made available with sufficient amount of credit. And economic growth, they should be economic. It's the objective of any central bank in the world. Okay, economic growth, trying to achieve rapid economic growth. Okay. Apart from these objectives, are there any other objectives? Yes, there are some more objectives, multiple objectives. Rapid economic growth. We should have economic growth and it should be rapid. It should be accelerating. Okay. Debt management. We should be able to manage debt. Since RBI acts as banker to the government, it knows what is the amount of debt country has. So it should advise government how to manage the debt, how to reduce the debt year by year. Okay. Moderate long-term interest rates, exchange rate stability, controlling the value of rupee indirectly. Okay, because that is the responsibility of government, right? So RBI also plays a very important role, but indirectly. Okay. And balance of payment equilibrium, maintaining balance between receipts and payments. Okay. Next, explicit objectives. When it comes to countries like India, what are the objectives which are related to countries like India, which are exclusively related to countries like India? Economic growth, adequate flow of credit to productive sectors, moderate long-term interest rate to encourage investment, and creating efficient market for government securities. What do you mean by that? Here, efficient market means I'm talking about creating demand. Demand. See, RBI has framed rules and regulations in such a way that banks are forced to purchase, banks have to purchase securities issued by Government of India. So whenever government wants to sell its securities, banks are the first to purchase those securities. If RBI had not passed that rule, what is that rule? I will explain it in some time. If RBI had not passed that rule, then no bank will be willing to purchase government securities. But simply, as RBI has passed a rule, banks need to purchase government securities. So in this way, RBI has created market or demand for government securities. Okay, this concept one. Next concept two. Money transmission mechanism. See, monetary transmission mechanism. What do you mean by transmission mechanism? How the effect is getting passed from one variable to another variable. How the effect is getting transmitted from one variable to another variable. That is called as monetary transmission mechanism. Okay, that means when RBI changes, when central bank changes a particular variable, how it affects the entire economy, how it affects employment and productivity. So monetary transmission mechanism is a process or channel through which change of monetary aggregates affect level of production, prices, and employment. So when there is change in certain variables by central bank, it will affect production, prices, and employment. This effect is called as transmission mechanism. It can be explained as under. So first one is interest rate channel. Okay. So what Keynes said, during inflation means already there is so much amount of money is there in the economy. That's why people are demanding more and more goods. Because of that, the prices of goods keep on increasing. This is called as inflation. So in expansion phase, we generally suffer from inflation. Why? Because people already have money with them. People already have abundant amount of money or more than sufficient amount of money with them. Now, in such a case, the RBI, what it will do, it will increase the interest rate on loans. It will increase the interest rate. When the interest rate on loans increases, borrowings decreases. Borrowings decreases. It is as the interest rate increases, what will happen? Borrowings decreases. And borrowings decreases, investment decreases, production decreases, consumption also decreases. That means demand decreases. By this way, the price of the goods can be reduced to a certain extent. You can clearly see just by affecting interest rate how we are able to affect the demand, the employment, the production. Once again, I'm repeating. During inflation, when we are in expansion phase, we suffer from inflation. To control this inflation, what RBI will do? It will increase the interest rate on loans. When the interest rate on loans increases, it will discourage the people from borrowing money. So when borrowings decreases, investment decreases. When investment decreases, production decreases, employment decreases, income decreases, demand decreases. And when demand decreases, prices also decrease to a certain extent. So when one particular variable is changed, it is affecting all the remaining variables in the economy. And the policy taken by RBI during inflation is called as contractionary monetary policy, because the objective of RBI is to contract, reduce the amount of money in an economy to control inflation. And coming back to recession, in contraction phase or recession phase, what will happen? The economy is suffering from lack of money. That's why they are unable to demand, and that's why companies are not willing to produce. And the objective of RBI is to increase the amount of money with people during recession. So what RBI will do? It will reduce the interest rate on loans. When the interest rate on loans decreases, cost of borrowing decreases, investment increases, production increases, employment increases, income increases, and economy will recover. So policy taken by RBI during contraction phase or recession phase is called as expansionary monetary policy. Expansionary monetary policy. Okay. Next, exchange rate channel. When there is a change in external value of rupee, then how it will affect production and employment. It is what is explained here. So when there is appreciation of home currency, what do you mean by appreciation of home currency? That means value of rupee has increased. When value of rupee increases, that means earlier $1 was equal to 82 rupees. Now it is $1 equal to 80 rupees. Earlier $1 is equal to 82. Now $1 is equal to 80 rupees. So this is called as appreciation of, that means there is increase. That when we are paying less against dollar, that means the value of rupee has increased. When the value of rupee increases, exports become costlier, expensive, and imports become cheaper. That means demand for our exported goods decreases and demand for imports into India increases. When demand for imports or imported goods increases and exports decreases, domestic production decreases. Domestic production decreases. When domestic production decreases, employment also decreases. And coming back to depreciation of home currency. Depreciation of home currency means fall in value of rupee. Earlier $1 was equal to 80 rupees. Now $1 is equal to 83 rupees. We are paying more compared to earlier. That means value of rupee has decreased or depreciated. In such a case, what will happen? Exports become cheaper and imports become expensive. That means demand for our goods in foreign countries increases and demand for imports into India decreases. Exports are increasing, imports are decreasing. When this happens, what will happen? Net exports rises, production increases, employment also increases. Okay, so this is another transmission mechanism. Next, credit channel, talking about open market operation. What is that? What do you mean by credit channel? So during inflation, what RBI will see? Inflation means there is so much amount of money in an economy, and because of this only we are suffering from inflation. Now RBI wants to reduce the amount of money in an economy. So what RBI will do? It will sell government securities in the market, and people will be willing to purchase those government securities. And what will happen? Securities will move from RBI to public and market, and money will move from market to RBI. That means amount of money in an economy or market decreases. Here market means banks. Market means banks. So when RBI, during inflation, RBI sells securities to banks. So when banks start purchasing securities, automatically funds with banks decreases. Lending capacity of banks decreases. When lending capacity of banks decreases, borrowings decreases, investment decreases, employment decreases, production also decreases. So this is called as contraction in monetary policy. And during recession, whatever the securities that is sold, see, in recession, RBI wants to increase the money with banks so that the amount of money in the market increases. Public also increases. So during recession, what RBI will do? Whatever the securities it has sold earlier, you try to purchase it. So when RBI is trying to purchase securities from banks, securities will move from banks to RBI and money will move from RBI to banks. So amount of money with banks increases, lending capacity of banks increases, borrowings increases, investment increases, production, employment also increases. This is credit channel. Okay. Next, balance sheet channel. What do you mean by balance sheet channel here? Right. When RBI increases the interest rate on loans, it will have two kinds of effect. One is immediate effect and the one is drag-on effect or long-term effect. Okay. So when RBI increases the interest rate, what will happen? It reduces the, see, when RBI increases the interest rate, no matter how much amount of profit a firm may earn, most of that profit will be used to repay the loan. So it reduces the profits of the firm. When the profits decreases, automatically investment decreases. Investment decreases, production also decreases. That is immediate impact. What is the long-term impact? When the RBI increases the interest rates, the debt burden of the company also increases. It reduces the capitalized value of fixed assets. Whatever the amount it has kept as collateral, the capitalized value of fixed assets also decreases. So in the short run, company does not have any profits because most of the profits are used to pay the loan. So it does not have any money of its own. And when the interest rate increases, the debt burden of the company also increases. It does not reflect good in the balance sheet. So no new investor will be willing to invest in the company. On one hand, company does not have any profit on it, sufficient amount of profits on its own. And when it wanted to borrow, no new lender is willing to lend money because already the company is in so much amount of debt burden. So it will have both short-term impact and long-term impact. That is called as balance sheet channel. Now, what do you mean by standard asset price channel? See, when the RBI increases the interest rate on debt instruments become more attractive. So investors will shift demand from equity to debt instruments. So demand for equities decreases and demand for debt instruments increases. When demand for equity decreases, market price of equities also, market value of equities also decreases. When the market value of equities decreases, what will happen? The wealth of existing shareholders decreases. When the wealth decreases, consumption decreases, production decreases, employment also decreases. Okay. And expectation channel. What do you mean by expectation channel? Change in monetary policy have impact on people's expectations. Because of change in interest rate, change in monetary policy have impact on people expectations about inflation and aggregate demand. So when there is change in policy, monetary policy, whether government policy or monetary policy, people will be anticipating that something is going to happen in coming future, right? So this in turn will affect their consumption pattern, which in turn has an effect on production and employment. So these are some of the transmission mechanisms. Okay. Right. Concept 3. Operating framework and implementation of monetary policy in India. So what do you mean by operating framework? Framework means structure here. Okay. So operating framework, what does it mean? It relates to all the aspects of implementation of monetary policy. So when it comes to monetary policy, how the RBI will implement the monetary policy, what is the system or structure it follows. So first it needs to choose operating targets. Sir, what are operating targets? The variables which RBI can control to a largest extent. The variables which the RBI can control or can influence directly are called as operating targets. And what do you mean by choosing intermediate targets? With the help of operating targets, whatever the variables the RBI is able to influence, it is called as intermediate targets. See, operating target means the variables which the RBI can influence directly. Intermediate targets means the variables which the RBI can influence indirectly with the help of operating targets. So in order to choose these operating targets and have the appropriate effect in an economy, RBI needs certain instruments. So what are those instruments that are available? So RBI uses one among the various tools to influence the money market. So it has different instruments at its disposal. So what are these instruments? These instruments can again be divided into two types. One is direct instrument and the one is indirect instrument. What do you mean by direct instruments? CRR, SLR, credit to priority sectors, administered interest rates. So these two are quantitative instruments and these are qualitative instruments. Anyway, these are nothing but direct instruments. And what do you mean by indirect instruments? Indirect instruments are repos, that means both repo as well as reverse repo, open market operations, standing facility, and market-based discount window. So these are some of the instruments. These are some of the instruments available with RBI. With the help of these instruments, RBI will try to implement the policy in an economy and will try to influence operating targets as well as intermediate targets. Okay, right. Next, let us see the instruments one by one. The first instrument that is available to RBI is cash reserve ratio, CRR. Okay, we all know that every bank has to maintain certain amount of reserve out of the total deposits that it has received on that day. These reserves can be divided into two types. One is CRR and the other is SLR. What do you mean by CRR? Out of total deposits, certain percentage is to be maintained in cash. Out of total deposits, certain percentage is to be maintained in cash with RBI itself. And what do you mean by SLR? Out of total deposits, certain percentage is to be maintained in the form of liquid assets with the bank itself. Okay, let us see one by one. What do you mean by cash reserve ratio? CRR refers to average daily balance that a bank is required to maintain with RBI as a share of net demand and time liabilities. So it is nothing but certain percentage which the bank is required to maintain. Share means here certain percentage. Okay, right. So this percentage will be notified from time to time by RBI. So RBI itself will intimate how much amount of percentage or what is the percentage of CRR that is maintained by bank every time. Okay, on daily basis. It applies uniformly to all the scheduled banks in the country, irrespective of the size and financial position. The failure of banks to maintain CRR, to meet CRR obligations, is liable to penalty. So, if banks fail to maintain CRR with RBI on daily basis, then RBI will punish banks appropriately by charging them a very high rate of interest. Okay. Next, statutory liquidity ratio. So, as per Banking Regulation Act 1949, all scheduled banks in India are required to maintain a percentage of their total net demand and time liabilities in any one of the following form. There is nothing but cash, gold, or unencumbered securities. What do you mean by unencumbered securities? Debt-free securities. That means these securities are not kept as collateral against any loan. Such kind of securities can be kept. Okay, and moreover, when it comes to unencumbered securities, preference is given to state government and central government central governments securities, and security is notified by RBI. Okay, and if just like CRR, if banks fail to maintain SLR, then they are liable to punish. Okay, next, liquidity adjustment facility. So from June 2000 onwards, central banks started using liquidity adjustment facility, or started offering liquidity adjustment facility. So what do you mean by liquidity adjustment facility? The name itself suggests liquidity adjustment facility. Liquidity means money. See, if banks are facing shortage of funds, they can adjust these funds by borrowing from RBI for a short period of time. And if banks have excess of funds, they can deposit the excess funds with RBI for a short period of time. So in this way, banks can adjust when there is shortage or when there is excess of funds with them. Okay, this is called as liquidity adjustment facility. In this, it is a facility extended by RBI to the scheduled commercial banks and primary dealers to avail of liquidity in case of requirement. Okay, that is nothing but or park excess funds with RBI in case of excess liquidity. So when banks are facing shortage of funds, they can borrow from RBI, and when banks have excess of funds, they can deposit the same with RBI on overnight basis, daily basis against collateral of government securities. See, when we borrow from banks, we need to keep something as collateral, right? In the same way, when banks need money from RBI, they have to keep something as collateral with RBI. So here, banks have to keep government securities as collateral. Against that only banks can borrow money on overnight basis. That is nothing but daily basis. Okay, right. So LAF is nothing but liquidity adjustment facility is led at a fixed time on daily basis on all working days in Mumbai. Okay, excluding Saturdays, on all days LF facility is provided. LF consists of overnight as well as term repo option. Term means a fixed period of time. The time is also given in this question. Overnight LF means RBI gives financial accommodation to banks through repos and reverse repos. And term means here the duration of the repo will be from 7 days to from 7 days to maximum of 14 days. Okay. So overnight means on daily basis. Term repo means a maximum period of 14 days credit is given to the banks. Okay, right. Next, repurchase option. What do you mean by repo? Repurchase option means we're talking about repo. Okay, next. So instruments for borrowing funds from a bank by selling securities with an agreement to repurchase securities on a mutually agreed future date at an agreed price, which includes interest from the funds borrowed. So what do you mean by that, sir? See here, repurchase option or repo means this is RBI and this will be bank. When bank is in need of money, what it will do? It will borrow money from RBI. Okay. And against that borrowing, banks have to keep something as collateral, nothing but government securities as collateral. Government securities as collateral. Now, here banks will enter into an agreement or write an agreement with RBI stating that on after so and so days, that is nothing but after 2 days or 3 days or after 1 day, I'm going to repay you the money with interest. I'm going to repay you the money with interest. That is principal plus interest. And buy back these government securities from you. Whatever the interest bank is paying to RBI against short-term loans borrowed by it is called as repo. So overnight liquidity to banks are on collateralized lending. That is, banks are borrowing money from RBI by keeping some government securities as collateral with RBI. Now, RBI charges a rate of interest against that loan. Okay, so whatever the rate that is charged by RBI or paid by bank is called as repo rate. Now, what do you mean by repo markets? Repo on sovereign securities, repo on corporate. See, when it comes to repos, there are 3 kinds of repos. Repo on sovereign securities. Sovereign means government securities. Repo on sovereign securities means when banks borrow money from RBI by keeping government securities as collateral, whatever the interest bank pays to RBI is called as repo on sovereign securities. Sometimes banks can keep notified. Sometimes banks can keep corporate debt securities also, which are notified by RBI as collateral with RBI and borrow money against it. Now, whatever the interest banks are paying at that time is called as repo on corporate debt securities. And there are other repos also. Predominantly, bank and RBI will deal in repo on sovereign securities. But from time to time, banks may also use securities of private organizations as notified by RBI. Okay. Repo operations inject liquidity. Because of repo operations, what will happen? The funds with banks, see, repo operations means banks are borrowing money from RBI, right? Because of that, what will happen? The funds with banks increases. Lending capacity of banks increases. When lending capacity of banks increases, borrowings of the people increases, and automatically money in the economy also, liquidity in the economy also increases. Okay. Aim of term repo is to develop interbank term money market to set market-based benchmarks for pricing of loans and deposits and to improve transmissions of monetary policy. What is the aim of repo rate? Basically, when there is change in repo rate, there will be change in lending rate. So when the RBI wants to affect the lending capacity or affect the lending capacity, what it will do? It will affect the lending rate. How it will do it? By changing the repo rates. By changing the repo rates. Okay. Now coming back to reverse repo. Reverse repo, the name itself suggests here the entire process will be opposite to that of repo. What will happen, sir? So in this case, the RBI will borrow money from commercial banks, just like banks borrowed from RBI. So when RBI is borrowing money from commercial banks, what it will do? It will give government securities as collateral, and RBI will enter into agreement stating that after a couple of days or after a day or so, RBI will pay the principal amount of interest and buy back those securities, which is kept as collateral. Okay. Right. So whatever the interest that is paid by RBI to banks is called as reverse repo rate. Reverse repo rate. Okay. Right. So reverse repo rate is the rate of interest paid by RBI on its borrowings from banks on an overnight basis under LAF. It absorbs the liquidity from the system. It absorbs the liquidity from the system. See, repo injects money. See, when under repo, what is happening? Banks are borrowing money from RBI, right? So funds with our banks increases. When funds with banks increases, lending capacity of banks increases, borrowings increases, borrowings of people increases, money in the economy increases. But because of reverse repo rate, what is happening? The bank RBI is borrowing money from bank. When RBI is borrowing money from bank, funds with banks decreases, lending capacity of banks decreases, borrowings from banks decreases, automatically money in the economy also decreases. Okay. So it is linked to repo rate. That means whenever there is change in repo, automatically there will be change in reverse repo rate. So what RBI has done is that this is the hierarchy of interest rate. You have repo, you have reverse repo, and you have MSF, marginal standing facility. Whenever there is change in repo rate, there will be change in MSF and reverse repo rate. Whenever there is change in repo rate, there will be change in MSF and reverse repo rate. So earlier, what RBI used to do, it used to change all the three rates. But as of now, whenever there is change in repo rate, there will be change in reverse repo rate and MSF rate. Okay, right. Next, policy rate. What do you mean by policy rate, sir? See, when banks are borrowing money from RBI by keeping government securities as collateral, whatever the interest banks are paying against that borrowing, or whatever the interest that is charged by RBI against that lending, is called as policy rate. The most important rate. Okay, it is also a repo, but it is given more importance when compared to other repo. That's why it's called as policy rate. In India, fixed repo rate quoted for sovereign securities, nothing but government securities in overnight segment of LAF, is policy rate. RBI uses the single independent policy rate, which is the repo rate, for balancing liquidity. It is a key lending rate. It is a key lending rate for the central bank in a country. So when banks are borrowing from RBI by keeping government securities or sovereign securities as collateral, whatever the interest paid by banks or charged by RBI are called as policy rate. It is called as repo on sovereign securities. But compared to other repos, since this repo plays a very important role, it is also called as policy rate. So whenever there is change in policy rate, there will be change in all other interest rates. That's why repo on sovereign securities is called as policy, because it is the most important rate. Okay. Now, what do you mean by marginal standing facility? Marginal standing facility. Whatever the money banks have borrowed under LAF, liquidity adjustment facility, is not sufficient, then RBI is giving one more facility to banks where they can borrow money under MSF, but they have to pay high rate of interest. Okay. So this facility is called as marginal standing facility. See, under LAF they can borrow in multiples of 5 crores, but in MSF they can borrow in multiples of 1 crore. Okay. So if bank is in need of 6 crores, obviously what it will do, instead of borrowing 10 crores under LAF, it will borrow 5 crores under LAF and 1 crore under MSF. Okay, so banks can do like that. Okay. So MSF, marginal standing facility. From 2011-12, RBI, being a banker's bank, acts as lender of last resort. MSF is aligned with bank rate. Okay. Next, facility under which scheduled commercial banks can borrow additional amount of overnight money from RBI over and above the available through LAF by reducing their SLR portfolio up to the limit at a penal rate of interest. What does it mean? After borrowing under LAF, If banks are in need of more money, then they can borrow under MSF. Okay. So once LAF quota is utilized, if banks are in need of more money, then they can borrow under MSF. But when it comes to borrowing under MSF, banks have to cough up more interest. They have to pay more interest than what they were paying under LAF. Okay. So that is the meaning of MSF. So banks borrow through MSF on all working days except Saturday, just like under LAF. The timing, the window will be between 7 p.m. to 7:30 p.m. Okay. Minimum amount access to through MSF is rupees 1 crore, and more will be in multiples of 1 crore. When it comes to LAF, it will be in multiples of 5 crores. Minimum is 5 and multiples of 5 crores. Here it is minimum 1 crore and multiple of 1 crores. Of the interest corridor, MSF rate will be the highest, repo rate will be in middle, and reverse repo rate will be the least. So that is what I have explained already. Okay. So this will be the hierarchy. Repo rate lies in between MSF and reverse repo. Reverse repo being the lowest and MSF being the highest. Okay. Right. Next, bank rate. What do you mean by bank rate, sir? So under section 49 of RBI Act 1934, bank rate is the standard rate at which RBI prepared to buy or rediscount bills of exchange. As of now, this rate has become dormant rate. That means RBI is no longer accepting bills of exchange and giving money to banks or lending money to banks under this scheme. Okay, as of now, most of the money or all the money is borrowed under LAF itself. Okay. So, at which RBI is prepared to buy or rediscount bills of exchange or other commercial papers eligible for purchase under the Act. So, if banks are in need of money under bank rate, what was the system? If banks were in need of money, what they used to do, they used to discount the bills of exchange with them and borrow money from the RBI. Okay, whatever the interest that is paid by banks against that amount is called as bank rate. Bank rate has been discontinued. Sorry, bank rate has been discontinued with the reduction of LAF. That's why I said it has become a dormant rate. Okay, and it is linked up with MSF rate. And this bank rate is predominantly used to impose penal charges, penal interest charges when companies fail to maintain, when banks fail to maintain CRR and SLR. Okay, right. Next, open market operation. What do you mean by open market operation? Shortly called as OMO. Market operations conducted by RBI by way of sale or purchase of government securities to or from market to adjust rupee liquidity conditions in on durable basis. So when there is more amount of money in an economy and it is leading to inflation, what RBI will do? It will sell government securities available with it and try to absorb that excess liquidity from the market. And when there is shortage of liquidity in the market, this will affect production adversely. So what RBI will do? It will purchase whatever the government securities sold earlier. In this way, what will happen? The money in the market increases. So when there is excess money, RBI will sell government securities to absorb the money from the market. And when there is shortage of liquidity in the market, what RBI will do? It will repurchase the government securities from the market. In this way, the money with the market also increases. Okay. So RBI sells securities to decrease the rupee liquidity, and RBI purchases securities to increase the rupee liquidity. That is what it is given here. Okay. Next. Note, all instruments of monetary policy, be it CRR, SLR, repo rate, reverse repo rate, policy rate, bank rate, and MSF rate, are inversely related to either money supply, credit supply, lending, investment, employment, and output, economic growth, income, aggregate demand, inflation, liquidity. That means whenever there is change in needs in these instruments, there will be an opposite change in the economic variables. Example, during inflation, CRR should be increased to reduce liquidity in the economy, and during recession, CRR should be reduced to increase liquidity in the economy. In the same way, the relationship exists between other variables also. Okay, that is between SLR, repo, reverse repo, and economic variables. Okay, right. Now, concept 5, what is meant by market stabilization scheme? It is almost similar to open market operations, but here the objective is to sterilize the market. What do you mean by sterilize? Sterilization is the process by which monetary authority sterilizes effects of significant foreign capital inflow on domestic liquidity by offloading parts of government securities held by it. So what does it mean, sir? If there is a sudden increase in foreign capital inflow, it will increase the amount of liquidity in an economy. This may lead to inflation. In order to nullify this effect of sudden increase in foreign capital inflow, RBI will take up the sterilization process. Sterilization means cleaning process. Okay, cleaning of the economy. That's stabilizing. Yes, stabilizing the economy. Okay. So what RBI will do in order to absorb this excess liquidity, sudden increase of inflow leading to excess liquidity. Okay, in order to absorb this excess liquidity, what RBI will do? It will sell. Offloading means sell government securities in the market. So for this, RBI need government securities. So keeping this thing in mind, RBI and Government of India have entered into an MOU in 2004 itself. Okay, stating that government, if RBI is in need of government securities, then government will borrow more than required so that RBI can have government securities. Okay, so under MSS, that is Market Stabilization Scheme, the Government of India borrows from RBI and issues treasury bills and data securities for absorbing excess liquidity arising from large capital inflows. So because of a sudden increase in foreign capital inflow into the country, it will lead to excess liquidity in the economy. When there is excess liquidity, it will lead to inflation. It will cause instability. In order to rectify this, what RBI is doing, it is selling government securities held by it. Now, for that, RBI needs government securities, right? So, keeping that thing in mind, RBI has entered into a MOU with Government of India, where the Government of India will borrow money from RBI. Even though it is not in need of it, it will borrow money from RBI by keeping government securities as collateral. Okay. Then RBI will use these government securities to sell the same in the market and absorb that excess liquidity, which is caused because of increase in large foreign capital inflow. Okay. So that is market stabilization scheme. Next one is Monetary Policy Framework Agreement. What do you mean by Monetary Policy Framework Agreement? Monetary Policy Framework Agreement. So RBI Act 1934 amended on June 27, 2016 for giving a statutory backing to Monetary Policy Framework Agreement. Okay. So what is Monetary Policy Agreement? What sort of structure it should have? What are its objectives? All those things will be mentioned here. It is an agreement reached between Government of India and RBI on maximum tolerable inflation rate. RBI and Government of India both have multiple objectives, but the most important objective which is common to both of them is control of inflation. So, under this Monetary Policy Framework Agreement, both the parties, Government of India and RBI, came into an understanding in regards to inflation. That means to what extent inflation can be allowed. There is a maximum tolerable inflation rate that RBI should target to achieve price stability. So, if inflation rate is at that particular level, there will be price stability in economy. Okay. So, what does it agreement does? Okay. It provides statutory basis for implementation of flexible inflation targeting framework. There is nothing but announcement of an official target range for inflation is known as inflation targeting. That means for every 5 years, RBI and Monetary Policy Committee will announce the inflation target. So inflation target means what? The Monetary Policy Committee wants to keep inflation between these two numbers. Okay. On January 2014, RBI abandoned multiple indicator and made inflation targeting the primary objective. Inflation has become a primary objective of RBI. The inflation target is to be set by Government of India in consultation with RBI once in every 5 years. So during these 5 years, the inflation should be between the limits defined by RBI and Government of India. Central government constitutes as failure to achieve the inflation target. So both these parties, after consultation, have given a target, and according to them, for this coming 5 years or for these 5 years, the inflation should be at that level. Okay. Now, when we can constitute or we can say that the Monetary Policy Committee or Government of India or RBI have failed to achieve the target, when these two situations occur, then we can say that Government of India and RBI have failed to achieve the target. Okay, that inflation target. Now, what are those two situations? When average inflation is greater than upper tolerance level of inflation. What do you mean by upper tolerance level of inflation? As of now, it is 6%. If average inflation is more than 6% for any 3 consecutive quarters, or if average inflation is less than 2%, that is lower tolerance level of inflation for any 3 consecutive quarters. So if inflation is more than 6% for 3 consecutive quarters, that means 9 months, and if inflation is less than 2% for the 3 consecutive quarters, that is nothing but 9 months, then we can say that the government of India and RBI have failed in achieving their targets. Okay, so this is the limit defined by the government of India and RBI for the 5 years period. Okay, so inflation should not be beyond 6%, it should not be below 2%, it should be between in this, nothing on an average 4%. Okay, right. Next, Monetary Policy Committee. Okay, so in order to implement this agreement, there should be a committee, right? So before constitution of Monetary Policy Committee, a technical advisory committee, a monetary policy, a technical advisory committee, a monetary policy with experts from monetary economics, central bank, financial markets, and public finance advised RBI. So earlier, RBI should do everything by taking certain suggestions from different committees and different groups. Okay, its role was only advisory in nature. Okay, with the formation of Monetary Policy Committee, the Technical Advisory Committee on Monetary Policy stopped to exist. So before Monetary Policy Committee, most of the work was done by Technical Advisory Committee, and its role was only restricted to advise. Its role was only restricted to advise, giving advices. Okay, it's up to the RBI whether they want to take that advice or not. But once Monetary Policy Committee was established, then Technical Advisory Committees stopped to exist. That means basically Technical Advisory Committee was replaced by Monetary Policy Committee. Next, Monetary Policy Committee in India. RBI Act 1934 amendment on 27/6/2016 constituted a 6-member Monetary Policy Committee in September 2016. Now, when it comes to this committee, who are the members? Okay, Monetary Policy Committee consists of RBI Governor, nothing but chairperson, RBI Deputy Governor in charge of monetary policy, one official nominated by RBI board, and remaining 3 central government nominees representing Government of India. That means 3 from RBI and 3 from Government of India. So having and members nominated by Government of India have knowledge and experience in economics, banking, finance, and monetary policy. The Monetary Policy Committee determines the policy rate required to achieve inflation targets. So in order to control inflation, what should be the policy rate? When policy rate is affected, automatically all the rates will be affected. The new system is intended to incorporate. Why Monetary Policy Committee replaced Technical Advisory Committee? Because of these reasons. Monetary Policy Committee incorporated diversity of views because there are different people from different backgrounds, right? So more views, more inputs. Specialized experience, independence of opinion, representativeness, accountability. All these are the points because of which are far more advantageous when compared to TAC, it is Technical Advisory Committee. That's why Monetary Policy Committee replaced Technical Advisory Committee. Okay, and the last one, basically short notes on monetary and macro financial policy during COVID pandemic. Okay, so it's a generalized question. So what sort of steps taken by Monetary Policy Committee? Basically, in the COVID pandemic means we were in sort of contraction phase, right? That is nothing but recession. In order to come out of recession, what RBI did? Basically, it reduced all the interest rates. So repo rate of 1.15 basic points. So repo cut of 1 point, repo rate reduced from the point cut change. Repo rates were cut by 1.115. ఇదంతా క్వశ్చన్ అంతా కట్ చేయండి, కాన్సెప్ట్ 8 ఏదైతే ఉందో అది కట్ చేయండి. ఓకే, so last concept 8, short notes on monetary and macro financial policies during COVID-19. So what steps were taken by RBI, Monetary Policy Committee, to tackle COVID pandemic? Okay, so basically we were in recession in those days, right? And so in order to tackle recession, what RBI does most of the time, it used its instruments. So repo rate was cut, CRR were also cut, liquidity measures were taken. Liquidity measures means long-term repo operations and increase in MSF to 3% of SLR. So basically, all these measures were taken to make sure that banks have more amount of funds and lending capacity of banks were also increased. Okay, so all these points are given here. If you go through all these points, you can easily understand what is what. Okay. Government announced several schemes for healthcare sector. Government announced several schemes for MSME sector. It also created special purpose vehicle to purchase short-term debt of eligible NBFCs and HFCs. Okay, right. So all these are the steps taken by monetary policy to tackle COVID-19 pandemic. Okay. So if you remember any 6 points, it will be better if they ask an examination. Okay, right. So with this, we have completed this chapter. So the next chapter is money markets. Okay. In this chapter, what we are going to learn? Basically, in this chapter, we are going to learn three things. One is introduction of money. Second one is demand for money. And third one is supply of money or money supply. Okay. Let us see the first one, that is concept one, basics of money. In this concept, we will learn about the introduction of money. Okay. So definition. Money is a set of liquid financial assets, variation in the stock of which will have impact on aggregate economic activity. Whenever there is change in amount of money, there will be change in economic activity. There will be change in production, consumption, distribution, all these things. All these depend on money. If there is change in amount of money available with people, obviously there will be change in economic activity. As a statistical concept means measurement concept here. Okay. Money could include certain liquid liabilities of a particular set of financial intermediaries or other issuers. So what is the nature of money? One of the financial assets held by households, firm, government in their asset portfolio. See, money not only means cash, it means all the wealth assets. So here nature of money means we're talking about the cash. Okay. So one of the financial assets held by households, firms, government in their asset portfolio. Generally acceptable in settlement of all economic transactions. This is the most important feature. It should be generally acceptable by everyone in settling the transactions. Then on it can be called as money. Liquid assets compared to other forms of money, it is the most liquid because it can be used directly, instantly, conveniently, and you will not incur any sort of transaction cost. That means there is no need to convert from one form to another form. See, gold can be also called as money, but gold may not be acceptable by everyone in the society. So you have to convert gold into cash, right? For converting gold into cash, you may incur a certain amount of brokerage or commission fee. So that is called as transaction cost. When you are holding cash in hand, when you are holding cash, there is no need to convert it to any other form, right? So you will not incur any sort of cost. Now, money is a fiat money. That means it does not have any intrinsic value. It does not have any value of its own. It is valid as long as it is approved by Government of India. The moment the Government of India withdraws its legality, it will be equivalent to a waste paper. Okay, so it is fiat money. It does not have any value of its own. That means it has no intrinsic value. Government by law made it a legal tender. That's why we are using it. Okay. The moment government withdraws its legality, that means that is what it happened, demonetization, right? Government withdrew its legality for 500 rupees and 1000 rupees notes. The second moment, they were not at all valuable. So we were asked to change from old currency to new currency, which are legal, which are approved by Government of India. Next, maybe in physical form or electronic form. Note, anything that can act as medium of exchange is not necessarily money. Simply acting as a medium of exchange does not constitute as money, because bill of exchange may be used as a medium of exchange, but it is not money because it is not generally acceptable by everyone in society. That's why I said generally acceptable is the most important feature. Okay. Next, characteristics of money: durable or long lasting, effortlessly recognized. Even a blind person should be able to recognize it. Okay. Difficult to counterfeit, that means difficult to copy and difficult to make duplicate copies of it. Next, relatively scarce compared to our wants. Money is always scarce, but supply is elastic. As when required, RBI can supply money. Portable or easily transportable, possessing uniformity. There should be uniformity when it comes to printing. Then only it can be easily recognized. Okay, so 100 rupees notes, a newly issued 100 rupee note in Andhra Pradesh, a newly issued 100 rupee note in Assam will be one and the same. So they should possess uniformity and divisible without losing value. Even when a 100 rupee note is divided into small denominations of 10 rupee notes, then value will be same. It means value of 100 rupee note is equal to value of 10 rupee notes. Even when the money is represented in small denominations, the value will be the same. Okay. Now, functions of money. What are the functions of money? So the first function is money serves as a medium of exchange. By acting as an intermediary, medium of exchange means intermediary. Money increases the ease of trade and reduces the inefficiency and transaction cost involved in barter exchange. See, because of money, we can avoid double coincidence of wants. Right? Double coincidence of wants is one of the drawbacks of barter system. That means buying and selling of both the parties or wants of both the parties should coincide. Then only barter system is possible. But with the use of money, what we can do, there is no need for wants of both the parties to coincide. You can buy at any given point of time, and some other party can buy any given point of. No need for both the people to carry out buying and selling at same time. Okay, so with this we are able to reduce the time and effort of involved in transactions. Though money do not have any inherent power to directly satisfy human wants, by acting as a medium of exchange, it helps us to purchase goods and services to satisfy our wants. See, money does not satisfy our wants directly. Goods and services satisfy our wants directly. But goods and services are to be purchased, right? So for that we need money. So money satisfies our wants indirectly, whereas goods and services satisfies our want directly. Okay. Next, measure of value or unit of account. What does it mean? Rupee is the unit of account in India. When it comes to India, rupee is the national currency, right? So entire money is denominated in rupees. So when the same currency is throughout the India, value of all the goods and services will be expressed in money itself, right? So when the value of all the goods and services is expressed in a single currency, it becomes very, very easy to compare and take appropriate decisions. As a unit of money, it measures and expresses the value of goods and services in terms of price. Money is the measuring rod of utility. So this is what we have studied in LDMU. Okay, if the marginality of money is constant, then we can say that money is the measuring rod of utility, but it's not entirely true. The value of money is inversely related. The value of money is inverse of purchasing power. There is inflation here, consumer price index. That means as inflation increases, value of money decreases. As inflation decreases, value of money increases. Okay. Next, the third function of money is standard of deferred payments. See, money value can be stored. That means what, sir? Provided there is no inflation and deflation. Provided there is no inflation and deflation. The value of money, the value of today's money will be equal to the value of money after 10 days. The value of today's money will be same as that of value of money after 10 days, provided there is no inflation and deflation. That means you can store the value. So money is a unit in terms of which future payments are contracted or stated. So since we are able to store the value here, we can carry out credit transactions. I can borrow money from my friend today and I can pay him after 10 days, the same amount of money, provided there is no inflation and deflation. But if there is inflation or deflation, then interest rate will be affected, right? So money facilitates recording of deferred promises to pay and simplify credit transactions. But inflation and deflation reduces the efficiency or efficacy of this function. Till now, whatever we have discussed, we assumed that there is no inflation deflation. But if there is inflation and deflation, definitely it will reduce the value of money. This function of money helps in capital formation by government and business enterprises, growth of financial and capital markets, growth of economies. Since there is standard of deferred payment, there is a possibility of deferred payments. Government, public sector enterprises, private sector enterprises, people are able to borrow from us and they can use that money to produce goods and services. It is helping in economy in growing also. Okay. Right. The last function is store of value. What do you mean by store of value, sir? Money has a store of value as it can transfer purchasing power from present to future. It is what I said. When it comes to money, value can be stored, but when it comes to barter system, the value of perishable cannot be stored. In case of perishable goods, sometimes the value may increase or sometimes the value may decrease as we progress from day to day. But here when it comes to money, provided there is no inflation deflation, the value can be stored. When the value can be stored, basically we can transfer purchasing power from today to tomorrow. Okay, so money has temporary store of value to perform medium of exchange function. Money has a permanent store of value. So money, when it comes to store of value, it can be either temporary or permanent. It can be either temporary or permanent. Sir, what do you mean by temporary? What do you mean by permanent, sir? Temporary store of value means keeping as cash in hand. And permanent store of value means converting cash into other forms of money, other assets now. Okay, so money has permanent store of value as it depends on degree and certainty with which the asset maintains its value over time. So when we will convert from cash to asset, it's cash to gold or cash to land, then when we are sure that the value of asset is going to increase continuously. So when the value of asset is going to increase continuously and when we have confidence of that, then there is no use of keeping that as money. It is better to convert from money to other form of asset. So if you're keeping as cash in hand, is called as temporary store of value. And if you're converting from cash to any other asset, is called as permanent store of value. Money commands reversibility. What do you mean by reversibility, sir? Value in payment is equal to value in receipt. Only money has that reversibility concept. In case of any other asset, there will be irreversibility. Okay, so these are the points regarding introduction of money. Okay, so the next concept is demand for money. So what do you mean by demand for money? Demand for money means the desire of people to hold money, nothing but cash in hand. Cash in hand. The demand of people to hold money is nothing but demand for money. So demand for money is a derived demand. That means the demand for money is indirect demand. When the demand for goods and services are there, automatically we will demand money. If there is no demand for goods and services, there will be no demand for money. Okay, so there will be direct demand for goods and services, whereas indirect demand or derived demand for money. Okay, so what are the determinants of demand for money? First determines income. As income increases, demand for money also increases, and vice versa. General level of prices. If the prices increases, people need to hold more cash to buy goods and services. So automatically demand for money also increases. Rate of interest. When the rate of interest increases, demand for money decreases because people would like to invest more money. Okay, so when their investments increases, automatically demand for money or cash in hand decreases. So there is an inverse relationship between rate of interest and demand for money. And degree of financial innovation. If there is a high degree of financial innovation, that means use of different apps, internet banking, etc., then demand for money or cash in hand decreases. So these are the determinants of demand for money. Okay, and theories on demand for money. So what are the different theories? So different economists came up with different theories explaining why people want to maintain cash in hand or desire to hold money. So theories, what are those theories? Quantity theory of money, Cambridge approach, liquidity preference theory, inventory approach, Friedman restatement of quantity theory, and demand for money as behavior towards risk. Okay, so these are all together we have 6 theories. Okay, first 3 are the primary theories, and remaining 3 theories are the basic development of liquidity preference theory. Okay, let us see one by one. Classical approach. First theory is classical approach, or also called as quantity theory of money. What do you mean by classical approach? See, this theory was given by Irving Fisher, and he focused only on transactional motive. See, there are 3 motives why people want to hold cash in hand. First one is transactional motive, second one is precautionary motive, and third one is speculative motive. What do you mean by transactional motive? What do you mean by transactional motive? Transactional motive means purchase of goods and services. Okay, so why people want to hold money? Because they want to purchase goods and services. This is called as transactional motive. Precautionary motive. Generally, people are not aware of all the expenditure they will incur throughout the month. Okay, sometimes they may incur sudden expenditure. So in order to face such kind of situations, they want to hold certain amount of money. Okay, as precautionary purpose. Okay, because no one knows what is going to happen in future, right? So to overcome such kind of problems or financial requirements, people maintain certain amount of cash in hand. It is called as precautionary motive. And speculative motive means we're talking about investment. If there is an investment opportunity and if some amount of cash is available with the people readily, they can take advantage of that investment opportunity. Okay. So these are 3 reasons why people want to maintain cash in hand: transactional motive, precautionary motive, and speculative motive. Okay. These economists focused on different motives to come up with different theories. For example, Irving Fisher focused on transactional motive alone, whereas Cambridge approach, the theory given by Alfred Marshall, A.C. Pigo, Robertson, and Keynes, they focus on transactional motive and precautionary motive. When it comes to liquidity preference theory given by Keynes, he focused on all the 3 motives: transactional, precautionary, and speculative. Okay, so step by step, the theories kept on developing. Okay, right. So the first theory was given by Irving Fisher. So it is based on demand for transactional motive. So here the demand for money is nothing but demand for money is nothing but transaction is based on transactional motive. So demonstration of QTM. There is a strong relationship between money and price level. So in this theory, we try to explain a strong relationship between money and price level. Money will present as M and price level represented as P. Okay. Changes in quantity of money in circulation bring changes in price level of economy. So what Irving Fisher is saying, if there is increase in amount of money in an economy, automatically it leads to inflation. There will be changes in price level. Okay, so basically he's trying to explain the relationship between M and P. So keeping this thing in mind, Keynes came up with an equation. It's called as equation of exchange or transaction approach. What is that equation? MV equal to PT. M into V equal to PT, where MV is nothing but supply of money and PT is nothing but demand for money. Where MV is nothing but supply of money and PT is nothing but demand for money. We all know that supply depends on demand, right? Supply depends on demand. So PT are independent variables and MV are dependent variables. So MV is nothing but supply of money and PT is nothing but demand for money. So let us see what do you mean by MVPT. M means total amount of money in circulation in an economy. Amount of money in circulation in an economy. P means average price, nothing but price. Okay. V means transaction velocity of circulation. Transaction velocity of circulation means number of times a rupee is demanded. It is called as velocity here. So if the demand for goods and services increases, automatically demand for money also increases. So we will demand rupees more number of times. So demanding the number of times a rupee is demanded is called as velocity. And T stands for total number of transactions, nothing but demand for goods and services. Okay. So later on, Irving Fisher modifies the equation as MV equal to M1V1 equal to PT. MV plus M1V1 equal to PT. Okay. So here, basically what Irving Fisher did is that he considered credit money also. So M1 stands for total quantity of credit money and V1 stands for velocity of circulation of credit money. Okay, so according to Irving Fisher, demand for goods and services not only depends on cash in hand but also depends on credit money. That's why he has taken this credit money also. Just like any other theory in economics, here also there are certain assumptions. What are those assumptions? First one, V and V1 and T will remain constant. Why it will remain constant? Because here Irving Fisher assumed that economy is at full employment. When the economy is in full employment, there will be no increase in income or decrease in income. That means whatever the amount of money you are earning till now, the same amount of money you will be earning. You keep on earning. So there is no change in income level. When there is no change in income level, there will be no change in demand, no change in number of transactions, no change in velocity. That means because of full employment, velocity, number of transactions and velocity of money will be the same. That is T is equal to V. So when T is equal to V, automatically T and V will be cancelled off and ultimately we'll try to explain the relationship between M and P, that is money and price level. Okay. So that is the theory given by Irving Fisher. So that was one of the oldest theories in economics regarding demand for money. Okay. But it focused only on transactional motives. So Cambridge economists came up with another theory called as neoclassical approach or Cambridge approach or cash balance approach. Here they focused on all the two motives, that is transactional motive and precautionary motive. Okay, we have three motives. Out of those, they focused on two motives. So it is somewhat advanced than QTM. So neoclassical approach or Cambridge approach or cash balance approach. Cambridge economists Alfred Marshall, A.C.P. Gore, Robertson, and J.M. Keynes came up with this theory. According to them, money increases utility both. We need cash in hand both for the sake of transactional motive as well as precautionary motive. Okay, so what is the explanation of the theory? Quantity of money demanded depends on income and general price level. Okay, so that is the explanation given by Cambridge approach, Cambridge economist. Quantity of money demand, the amount of money we want to maintain in hand, it depends on income and general price level. The higher the income, greater will be the demand for money. That is Cambridge economy. That is given by Cambridge economists. So they came up with an equation that is MD equal to K of P into Y. MD equal to K of the demand for money is nothing but K of P into Y. K is nothing but certain percentage. It is also called as Cambridge K. So MD stands for demand for money. Y stands for real national income. Real national income is nothing but quantity. We're talking about quantity. And P stands for price. So price into quantity means you will get nothing but income. So what Cambridge economy is saying, out of your total income, certain percentage will be maintained as cash in hand. So K stands for Cambridge, which is also called as Cambridge K, nothing but it's a certain percentage of your total income. So the equation explains that the demand for money equals K proportion of total money income. K proportion means certain percentage of your total income. So no individual will maintain entire income in the form of cash. Out of his total income, certain percentage will be maintained in the form of cash. Okay, so this is about neoclassical. Next, let us see liquidity preference theory, which is given by Keynes. So Keynes here focused on all the three motives: transactionary motive, precautionary motive, and speculative motive. Okay, let us see this question in detailed manner. People desire to hold money rather than securities or long-term interest investments. Okay, instead of converting cash into assets, why people want to maintain cash? Total demand for money is summation of transactional demand, precautionary demand, speculative demand. So according to Keynes, total demand for money is nothing but demand for money on the transactional motive, demand for money on the precautionary motive, and demand for money under speculative motive. Okay. So if we sum up the demand for money under all these three motives, we will get total demand for money. Okay. Transactional motive. When it comes to transactional motive, there's a direct relationship between income and demand for money. When it comes to precautionary motive, there's a direct relationship between demand for money and precautionary motive. Okay. Right. And when it comes to speculative motive, there is an inverse relationship between interest rate. That means as interest rate increases, demand for money decreases when it comes to speculative motive. But whereas in transactional motive and precautionary motive, as the income increases, demand for money and a transactional motive and speculative motive increases. That we need to keep in mind. Okay. So transactional motive, need for cash for current transactions for personal and business exchanges. Need for holding money is due to lack of synchronization between receipts and expenditure. See, we earn once in a month, but our expenditure is spread throughout the month. So there is no synchronization or equality between the number of times we are earning and number of times we are spending. Okay, that is the reason why we want to maintain cash in hand. So he came up with an equation that is LR equal to K of Y, where LR stands for demand for money, K stands for certain percentage, ratio or proportion, and Y stands for income. So whatever the equation that was given by Cambridge economists, the same equation was given, the same thing is given by Keynes, but he modified the equation. That's it. Precautionary motive. When it comes to precautionary motive, individuals, business keep a portion of their income to finance unpredictable incidences. No one knows what is going to happen in future, right? So keeping this thing in mind, keeping this uncertainty or unpredictability or contingency, we want to maintain certain amount as cash in hand. Depends on, see this, how much amount of money, basically we are talking about savings, how much amount of money we save, that depends on the size of income, economical, political considerations, personal characteristics of individuals, whether he's optimistic, pessimistic, or whether he has far-sightedness or not, all those things. Okay. Speculative demand for money. When it comes to speculative demand for money, people hold money balances to take advantage of future changes in interest rate and bond prices. So here, interest rate and bond prices, interest rates and bond prices are assets, right? So if there is any change in price of assets, if there is an investment opportunity available to the people to take advantage of the situation, people want to maintain certain amount of cash in hand. Okay, so like any other theory, here also we have certain assumptions. What are those? Expected return on money is zero. It is always zero. You will not get any sort of return on money. If you're keeping it as cash, you will not get any sort of return on it. Expected returns on bonds is interest and expected rate of capital gain. When it comes to bonds, you will get two kinds of returns. So one is the interest that you will earn. Another one is the capital gain or capital gain or nothing but profit on sale of bonds. Okay. So you will have two types of returns. One is in revenue nature, another one is capital in nature. Okay. Keynes focused only on the revenue part. That means he focused only on the interest on bonds, not on the capital gains. Okay. So holding of wealth holder in his assets portfolio. So when an individual will maintain cash, when he will maintain bonds, that will depend on the interest rate. Okay. So if the actual interest rate is more than the expected interest rate, if the actual current interest rate is nothing but actual interest rate, okay, and Rn is actual interest rate and Rc is expected interest rate. So if the actual interest rate is more than the expected interest rate, then he will hold in government bonds. If actual interest rate is less than the expected interest rate, he will hold in cash. But if actual interest rate is equal to expected interest rate, then he may hold either in cash or in bonds. Okay. See, when we will invest, when we are getting more than what we have expected, then definitely we will invest. That is what Keynes has said here. If actual interest rate or current interest rate is more than the expected, critical rate of interest means expected rate of interest. So you were expecting only 8%, but as of now you're getting 10%. So instead of holding it at cash, if you keep it in bonds, you will get 2% more than what you have expected, right? So whether you keep it in bonds or in cash, that depends whether the current rate of interest is more than the expected or less than the expected. Okay. Next, liquidity trap. What do you mean by liquidity trap here? See, liquidity means money. Trap means getting stuck with such a person. That means money is not being circulated in an economy. It is getting stuck with an agent or with a person. That is called as liquidity trap. So if the money does not circulate in an economy and is getting stuck with a particular individual or particular sector or particular what we say agent, then it will obviously adversely affect the production. So that is called as liquidity trap. It is a situation in which current interest rates are low and saving rates are high, rendering monetary policy ineffective. So when the interest rates are low, no one will be willing to invest. So whatever the policy the government may take or RBI may take, it will be ineffective. In liquidity trap, consumers choose to avoid bonds because interest rate on bonds is very, very low. So when the interest rates on bonds are very, very low, automatically the present value of bonds will be very, very high. And there is every possibility that if you buy bonds at high prices and if the price of the bonds falls, then we may suffer from losses. So in order to avoid the situation when the interest rates are very, very low on bonds, generally people would not be willing to invest in bonds. Okay, to avoid bonds and keep their funds in savings with an expectation of rise in interest rate in the near future. That is called as liquidity trap. This can also be explained in another way. It is a situation in which investor would maintain cash savings other than bonds. If the people are holding it as cash or in the form of savings, that means they are not investing. When there is no investment, there will be no production. The speculative demand becomes perfectly elastic with respect to interest rate, and the speculative money demand curve becomes parallel to x-axis. This is called as liquidity trap. So when the interest rate is very low or too low, then people will not be willing to invest. So whatever the curve, demand for money curve will be there, it will become parallel to x-axis. Okay, right. Next, concept 6. Inventory approach to transaction balance or year cash balance. So this was given by Burmel and Tobin. So this theory is based on carrying cost. This theory is based on carrying cost. So what Burmel and Tobin are saying, according to Burmel and Tobin came up with a theory called inventory theoretic approach. According to them, transaction demand for money, that is nothing but money or year cash balance, views as an inventory. So according to Burmel and Tobin, here inventory means nothing but money or year cash balance, okay, which is held for the purpose of transaction, Okay, so what does Burmel theory says? Basically, there are two store of values for money. One is temporary store of value and the one is permanent store of value. Okay, so money and the interest rates. So interest bearing financial assets. Money is nothing but temporary store of value, and interest bearing financial assets nothing but bond is permanent store of value. So when we are converting from money to bonds or bonds to money, generally what will happen is that we will incur carrying cost, which is also called as brokerage fee. So when the brokerage fee keeps on, so when the number of conversions from money to bonds increases, brokerage fee also increases. When the brokerage fee increases, it should be added to the value of bonds, right? So marginal cost of bonds also increases. When marginal cost of bonds increases, number of transactions. See, everyone wants to buy at lower prices, right? But when the marginal cost increases, price also increases, right? So number of transactions, that means number of conversions from cash to bonds decreases. So when number of conversions from cash to bond decreases, automatically bond holding decreases and demand for money increases. So every time we are converting from cash to bonds, we incur brokerage fee. Okay. So as the brokerage fee increases, additional cost of bonds also increases. That means simply bond price will keep on increasing. When the bond prices keep on increasing, generally people will not be willing to invest bonds because everyone wants to buy it at lower price and sell it at higher price, right? So when the bond prices increases, generally what will happen? The conversion from cash to bonds decreases. The average bond holdings, when the conversion from cash to bonds decreases, bond holding decreases, cash in hand increases. This was given by Baumol and Tobin. Okay. Next, Friedman. What did Friedman say? So Friedman came up with a theory which is an extended theory of liquidity preference theory. Friedman extended Keynes' speculative demand for money in terms of asset price theory because Keynes focused only on interest rate, right? He completely ignored the capital part of the asset now. So he only focused on the revenue aspect, not on the capital aspect. Okay, he only focused on interest rate, but not on capital gains or capital loss. So Friedman took that point into consideration and came up with a new theory. Determination of demand for money in the words of Friedman. Permanent income. It is a present expected value of all future incomes from wealth. This is what Keynes ignored. And relative returns on risk. According to Friedman, basically there are 5 types of assets. Okay, and each asset has its own return. So first one is money. Obviously, money has no return. Next one is bond, which has interest rate. Equity, which has dividend. Physical capital, which is nothing but cost of storage. And human capital, nothing but wages. The nominal demand for money is positively related to price level. According to Friedman, as the price level increases, demand for money also increases. We already know that. And demand for money is inversely related to interest rate. That means as interest rate increases, demand for money decreases. Why, sir? When the interest rate increases, people invest more in bonds. So bond holding increases, cash in hand, demand for money decreases. Okay. Last theory, which is given by Tobin. Okay, demand for money as behavior towards risk, that is given by Tobin. So demand for money as behavior towards risk, that is given by Tobin. So what did Tobin say? Risk avoiding behavior, he focused on risk avoiding behavior of individuals. Okay, which is principle of portfolio management. See, every investor wants to maintain balance between reward and risk. Okay, so keeping this thing in mind, Tobin came up with a theory. What Tobin said is that since every individual or every investor wants to maintain balance between risk and reward, he will neither keep entire income in the form of cash, or he will neither keep entire income in the form of bonds. We'll try to maintain a balance between cash and bonds. Okay, why? What is the reason for that? Determinants of demand for money, in the words of Tobin: uncertain about actual returns on bonds and future changes in price prices, while money is not. See, when it comes to money, money has certainty. It will not get any sort of returns. But when it comes to bonds, there is uncertainty. When it comes to money, there is certainty. We are certain that it does not have any return. But when it comes to bonds, there is uncertainty. What sort of uncertainty, sir? What sort of uncertainty? The uncertainty here is that you may get whatever the amount of interest you were expecting, or you may not get it. Okay, the price of bonds may keep on fluctuating. All these are uncertainties. Okay, so individual faces the risk if expected rate of return from bonds exceeds that of money. So when the interest rate on bonds is high and you are holding it as cash, then obviously you are losing interest rate, right? So in order to avoid this, what individual will do? He will try to maintain some part of his wealth in the form of bonds and some part of his wealth in the form of cash. The rational behavior of risk-averse person. Risk-averse means what? Reducing. So every person wants to reduce his risk, right? Holds optimum wealth portfolio of bond and money. So every individual who wants to reduce his risk, he will hold both cash as well as bonds. Okay, basically he's trying to maintain balance between return and risk. Sorry. Overall expected return is high if portfolio has all bonds, but risk-averse investor exercise a trade-off, a balance for a reduction in risk. Yes, if you hold completely in bond, and if the interest rate increases, then you will get more return. But at the same time, there is every possibility that interest rate may fall. So in such a situation, you may suffer from losses, right? So in order to avoid this kind of situation, what people will do, instead of investing in the entire money in the form of bonds, they will keep both combination of bonds as well as money. Demand for money and interest rate are inversely related. We all know that as interest rate increases, bond holding increases and demand for money decreases. So this is about theories of demand for money. Okay, let us see the next part of the chapter, that is money supply. So what do you mean by money supply, sir? The total quantity of money available to the people in an economy. The total quantity of money available to the people in an economy is called as money supply. Okay, so when it comes to money supply, public means what? Household, firms, institutions, local authorities, non-banking financial companies, non-departmental public sector enterprises, undertakings, foreign central banks, foreign governments, and IMF. All these come under the term public. Okay. Government in terms of money supply. When it comes to money supply chapter, what do you mean by government? We're talking about both central government, state government, and local bodies, municipal corporations, all those things. Okay. Next, banking system in terms of money supply. When it comes to money supply, what do you mean by banking system? We're talking about central bank and all the banks which accept deposits. They're nothing but CASA deposits. Okay, current account and savings account deposits. Components of money supply. When it comes to money supply, we need to focus on what? We need to focus on these two. There is monetary authority and banking system. Monetary authority means we're talking about central bank. And banking system means we're talking about the entire banking system as a whole, as a unit. Okay. Let us see one by one. Monetary authority. Central bank is a primary source of money as it is empowered to issue currency. Okay, the primary functions of RBI is to issue currency, right? So whatever the money we get, it is primarily from RBI. It's the primary source of money. Currency issued by central bank is a fiat money. That means it does not have an intrinsic value. As long as it is backed up by government, it is legalized by government, we can use it. And the moment the government withdraws its legality, it is of no use to us. Okay. So currency issued by central bank is a fiat money and its value is guaranteed by the government. That is what I said. Currency issued by the central bank is a liability for the central bank because you are claiming that much amount of purchasing power, right? So central bank has to fulfill it. So whatever the currency that is released by the central bank, it is liable to the central bank. Currency must be backed up by equal value of foreign exchange reserves. See, what that point means is that whatever the amount of currency the RBI is issuing, to that extent, it should maintain assets also, but which is very, very difficult to do. That's why all the central banks in the world are following the minimum reserve system. Under this system, what central bank will do, instead of maintaining equal amount of assets, whatever amount of cash they are releasing or currency they are releasing, they will maintain a minimum reserve that is sufficient. Okay. So according to minimum reserve system, central bank is empowered to issue currency to any extent. It can issue any amount of currency by keeping a certain minimum reserves of gold and foreign securities. As of now, India, that minimum reserve is 200 crores. 200 crores. Okay. Next, banking system. What do you mean banking system? Banks create money supply in the process of borrowing and lending transactions with the public. Okay, so banks, what they do? They accept deposits and lend money. Okay, in this process, they will be able to create money. This money is called as credit money. This money is called as credit money. How banks are able to create money? Because they use instruments, checks and other instruments. With the help of these instruments, they're able to create money. I mean to say, at any given point of time, the claims on banks will be more than the cash available with banks. The claims on banks will be more than the cash available with banks. So because of this reason, what will happen? Because of this, we can say that banks are able to create money. Okay. Cryptocurrencies face significant legislative uncertainties and are not legally recognized in India as currency. Hence, these are not characterized as money. As of now, cryptocurrency cannot be called as money. Okay. So we know what you mean by money supply, total quantity of money available with people in an economy. Now we need to measure it. In order to measure it, we have a different set of formulas. Okay. All those formulas are given in concept 10. So till 1967-68, we were using only one formula, that is M1, currency with public but demand deposits held by public. But from 1977 onwards, based on the recommendations of second working group on money supply, it's a committee formed to come out with formulas now. They gave four formulas, M1, M2, M3, M4. What do you mean by M1? Currency with people, demand deposits with banks and other deposits of the RBI. M2 means what? M1 plus savings deposit with post office savings bank. M3 means what? M1 plus. Okay, M3 means, it does not mean M2. It is M1 plus net times deposits with the banking system. And M4 means M3 plus total deposits with post office savings organization excluding national savings certificate. Okay, these are the formulas. In examination, all the data will be given to you. You need to just simply remember the formulas and solve the problem. That's it. Okay, so M1, M2, M3. You need to remember the M3 now. At M3 you should be very, very careful because generally what we do is that M3 means M2 plus. We write M2 plus a net time deposit, but it is M1 plus net time deposit. That means when it comes to M1 and M3, we only focus on banks. But when it comes to M2 and M4, we focus both on banks as well as post offices. Okay. So basically M1 is the most liquid and M1 has highest liquidity and M4 has least liquidity. Okay. Again, in 1998, third working group came up with a different set of formulas which are used to calculate money supply in an economy. Okay. So first formula is reserve money, which is called as M0 or M0. So reserve money we can calculate either from asset side of the balance sheet of RBI or from liability side of the balance sheet of RBI. See, this third working group came up with these formulas basing on the balance sheet of RBI. So in all these formulas, that is reserve money, NM1, NM2, NM3, we only have elements which are present in balance sheet of RBI. Okay. So we did not take into consideration post office or what we say non-banking finance companies, etc. We only focus on RBI. So reserve money means currency in circulation, bankers deposit with RBI, other deposits with RBI. Net RBI credit to the, so that is one formula, okay, which is from liability side of balance sheet. Now, from asset side also we can calculate reserve money. What is the formula? Net RBI credit to the government RBI credit to the commercial sector, RBI claim on banks, RBI net foreign assets, plus RBI currency liabilities to the public minus RBI net non-monetary liabilities. This is the formula for reserve money. NM1, what is the formula for NM1? Currency with public demand deposit banking system and other deposits with RBI. That means there is no difference between M1 and NM1. NM2, NM1 plus short-term time deposits of residents, that is up to 1 year. NM3 means NM2 plus long-term time deposits of residents plus call or term funding of from financial institutions. So this is the formulas. These are the formulas given by third working group. Okay. So next. So other names of monetary aggregates. M0 can also be called as reserve money, high-powered money, monetary based money stock. M1 and NM1 both mean one the same, narrow money, and M3 and NM3 means broad money. When it comes to broad money, we're talking about M3 and NM3, not M4. Okay, we are talking about M3 or NM3. Depending on the data, either we need to decide whether to calculate M3 or NM3. Depending on the data given in the problem, we have to decide whether they are asking us to calculate M3 or NM3. Both mean broad money. Okay. Next, liquidity aggregates include so instruments which are close substitutes of money but are issued by non-banking financial institutions. So slowly, non-banking financial institutions also started playing very important role in the economy. So keeping this thing in mind, the money created by non-banking financial institutions also added to the formula. So RBI came up with new set of formulas. There is nothing but extended version of formulas given by third working group. So L1 means what? NM3 plus all deposits of post office savings bank excluding national savings certificate. L2 means what? L1 plus term deposits with the term lending institutions and refinance institutions plus term borrowings by financial institutions, certificate of deposits issued by financial institutions. And L3 means what? L2 plus public deposits of non-banking financial companies. So these are the formulas. Do remember one thing, entire data will be given in the examination. You just need to remember the formulas and write down the values. Okay, you will get full marks for that one. So concept 11, components of narrow money. What do you mean by narrow money? Narrow money means talk about M1 here. So what is the formula for M1? Currency with public demand deposits of banks and other deposits of the RBI or with RBI. Okay. Let us see what you mean by currency, demand deposits and other deposits of RBI. Currency means paper currency as well as coin that is held with public. Okay. Next, demand deposits means what? We're talking about current account deposits and demand deposits portion of savings deposit, but nothing but CASA deposits. From public and interbank deposits, cheapest source of finance. It is the cheapest source of finance available to the banks, because when it comes to current account, no interest will be paid. And when it comes to savings account, a very low interest will be paid, right? So it is the cheapest source of finance available to the banks. See, here we consider net demand deposits of bank. That means if interbank deposits are given, then we have to subtract it from total demand deposits. Okay, then we will get a net demand deposits of banks. So we will focus on net demand deposits only. So if interbank deposits is given, we have to subtract it. We have to subtract it from total demand deposits. Okay. Next, other deposits of RBI constitute less than 1% of the total money supply. Very, very small portion. Okay. Demand deposits of quasi-government institutions and other financial institutions. Balances in the account of foreign central banks and foreign governments. And accounts of international agencies such as IMF and the World Bank. All these are considered under other deposits of RBI. Okay, so these are the components of narrow money. Next, conceptual money multiplier and its determinants. What do you mean by money multiplier and what are its determinants with respect to money supply? So what do you mean by money multiplier? It defines the ratio of change in money supply to the change in monetary base. That means whenever there is change in monetary base, sir, what do you mean by monetary base, sir? H. Whenever there is change in monetary base, there will be change in money supply, because whatever the currency that is released by RBI will not be the same. I mean to say the amount of currency released by RBI will not be the same. It will multiply in the economy. It will multiply in the economy. So this multiplication is called as money multiplier. How to calculate money multiplier? The formula is money supply divided by monetary base. Okay, that means change in H will bring about change in M. Okay, and generally this change in M will be greater than change in H, nothing but monetary base, high-powered one. And there is one more formula for money multiplier. Generally, the relationship between money multiplier and the reserve is inverse relationship, because see, money will get multiplied because of banking system only, because of banks only. Because what banks do, they accept deposit and keep on giving loans. Okay, so it is a reciprocal of reserve ratio. Money multiplier is nothing but reciprocal of reserve ratio. How to do it? Money multiplier is equal to 1 by reserve ratio. It means if the reserve requirement of banks increases, automatically lending capacity of banks decreases. When lending capacity of banks decreases, money multiplier decreases, money supply also decreases. So money multiplier is inversely related to reserve ratio. Okay, so when there are no excess reserves, then money multiplier is expressed in this form. There is 1 plus small c. Small c stands for currency to deposit ratio, and small r plus c. Small r stands for reserve to deposit ratio. Okay, so this is another formula for money multiplier. When there are no excess reserves, the formula is small m, money multiplied small m equal to 1 plus c by r plus c. And when there are excess reserves, then the same formula will be modified. It becomes 1 plus c by small r plus small e plus small c. Okay, where c stands for currency deposit ratio or cash deposit ratio, and R stands for reserve deposit ratio, nothing but reserves by deposits. Okay. So what are the determinants of money supply in terms of money multiplier? That means what are the determinants or what are the factors which affect money multiplier and money supply in an economy? Basically, there are three factors: behavior of central banks, behavior of commercial banks, and behavior of public. So these are the three determinants or factors which affect the money supply or money multiplier in an economy. Let us see these three factors. Okay, right. So first one, the stock of high-powered money. High-powered money can be called as reserve money or monetary bills, okay, or H. So other things remaining constant, total supply of nominal money will vary directly with the supply of H. That means what? As H increases, it will lead to increase in money supply. Other things remaining constant, if there is increase in H, that is high-powered money, if RBI keeps on releasing more and more money into the economy, automatically money supply in an economy will also increase. Okay. Next, the second behavior is intermittent. The ratio of reserves to deposits, the behavior of commercial banks. The reserve ratio on demand deposits and the money supply are inversely related. That's what I said. See how banking system works. We all know that. What banks do? This is a bank. Banks accept deposits, and out of these deposits certain amount is to be kept as reserves, and balance will be given as loans. Balance is lent out. So if reserves increases, automatically lending capacity of banks decreases. That means there is an inverse relationship between reserves and lending capacity of banks. When lending capacity of banks decreases, automatically money supply also decreases. So the reserve ratio on demand deposits and money supply are inversely related. Excess reserves of banks have no effect on deposits or currency and on money supply. What do you mean by the second part of this point? It means whatever the money that is released by RBI is held by banks as excess reserves. Then there will be no change in lending capacity of banks. When there is no change in lending capacity of banks, there will be no change in money supply and there will be no change in money multiplier. Okay, generally what RBI will do, whatever the money it wants to release into the economy, it will release through banks. Okay, now banks, what they can do, as soon as RBI gives money to them, instead of lending the entire money, it can keep it as excess reserves. So RBI has released 100 rupees to bank, but bank, instead of lending the same money to the public, it has kept it as excess reserves. So when banks are made in excess reserves, there will be no change in lending capacity. Whatever the amount of money it used to lend earlier, the same amount of money it will lend now also. So when there is no change in lending capacity, there will be no change in money supply and money multiplier. So that is a point that we need to remember here. That is the second determinant. And the third determinant is ratio of currency deposits. Okay, that how behavior of public will affect the money supply. See, banks are the only one who has the capacity of multiplying the money. Okay, so bank plays a very important role. If people keep more money in their pockets and less money in banks, then currency ratio increases. See, currency does not have, if you are keeping money in your pocket, it does not have any capacity of getting multiplied. But if you deposit the same money in the banks, it will multiply. It will multiply. But demand deposits undergo multiple expansions, while currency in hand does not. The money multiplier and money supply are negatively related to currency ratio. That means what? If cash in hand increases, automatically deposits decreases. When deposit decreases, lending capacity, funds with banks decreases. Lending capacity of banks decreases. When lending capacity of banks decreases, money supply decreases, so money multiplier also decreases. So you can clearly see there is an inverse relationship between currency and money supply and money multiplier. Okay. So increase so this is the point that we need to remember. And moreover, when it comes to deposits, we are talking about term deposits. If there is increase in term deposits, if there is increase in time deposits to demand deposits, this will lead to multiple deposit expansions and monetary expansion. Okay. So if there is increase in deposits, definitely there will be increase in money supply and money multiplier. Moreover, if there is increase in time deposits, okay, then it will lead to a greater increase in monetary expansion. Okay, so this is the behavior of public. So simply stating, money supply and money multiplier depends on the behavior of three, that is central bank, commercial bank, and public. Okay, so if central bank releases more amount of hedge, other things remaining constant, that means other factors not affecting the purchase hedge. So other factors are not affecting, then what will happen? As hedge increases, money supply and money multiplier also increases. Okay, then coming back to behavior of commercial banks. If commercial bank increases the reserves, if commercial banks are asked to maintain more amount of reserves, then automatic lending capacity of banks decreases. When lending capacity of banks decreases, money supply decreases, money multiplier also decreases. Coming back to the behavior of public, if people, instead of keeping deposits, if they maintain as cash, then deposits with banks decreases, lending capacity of banks, funds with banks decreases, lending capacity of bank decreases, money supply and money multiplier also decreases. Okay. Concept 13. Effect of monetary policy and government expenditure on money supply. So in what way monetary policy and government expenditure will have an impact on money supply? Okay, the effect of monetary policy and money supply. To stimulate economic activity, central bank of a country infuses liquidity, pumps money into the system through its monetary policy instruments. Example, open market operations. So when RBI feels that there is shortage of funds in an economy, what it will do? It will purchase whatever the securities has sold earlier. It will purchase whatever the securities it has sold earlier. Okay, from the public. In this process, what will happen? The securities will move from public to RBI, and money will move from RBI to public. So because of this purchase of securities from public, the RBI has released money into the economy. It has given money to the public. Okay. In this way, what will happen? The amount of money in the economy increases. That's what given in the example. Open market operations by central bank. Purchase of government securities inject monetary base or money into the system. Thus, both the reserves means here funds. Reserves here means funds, and money supply increases. Okay. So simply stating, RBI, when it feels that there is shortage of funds in the economy, it will buy back whatever the securities it has sold earlier. Because of this, the funds with people increases. When the funds with people increases, automatically money supply also increases. Okay, so here public means I'm talking about banks. Okay, it's because RBI does not interact with public directly, right? It will do everything with banks. So what are the assumptions that we take here? Banks do not hold excess reserves. So when RBI is purchasing securities from banks, it will give money to banks, right? So that money will be released as is into the economy. Okay, that means banks do not hold these as excess reserves. People do not hold more currency. Okay, there is demand for loans from business. When all these assumptions are taken, then we can say that whatever the monetary policy taken by RBI, it will have a positive impact on the economy. Trade creation pushes by the banking system in country will create money. Okay, so when banks lend money in this, see banks how they work, we all know that they accept deposits and lend money, right? In this process, banks create money. That money is called as credit money. Okay, so we already know this formula. Here reserves means nothing but H. Here reserves means we're talking about H. So we already seen money multiply is nothing but money supply by monetary base, right? The same thing can be written as H. So money supply is nothing but multiplier into H. So whenever there is a change in H, it will lead to change in money supply. And this change in money supply will be greater than change in H. By how many times? By M times. Okay, note. But the value of money multiplier becomes zero when the interest rates are too low. When interest rates are too low, people will not be willing to deposit, right? And banks prefer to hold newly injected reserves as excess reserves with no risk attached to it. When interest rates are too low, people will not be willing to deposit, and they will prefer to hold entire thing as cash. When people are preferring to hold entire thing as cash, entire wealth as cash, it will not lead to any sort of multiplier. Same in case of banks also. when interest rates are too low, what banks will do? They will not lend money. They will keep everything as reserves. In such a case, also it will not lead to any sort of multiplier. Now, effect of government expenditure on money supply. What sort of effect it will have? If the central and state government's cash balances are less than minimum requirement, they are eligible to avail ways and means advances or overdraft facility. When funds available with government are very, very low, they can use this facility. Okay. When RBI lends to government under ways and means advances or overdraft, it results in the generation of excess reserves. It is because when government incurs expenditure, it involves debiting government balances with RBI and creating the receiver's account with commercial bank. Example, salary account of government employee. Simply, the government will pass. See, simply entry will be passed. Okay. So, thus excess reserves will be created. Excess reserves thus created increase money supply through money multiplier process. So, whatever the excess reserves that are created, if these excess reserves are used to lend money to the economy, then it will lead to money multiplier. Okay. So, when government borrows money from RBI, okay, it will lead to excess reserves. Why, sir? Because when government incurs expenditure, it involves debiting government balances with RBI. Okay, and simply creating the receiver account with commercial bank. Okay, so when commercial banks, they will simply pass the money, they will simply pass an entry. They will simply pass an entry, okay, debiting the balances with RBI and creating the account with commercial bank. Okay, that means commercial banks will be receiving money. Commercial banks will be receiving money from RBI, right? So banks, what they can do instead of releasing this money as it is in the economy, they can keep it as excess reserves. And whatever the funds available with them, they can use these funds. They can use these funds. Effect of government expenditure on money supply ఏదైతే ఉందో టాపిక్ ఇది కట్ చేసేయండి. Okay. Now, effect of government expenditure on money supply. If the central and state government cash balances are less than minimum requirement, they are eligible to avail ways and means advances or overdraft facility. So when government takes overdraft facility from RBI, what will happen? Simply the balances of government of India with RBI decreases, and the receiver account with commercial banks will be credited. Okay. So basically, money is getting transferred from RBI to commercial bank, right? Now, commercial banks, what they can do, whatever the money that they're receiving from RBI, they will, instead of releasing this money into the economy as it is, they will keep it as excess reserves. Then what about the salaries, sir? Whatever the funds already available with banks, they will use those funds to credit the salary account. Okay. So whatever the fresh money that is received from RBI, it will be maintained as excess reserves. Okay, so government expenditure may lead excess reserves. Now, excess reserves thus created increases money supply. So when excess reserves are created, commercial banks can use these excess reserves to increase their lending capacity. So as and when required, commercial banks can use these excess reserves to increase their lending capacity. When lending capacity increases, money supply increases and money multiplier also increases. Okay, now what do you mean by excess reserves? What do you mean by excess reserves? We all know reserves over and above the required reserves are called as excess reserves. Reserves over and above the required reserves are called as excess reserves. In a banking system, excess reserves are bank reserves in excess of reserve requirements set by central bank. Okay, right. This is called as excess reserve. So the formula is clearly mentioned here. Excess reserves means total reserves minus required reserves. See, RBI is asking us to maintain 25% of reserves, but bank is maintaining 28% of reserves. The 3% is called as excess reserve. If the actual reserve ratio is greater than the required reserve ratio, commercial banks hold them in the form of cash reserves known as excess reserves. Okay, and they have no effect on deposit currency and hence no effect on money supply, because whenever RBI is releasing money, if banks are holding it as excess reserve, the lending capacity of banks will not change. When there is no change in lending capacity, there will be no change in money supply, no change in money multiplier. In a commercial bank, the larger portion of SLR in the form of cash reserves. Hence, the additional units of H go into excess reserves. See, banks want to maintain the excess reserves, right? So they will maintain in the form of SLR, because CRR is to be maintained with RBI. So the only other reserve that is available with bank is SLR, which will be maintained by bank with itself. It will be maintained in three forms: cash, gold, and government securities, right? So these excess reserves will be maintained in the form of cash under SLR. Okay, right. So effects of excess reserves. Cost of holding excess reserves is in terms of its opportunity cost. So excess reserves are negatively related to market interest rate. That means if the interest rate in the markets increases, instead of keeping as excess reserves, banks want to invest. So automatically excess reserves decreases with banks. Okay. So as the interest rate in banks increase, as the interest rate in the market increases, what banks will do? They will keep on investing. So when banks start investing, automatically the excess reserves available with banks, it decreases. Benefits of holding excess reserves in terms of expected deposit outflows. Okay, what are the benefits of holding excess reserves? Second, the point we need to remember here is that banking system depends on deposits. The entire banking system depends on deposits. And people, as and when required, they can withdraw their entire money. Okay, bank cannot ask people not to withdraw money. Okay, so when banks expect that there will be increase in deposit outflows or withdrawals, in order to make sure that their business is not getting affected because of these excess withdrawals or because of the deposit withdrawals, banks can use these excess reserves to again lend. So when there is increase in lending, automatically there will be increase in deposits. Okay, this is what banks did during demonetization. During demonetization, people were not willing to deposit in banks. During demonetization, people were not willing to, or most of the people were not willing to deposit in banks. So automatically banking transactions got affected. So what banks did, whatever the excess reserves they maintained, they started using these excess reserves to lend money. So when there is increase in lending, automatically there will be increase in deposits. Okay. Next, concept 15, credit multiplier or deposit multiplier, deposit expansion multiplier. We all know what is credit multiplier and deposit expansion multiplier, deposit multiplier. Okay. The amount of additional money created by commercial banks through the process of lending the available money it has in excess of the excess central bank's reserve requirements is called as credit money. Okay. The amount of additional money created by central bank through the process of lending the available money it has in excess of central bank reserve requirements. Banks received 100 rupees. Out of that, 25 rupees is to be kept as reserves. The balance 75 is lent out. So in the process of accepting deposit and lending a partial of that money or part of that money creates money in an economy. This is called as credit multiplier. The credit multiplier is reciprocal of required reserve ratio. If required reserve ratio of banks increases, automatically money multiplier, credit multiplier decreases. Okay. Though deposit multiplier and money multiplier are closely related, but they are not identical. What are the reasons for that? There are two reasons. Banks do not lend out all the deposited money. They need to maintain reserves at a level above the minimum required resource. Whatever the money banks receive, they will not lend the entire money, right? So deposits will not be equal to loans. Because out of deposits, banks have to maintain certain amount as reserves. That is first reason. Next, all borrowers do not spend every money they borrowed, as they convert some portion into cash. So I have taken 1 lakh as loan. I will not going to deposit. I am not going to deposit the entire 1 lakh into the bank, right? Out of that 1 lakh, I will keep some amount as cash, and remaining will be used for purchase of goods and services. That remaining part will go into deposits into the bank. Okay, so since the deposits are not equal to loans, the credit multiplier is not equal to deposit multiplier. Okay, so these are the two reasons for that. The list of formulas are given. You can go through those list of formulas. Okay, we have already gone through all these list of formula. Okay, so with this we have completed this chapter. The next chapter is international capital movements. So concept 1, what is concept 1 here? Foreign direct investment. What do you mean by foreign direct investment? Okay, so a process whereby residents of home country acquires ownership of asset in the host country, and such movement of capital involves ownership, control and management of assets in the host country. That means a US based company coming and investing in an Indian company. Okay, to the extent of investment, the amount of money that US based company has invested in Indian company, to that extent it needs three things: ownership, control and management. Okay, so that kind of investment is called as foreign direct investment. Now, FDI according to IMF and OECD. IMF, we all know, International Monetary Fund. OECD stands for Organization for Economic Cooperation and Development. Okay. According to these two organizations, FDI means the acquisition of at least 10% of ordinary shares or voting power in a public or private enterprise by non-resident investor makes it eligible to be FDI. So if a foreign company has acquired at least 10%, that means 10% or more than 10% of shares in an Indian company or voting power in an Indian company, then that such kind of investment will be called as foreign direct investment according to IMF and OECD. The same definition is followed by everyone throughout the world. Okay. Next, foreign direct investors. Who can be called as foreign direct investors? Individuals, incorporated or unincorporated, private or public enterprises, associate group of individuals or enterprises, governments or government agencies, estates, trust, and all other organizations. Whoever want to invest in India, we will welcome them with open arms. Okay, so anyone can come and invest in India. Okay, entry routes of for FDI in India. There are basically two entry routes. One is automatic route and the one is government route. Automatic route means there is no need to take any permission from Government of India or RBI. Already rules are in place. You just need to follow those rules and start doing the business. Okay. When it comes to government route, before doing any sort of investment activity, first you have to take permission or approval from the Government of India. These are the two routes. Okay. Next, components or instruments of FDI. What are the components and instruments available to carry out FDI? First one, equity capital. Second one, reinvested earnings. What do you mean by reinvested earnings? Whatever the profit we have earned from our earlier investment, again that amount, whatever the dividends we have earned from our earlier investment, again that amount is invested into the company. So automatically our shareholding will increase. If the shareholding is more than or at least equal to 10%, it is called as FDI. Intra-company loans, a parent foreign company, a foreign parent company giving loan to its Indian subsidiary, that is also FDI. Next, fully earned mandatory convertible preference shares and damages, partly paid equity shares and warrants. All these are the instruments available to carry out FDI. Okay, main forms or modes of FDI. What are the main forms or modes of FDI? First one is greenfield investment. What do you mean by greenfield investment? When a foreign company comes into India and start everything on its own without taking over an existing company, it will start doing everything on its own. That is called as greenfield investment. Okay. Next, brownfield investment. Brownfield investment. What do you mean by brownfield investment? A foreign company coming into India and acquiring already existing company. That is called as brownfield investment. Okay. Next, opening of overseas companies, including establishment of subsidiaries or branches. All these are the main forms or modes of FDI. Creation of joint ventures on contract basis. Okay. Joint development of natural resources. See, we have natural resources, but we don't have the technology to extract it and make it marketable. So what we will do, we will invite a foreign company or invite a company of another country to come and invest in our country and help us out in extracting. Okay, so whatever the output we get or profit, whatever the revenue we get, it will be shared in this ratio. That is called a joint development of natural resources. Okay, so we have oil, but unfortunately, if we don't have the technology to extract that oil, we may ask a foreign company to tie up to come and have it to come and extract that oil, and whatever the oil we get, that will be shared equally. Okay. Purchase or annexation. Annexation means takeover of companies in the country receiving foreign capital. Equity injection into an overseas company. Acquiring a controlling interest in the existing foreign company. Mergers and acquisition. All are these are main forms or modes of FDI. Okay. Next, categories of FDI. What are the different categories of FDI? Horizontal FDI, vertical FDI, conglomerate FDI, two-way FDI. What do you mean by horizontal FDI? If a foreign company is investing in the same kind of business in Indian company, it is called as horizontal FDI. Investor establishes same type of business operations. That means a foreign car manufacturing company investing in an Indian car manufacturer. That is called as horizontal FDI. Next, vertical FDI. A foreign car manufacturing company investing in an Indian tire manufacturing company. It's a vertical FDI. Okay. See, business is different, but the business that is being acquired is related to the business done by the foreign company. Okay, so investor requires a different types of business activity in foreign country from its main business activity, but supplements its major activity, but it helps it out in its production. So a car manufacturing company, a foreign car manufacturing company acquiring an Indian tire manufacturing company. So both businesses are different, but they are related to one another. That is called as a vertical FDI. Conglomerate FDI. A foreign car manufacturing company investing in an Indian FMCG company. A foreign car manufacturing company investing in an Indian FMCG, fast moving consumer goods, food items, okay, in that company. See, both businesses are completely different. Such kind of investment is called as conglomerate FDI. Investors make foreign investments in unrelated business when investment is made in unrelated business to its existing business of home country in the form of joint venture, as investors have no previous experience. See, a foreign car manufacturing company knows how to sell cars, but he may not know how to do the business when it comes to FMCG goods. So what he will do, he will invest the money in that company and try to who try to form a joint venture so that he can learn from the existing company. Okay, a two-way FDI, a foreign car manufacturing company investing in an Indian FMCG company and an Indian FMCG company investing in USA. See, two-way FDI means a foreign company investing in India, a US-based company investing in India, and Indian-based company investing in USA. That means investment happens in both the ways. Okay, it is called as two-way FDI. If FDIs are reciprocal investment between countries that occurs when some industries are more advanced in one nation. For example, the automobile the automobile industry is more advanced in Japan and the software industry is more advanced in USA. So software companies from USA will invest in Japan and automobile companies from Japan will invest in USA. Such kind of investment is called as two-way FDI. Okay, right. Next, determinants of FDI of a host country. So what are the factors of a host country? Host country means, see, what are the factors of India which affect the FDI? Okay. So when a foreign company wants to invest in India, what are the factors or what are the determinants he will look for? Okay. If these factors are available in the country, in India, then definitely a foreign investor will come and invest in our country. So basically, any foreign investor will, when they want to invest in one particular country, they will look for three things. What are those? First one is market, second one is resources or assets available, and third one is efficiency. Okay, so these are the 3 points any foreign investor will look for in a particular country before investing. Okay, let us see what do you mean by market seeking FDI. Okay, so the investor wants to know what is the market size and per capita income, market growth, access to regional and global markets, country specific consumer preference. That means whatever the goods that I am manufacturing, are these goods used in the country or not? Are these goods will be demanded in the country or not? Okay, structure of market, what kind of structure we have? Monopoly or monopolist or duopoly, what kind of structure we have? Okay, next, the second feature, that second factor that they look for is resources and assets available, whether the resources and assets are available in that country or not. Raw material, low cost unskilled labor, availability of skilled labor, technological, innovative, and other created assets, physical infrastructure. If these things are available, then definitely foreign investor will come and invest in the country. Next, the third one is efficiency seeking FDI. What do you mean by efficiency seeking FDI? Efficiency seeking means we're talking about cost of production, cost of physical and human resources and assets and other inputs. If these are low, then definitely he will come and invest. The foreign companies will come and invest in our country. Okay, this is concept 2. Concept 3, policy framework of FDI of a host country. So what sort of policy framework, what sort of the policies India should frame to attract foreign investors? Okay, economic, political, and social stability. Policy should bring economic, political, and social stability in the country. Rules of entry and operations, standard of treatment of foreign affiliates, how foreign companies are being treated in our country. Next, policies on functioning structure of markets, international agreements on FDI privatization. To what extent the government of India is allowing privatization, private companies into India, in which sectors it is allowing, trade policy coherence and consistency. Coherence means the consistency of FDI and trade policy. Is there any consistency between FDI and trade policies? Are they conflicting in nature or are they complementing to one another? And tax policies. So all these are the policies of government which affect FDI into a country. Okay, next, concept 4, FDI. In what way FDI favors business facilitation? It encourages investment. So first point is investment promotion. So if the if FDI in a country increases, if more and more investors are coming and investing in our country, automatically what will happen? It increases the image of the country. Okay, so it is called as, when the image of the country increases, more and more investors from other countries will also be willing to invest in our country. This is called as investment promotion. Next, it also leads to investment incentives. Okay, that means it will reduce the hassle cost, it will increase the social amenities, and it will increase the after investment services. It will increase the efficiency in providing after investment services. So in these ways, FDI favors business facilitation. FDI helps in business facilitation. So if FDI into India increases, then India will get all these benefits. Investment in the country increases, and it also leads to increase in investment incentives. That means what? Hassle cost decreases. That means administrative efficiency increases, corruption and other things decreases. Social amenities, bilingual schools, quality of life, standard of living, all these things increases. And after investment services also increases. Okay. So next concept is concept 7, recent changes in FDI. So what are the recent changes brought in FDI? Okay. Right. FDI regime was radically liberalized on 20th June 2016 under automatic route and easing of conditions of FDI in. So basically on 20th June 2016, what government of India did, it brought so many sectors under automatic route. Automatic route means what? No need to take any prior permission from the government. So what are those sectors? Defense sector, e-commerce, food product manufactured in India, pharmaceuticals, both greenfield as well as brownfield investment, airports, both greenfield and brownfield, air transport services, private security agencies, animal husbandry, establishment of branch offices, liaison office or project office, teleports, direct-to-home cable networks, mobile TV and head-end in sky broadcasting services, single brand retail trading, all these sectors have been bought under automatic route. Okay, so basically government started liberalizing more and more sectors whereby private sector can enter into those sectors, and when private sector enters, number of firms increases, productivity increases, and leads to economic growth. Okay, right. Next concept 8, FDI and economic development in India. FDI is a major source of non-debt finance resource for the economic development of India. See, for a country to develop, there should be increase in production. To increase production, we need investment. The two ways of bringing in investment is one by borrowing, and the other one is by encouraging FDI. So out of these two, encouraging FDI is the most easiest way of increasing investment, increasing production, leading to economic growth. Because if you borrow money, the debt burden of the country increases, right? So if you encourage foreign direct investors, debt burden of the country will not increase. In fact, it will lead to rapid economic development. FDI is a major source of non-debt financial resource. It is a major source of non-debt financial resource for the economic development of India. So United Nations Conference on Trade and Development (UNCTAD) World's Investment Report 2020, he gave a report in which India stood ninth when it comes to FDI received. So during 2020, India received around 74,390 million US dollars as FDI. According to RBI Bulletin, which was published on July 2020, during May 2020, India's FDI inflows are 2,535 US dollar, 2,535 million US dollars, and FDI outflows are $519 million. Hence, the net FDI stood at 2,016 million US dollars. It is in the month of 2020. In 2019-20, on a whole, India received maximum FDI inflows from Singapore, Mauritius, Netherlands, USA, and Japan. Service sector attracted the highest amount of FDI, followed by computer software and hardware. FDI outflows of India. So just like we are receiving investment into the country, in the same way, some companies are investing outside the country also. This is called as outward FDI. So overseas investments by Indian entrepreneurs in the form of joint ventures and wholly owned subsidiaries. Okay. Right. So changes in outward foreign direct investments. What are the changes brought to encourage outward foreign direct investment or to have a control over outward forward direct investment? Okay. So what are the changes brought in outward foreign direct investment? Listed Indian companies can invest up to 50% of their net worth as on date of last audited balance sheet. There is a change that is brought in. Next, outward FDIs change in terms of size, geographical spread, and sectoral composition. The total financial commitment on outward FDIs was $805 million on June 2020. Outward FDIs are primarily driven by resource seeking, just like inward FDI is based on resource seeking, market seeking, and efficiency seeking. In the same way, outward FDI also depends on resource seeking and market seeking and efficient, nothing but technological seeking motives. Many Indian IT firms like TCS, Infosys, Wipro, and Satyam, not Satyam, this is Tech Mahindra. Okay, this is Tech Mahindra. Acquired global contracts and established overseas offices in developed economies to be close with their key clients. Indian entrepreneurs are choosing investment destinations in Mauritius, Singapore, British Virgin Islands, and Netherlands as they provide higher tax benefits. Any Indian investor can make outward FDI in any bona fide activity except in bona fide means here genuine. So any Indian investor can invest in any sort of genuine activity except in certain real estate activities. Progressive relaxation of capital controls, and simplification of procedures for outward FDI from India. So what are the relaxations, progressive relaxations taken up by the government of India? Annual overseas investment ceiling to establish joint ventures and wholly owned subsidiaries has been raised from $75,000 to 1,25,000 US dollars. Okay. And RBI relaxed norms for outward FDI corporates by raising their borrowing limits also. FDI and repatriation in India. Repatriation means bringing back to home country. Okay. All foreign investors or foreign investments are repatriable. That means whatever the profits these companies, foreign companies have earned in India, they can take back these profits to their home country, uh, provided they have paid the taxes. Okay. Except where investment is made on not repatriable basis or sectoral conditions specifically mentions non-repatriation. See, unless and until non-repatriation condition mentioned, all the profits that are earned by foreign countries in India can take back these profits to their home country. Dividends or profits on foreign investments can be remitted outside India through an authorized dealer bank. Only NRIs are allowed to set up partnership or proprietorship in India on non-repatriable basis. Okay. Next, concept 9. State and explain briefly about foreign portfolio investment. So what do you mean by foreign portfolio investment? See, the key difference between foreign direct investment and foreign portfolio investment is, when it comes to foreign direct investment, it is related to creation of output, employment, and income generation activities. Whereas when it comes to foreign portfolio investment, it simply means investment in stock market and making sure that we are able to sell the shares at higher prices and earning profits. So FPI has nothing to do with increase in production. FPI has nothing to do with production activity. Okay, that's why when it comes to investment, governments give more importance to FDI over FPI. So what do you mean by FPI, foreign portfolio investment? It is a flow of financial capital rather than real capital and does not involve ownership control on the part of the investor. See, when it comes to foreign direct investment, whatever the amount of money a foreign company has invested in an Indian company, to the extent of investment, they need ownership, control, and management. Here, the foreign portfolio investor is not at all concerned about ownership, control, and management. He's only concerned about his financial capital, not the real capital. That means he's only concerned about the value of the shares. He's not at all concerned about the production activity of that particular firm. So characteristics and features of foreign portfolio investments, those are mentioned here. Okay. So what are the characteristics and features of foreign portfolio investment? Okay. Portfolio capital in general moves to investment in financial stocks, bonds, and other financial instruments is affected largely by individuals and institutions through mechanism of capital markets. So here simply foreign portfolio investment means it is investment in stock markets. Okay. It can be in different types of funds and different types of stocks. Investment is only in financial assets. It is short term in nature. Okay, relatively easy to withdraw. In the morning, they will come and invest. As soon as the share prices increases, they will sell off the shares and exit the market. Okay, it's completely speculative in nature, not accompanied by technology transfer. See, technology transfer, it comes under FDI, not under FPI. Okay, no, see, it does not have any kind of impact on employment or production, anything. Okay, right. And here, the investor is not at all concerned about the ownership and management of the company whose shares he is purchasing. Okay, so these are the features of FPI. Now, foreign portfolio investors. Who can be foreign portfolio investors? Foreign institutional investors, qualified foreign investors, and sub accounts and their sub accounts. Okay. Next, after the new SEBI guidelines, the RBI stipulated that foreign portfolio investors include. So, who can be, according to SEBI guidelines and RBI, who can become foreign portfolio investors? Asset management companies, banks, investment trust as nominated companies, incorporates, or institutional portfolio managers, or their power of attorney holders, university funds, endowments foundations, charitable trusts and charitable societies, sovereign means government, sovereign wealth funds, pension funds, mutual funds, all these can be called as foreign portfolio investors. Okay, so this is about foreign portfolio investment or investors. Okay, so last question is about difference between FDI and FPI. So if you're thorough with the FDI concept and FPI concept, you can easily write the differences. Okay, one is completely a affecting production, employment, income. Another is only concerned about increasing share prices. Okay, one is a long-term investment, and another is a short-term investment. Okay, uh, uh, one is speculative in nature, and the one is, see, FPI is speculative in nature, and FDI is not speculative in nature. FDI means there will be transfer of not only funds but also technology. But in comes to FPI, there will be only transfer of funds, basically investment of funds in stock market. Okay, FDI directly affects employment, labor, all the things. But when it comes to FPI, it only affects It does not affect any sort of employment or labor, but only concerned about fluctuations in share prices or stock prices. Okay, so this is about FDI and FPI. Okay, international capital movements. Next chapter is exchange rate and its economic effects. So what do you mean by exchange rate? What sort of effect it will have on the economy? Let us understand what do you mean by exchange rate. Exchange rate means what? Number of units of one currency for one unit of foreign currency, or is nothing but price of one currency expressed in terms of other currencies. Okay, that is called as exchange rate. Example, $1 equal to 82.67 rupees. That means price of dollar is expressed in terms of rupees. So number of units of rupees per one unit of dollar is nothing but exchange rate. What are the characteristics of exchange rate? Similar to any other commodity, foreign exchange has a price. In my example, dollar has a price in rupees. Value of currency is relative in terms of another currency. Here we are comparing the value of two currencies, right? That's why it's a relative concept. When we are comparing two currencies, the same thing can be expressed in fraction also. So the same equation can be expressed in fraction. That is 82.67 rupees per $1. So when you are writing in fraction form, you have one currency in numerator and another currency in denominator. The currency which is in denominator is called as base currency, and the currency which is in numerator is called as counter currency. Okay, so expression of exchange rate between two currencies. So how we express exchange rate? It can be expressed in two ways. One is direct quote and the one is indirect quote. What do you mean by direct quote? Direct quote can also be called as European currency quotation. Why? Because here, when it comes to direct quote, we will be defining the value of different currencies against dollar. Okay, that means nothing but one unit of foreign currency is exchangeable for number of units of domestic currency. So here foreign currency, then nothing but dollar becomes. So when we're talking from India point of view, for India, rupee will be domestic currency and dollar will be foreign currency, right? So if you're expressing the value of rupees for one foreign currency, for $1, that is called as direct quote. Simply stating number of units of domestic currency for one unit of foreign currency is called as a direct quote. When it comes to direct quote, the foreign currency will be base currency and the domestic currency will be counter currency. When it comes to indirect quote, which is also called as American currency quotation, it is used by America. Now, when it comes to indirect quote, what does it mean? Number of units of foreign currency for one unit of domestic currency. Number of units of foreign currency for one unit of domestic currency. That means the fraction will become reverse. Okay, 1/. Cut chesayandi. Okay, so indirect quote means nothing but one unit of domestic currency is exchangeable for number of units of foreign currency. Direct quote means number of units of domestic currency, number of rupees for $1. That is direct quote. Now, indirect quote means a number of dollars for 1 rupee. That is called as indirect quote. Okay. So when it comes to direct quote, when it is written in fraction form, foreign currency will be base currency and domestic currency will be counter currency. When it comes to indirect quote, it is written in fraction form. Foreign currency will be counter currency and domestic currency will be base currency. Okay. So what is the relationship between direct quote and indirect quote? No, there is an inverse relationship between direct and indirect quote. If direct quote is given, we can easily convert into indirect quote. If indirect quote is given, we can easily convert to direct quote. How, sir? Since there is a reciprocal relationship between the two, we can easily convert it. Okay. Kinds of exchange rate. Basically, how many types of exchange rate we have? We have two types of exchange rate. First one is nominal exchange rate. Next one is real exchange rate. And the third, nominal effective exchange rate and real effective exchange rate. Kinds of exchange rate nunchi cut cheseyandi. Okay. Now, kinds of exchange rate. Basically, we have different types of exchange rate. Let us see one by one. Nominal exchange rate. What do you mean by nominal exchange rate? It describes how much of one currency can be traded for a unit of another currency. So, if you are explaining conversion in terms of currency, it is called as nominal exchange rate. Okay. It is used to find the domestic price of a foreign good. The purpose of nominal exchange rate is to convert the value of domestic goods into domestic price. Okay. On the demand side, people desire foreign currency. So when people will desire foreign currency and when we are in supply of foreign currency, see, when there is inflow of funds, when there is inflow of goods and money outflow, then we demand foreign currency. In simple terms, if we need to make payment to others, we demand foreign currency. Okay, so when we need to make payment to others, when we are importing goods and services, okay, when we need to make payment to others, to other countries, then we demand foreign currency. Okay, so that is what is given here. Import of goods and services, outflow of domestic currency to abroad in terms of unilateral transfers, FDI, FPI, investment income payment from abroad, opening of foreign bank account. In all these cases, we demand foreign currency because we need foreign currency. Okay, if there is outward FDI, Indian companies want foreign currency to invest in other countries. If there is outward FPI, the investors want foreign currency to invest in stock markets. Okay, so if we need to make any sort of payment to abroad, we need foreign currency. So when we need to make payments, we demand foreign currency. And when we will be in supply of foreign currency, when we receive money from abroad. So when we are exporting goods and services, we will receive money from abroad. In such a case, we will receive foreign currency. Later on, we will convert this foreign currency into rupees. Inflow of foreign currency from abroad in terms of unilateral transfers, we may be getting grants, donation from abroad, or we may be getting FDI and FPI from abroad. Investment income receipts. Our people might have invested in foreign countries. Against that investment, they may be getting some sort of dividends and interest, etc. So when foreign companies are paying dividends and interest to us, to people in India, they will be making payment in dollars, okay, foreign currency. So when we need to make payment, we demand foreign currency. And when we are receiving foreign currency, we are in supply of foreign currency. Interaction between demand and supply will determine the value of rupee and dollar. Okay. Determination of nominal exchange rate. Demand curve and supply curve of dollars intersect. The point where these intersect, that is called as equilibrium point. And that point, whatever the exchange rate we get, that is called as equilibrium exchange rate. And whatever the quantity we get, that is called as equilibrium quantity of dollars exchanged. Okay, so this is nominal exchange rate. Nominal exchange rate means we are concerned about number of units of one currency for 1 unit of foreign currency. Okay, so basically we are talking in terms of money or rupees here. Now coming back to real exchange rate, what do you mean by real exchange rate, sir? How many of a good or service in one country can be traded for one of the same good or service in foreign country? Okay, so here how many of a good or service in one country? So here we are talking in terms of goods and services can be traded for one or the same good or service in the other country. Okay, so this is called as real exchange rate. If the price change is either in both the countries, then we will use this formula. Real exchange rate is equal to nominal exchange rate domestic price index divided by foreign price index. Okay, so here we will be using indirect quote. If you are using direct quote, then formula will be different. Nominal exchange rate equal to foreign price index into foreign price index divided by domestic price index. Okay. So here we are using indirect quote. That's why we are written formula in this way. But if you are using direct quote, the formula will be nominal exchange rate into foreign price index divided by domestic price index. Okay, right. Nominal effective exchange rate. Every country has many nominal exchange rates as its currency used to purchase many foreign currencies. Okay, we deal with different countries, so we will have numerous or several nominal exchange rates. Nominal effective exchange rate measure the value of domestic currency against a weighted average of various foreign currencies. So by taking all the nominal exchange rate, if you are calculating weighted average and defining the value of rupee against all these currencies, that is called as nominal effective exchange rate. Next, what do you mean by real effective exchange rate? Nominal effective exchange rate divided by price deflator or index of cost. That is a formula for that. Okay. So real effective exchange rate means nominal effective exchange rate divided by price deflator or index of cost. So both these things will be given in the form, given in the problem. You simply need to write on the formula and substitute the values. So nominal exchange, real effective exchange rate is nothing but nominal effective exchange rate divided by price deflator or index of cost. Now, what do you mean by cross rate? When two pairs of exchange rates are given with a common currency, defining the exchange rate between other two currencies apart from common currency is called as cross rate. For example, we have two pairs of exchange rate, that is X, Y and YZ. In these two pairs of exchange rates, Y is the common currency, right? So apart from common currency, if you are trying to explain the relationship between or exchange rate between X and Z, it is called as cross rate. Okay, right. Next concept 2. Exchange rate regime. What do you mean by exchange rate regime, sir? Regime means system here. So system of a country managing its currency in terms of foreign currency. It is called as exchange rate regime. System of managing domestic currency against foreign currency is called as exchange rate regime. Two major types of exchange rate regimes at the extreme ends are. So there are several systems, but at the extreme ends we have two major systems. One is floating and the one is fixed. Floating exchange rate regime can also be called as flexible exchange rate. Here, floating means that the exchange rate is determined by market. There is nothing but demand for foreign currency and supply of foreign currency will determine the value of foreign currency, which in turn will determine the value of domestic currency. So everything is determined by market. Okay. So equilibrium value of exchange rate of the country's currency is market determined. It is determined by market. So there is no predetermined target and no interference of government or central bank of the country in fixing the exchange rate. See, when it comes to floating exchange rate, everything is determined by market. So depending on the situations in the market, the value of rupee may increase or value of rupee may decrease. So here the government or RBI will not interfere in the market to fix the exchange rate, but they will interfere. But these government and RBI will interfere when there is instability, when there is continuous rise or continuous fall. Then they will interfere to stabilize the foreign exchange market. Intervention by central bank in forex, that is foreign exchange, is only to prevent undue fluctuations. It is also called as soft peg. Generally, when it comes to floating exchange rate regime, the government or the central bank of that country will not interfere. Okay, because everything is determined by market. But when there is instability in the market, then government and central bank of that country will interfere to maintain stability. As of now, recently, rupee value continuously falling, right? So RBI has intervened several times to maintain stability, not to fix the exchange rate. RBI interfered so many times to make sure that rupee value is not falling any further. Okay, so the RBI, the central bank of a country and government will interfere, but the here intention is to maintain stability, not to fix the exchange rate. Okay. Conclusion in terms of its advantages and disadvantages. What are the advantages of floating exchange rate and what are the disadvantages of floating exchange rate? Greater flexibility but less stability. Okay, there is a flexibility because it keeps on changing based on the market conditions. If it keeps on changing means there is no stability. A central bank pursues its own monetary policy and no need to maintain high forex exchange reserves. This advantage is in terms of fixed exchange rate. See, this is disadvantage when it comes to fixed exchange rate. But here, since everything is determined by market and there is no need for central bank of a country to keep on intervening regularly, there is no need for it to maintain huge amount of reserves to buy and sell foreign exchange. Okay, right. Second system is fixed exchange rate or pegged exchange rate. Country's central bank or government announces or decrees what is currency will be worth in terms of either another currency or basket of currencies or gold. So basically, when it comes to fixed exchange rate or pegged exchange rate regime, the central bank of a country or government or both together will decide what will be the value of rupee or what will be the value of domestic currency against a particular currency or a bunch of currencies or against any other commodity. So this exchange rate will be quite different from that of the market exchange rate. So after government announces fixed exchange rate, and if exchange rate of its currency is different from market, it is said to be established a peg for its currency. Generally, the exchange rate is determined by market, but if government wants to fix some other rate, which is different from market rate, okay, that is called as fixed exchange rate regime. So in order to sustain this fixed exchange rate regime, the central bank buys and sells foreign reserves. This is called as hard peg. Okay. So when central bank says that the value of rupee should be 70 rupees, it has to make sure that it is 70 rupees. So either it has to reduce the value of rupee or it has to increase the value of rupee. For example, as of now, $1 is equal to 82 rupees, right? Now, central bank and RBI adopted fixed exchange rate regime. So they wanted to make it as $1 equal to 75 rupees. That means they want to increase the value of rupee. In order to increase the value of rupee, they have to decrease the value of dollar. So what they will do, whatever the dollar reserves country has, it will dump those reserves in the market. Automatically, supply of dollars in the market increases. When supply of dollars increases, value of dollar decreases and value of rupee increases. And if RBI wants to reduce the value of rupee further, it has to increase the value of dollars. In order to increase the value of dollars, what it will do, it will start buying dollars from the market. So that means if a country is following fixed exchange rate, the central bank of that country has to keep on buying and selling foreign currency. For that, it has to maintain huge amount of reserves. It's a disadvantage when it comes to fixed exchange rate regime. It's an advantage when it comes to floating exchange rate regime because the central bank of that country, there is no need for it to maintain huge amount of reserves. Okay, next. Conclusion in terms of advantages and disadvantages. Fixed rate brings in more currency encourages foreign investment, maintains stability and credibility. See, fixed exchange rate means there will be stability, right? When there is stability, there will be credibility, and it encourages investors to come and invest in the country. It imposes discipline on countries' monetary authority and controls them. Okay, and controls inflation. When there is stability, we can overcome almost all kinds of problems. But here, the major disadvantage is that the central bank of the country has to maintain huge amount of reserves to keep on buying and selling on regular basis. Okay. Note, in real world, there is a spectrum. Spectrum is different types of intermediate exchange rate regimes, which are either inflexible or varying degrees of flexibility that lie in between fixed and flexible. Okay. So in real world, almost all the countries use combination of both fixed as well as flexible. Okay. Right. This is concept 2. So foreign exchange market. In this question, we will talk about the features of foreign exchange market and other things. Okay. So foreign exchange market, what does it mean? It is a wide-reaching collection of markets and institutions that handles exchange of foreign currency. So wherever the currency is exchanged from one form to another form, that is from one currency to another currency, all those places are together called as foreign exchange market. What are the features of foreign exchange market? It operates worldwide, and it is the largest market in the world in terms of cash value added. So in terms of currency handled, it is the world's largest market. Okay. It is over-the-counter market, that is electronically linked network of big banks, dealers, and foreign exchange brokers who bring buyers and sellers together. No central trading location is there. Okay, so no central trading location is there, and no set hours of trading. Very narrow spread. The spread means here margins. The spread means we're talking about margin. So very narrow margin between the buying rate and the selling rate. As large volumes are traded, traders may earn huge amount of profits or may suffer from huge amount of losses. Okay. Next, role of major participants in exchange markets. Who are the participants in exchange markets? See, any kind of market there will be participants. For example, when it comes to SEBI market, there are different participants: buyers, sellers, financial intermediaries, and SEBI. In the same way, when it comes to foreign exchange market, we have different participants. First one is central bank. Central bank. See, central bank is there. The first participant is central bank. What do you mean by central? What sort of role central bank will play here? So, central bank is not a profit-making organization. Okay, so it is there to avoid sudden or large appreciation or depreciation of domestic currency. It is there to maintain stability, but not to carry out any sort of transactions. Okay, right. Commercial banks. Commercial banks either participate on their own or on behalf of clients. They are there to exchange from one currency to another currency. Just like central bank, government also regulates the foreign exchange market indirectly. Multinational corporations engage in international trade and investment. NBFIs, non-banking financial institutions, just like commercial banks, they also take part in foreign exchange market, either in buying or selling foreign currency. Arbitrage. What do you mean by arbitrage? Simply stating buying and selling of same currency in two different markets at two different prices to earn profits. That is called as arbitrage. It refers to the practice of making riskless profits by intelligently exploiting prices differences of an asset at different dealing locations. Okay. So if in one particular market the price of dollar is low and in another particular market the price of dollar is high, we will purchase in low price of market and sell it in high price of market. Doing so, what will happen? We will earn profits. Okay, that is called as arbitrage. Now, what is the impact of arbitrage? When price difference occurs in different markets, participants buy foreign exchange in low priced market for resale in the high priced market and make profits in this process. That is what I have explained just now. Thus, profit rise in low price. See, when we are buying in low price market and selling in high price market, basically we are creating demand in low price market. Because of increase in demand in low price market, prices in low price market starts increasing. And we keep on selling currency in high price market, there will be increase in supply. When there is increase in supply, prices in high price market start falling. So arbitrage will take place till the prices in both the markets become equal or they differ only by transaction cost of operation. Okay, so because of price mechanism, prices in low price market start increasing and prices in high price market starts decreasing. Any profit spread on currency is quickly arbitrageable. Generally, there will be difference in currency value from one market to another market, but because of arbitrage, this is quickly wiped away. Okay. Next, we have individuals who participate in foreign exchange market and also foreign exchange dealers. Okay. Now, rates in exchange market. Currency in an exchange market has two rates. One is buying rate and the selling rate. Generally, if you go to the banks, you will find two different rates at which bank is buying. One rate is at which bank is buying and the rate at which bank is selling. How to determine which one is buying rate and which one is selling rate? Generally, we buy at lower prices and sell it at higher prices. So lower price will be a buying rate and higher price will be selling rate. Okay, right. Next, two types of transactions in the foreign exchange market. Two types of transactions in the foreign exchange market. One is spot or currency current transaction, and the one is forward transaction. What do you mean by spot transaction? Carried out in spot market. Carried out in spot market. An exchange involves immediate delivery. That means the transaction is settled immediately or a maximum of 2 days. Okay. Exchanges prevailing for the spot market are called as spot exchanges. What about the rate at which the transaction is completed? That is called as spot trading rate. Okay. Now coming back to forward transactions. What do you mean by forward transactions? Contract to buy or sell currencies for future delivery occurs in forward or future markets. So basically, we are entering into contract stating that on some future date, I'm going to buy so and so securities or I'm going to sell so and so foreign currencies. Okay, so basically, I'm entering into contract with the person stating that on 30th December, I will be selling so dollars or I will be buying so many dollars at this rate. So whatever the rate that is mentioned in the forward transaction is called as forward rate. Okay, now I will compare this forward rate with the spot rate on the date of transaction. On the date of transaction, if the rate mentioned in the contract or forward rate is more than the spot rate on the date of the transaction, then we will say it is forward premium. That means I have purchased it at premium or have sold it at premium. Okay, but if the forward exchange rate is less than the spot rate on the date of transaction, that is nothing but discount. Okay, so how to calculate forward premium or spot discount? The formula is given there, you can calculate it. Okay, right. Next, changes in exchange rate under floating exchange rate regime. So what are the changes in exchange rate under floating exchange rate regime? Okay, right. Currency in exchange, changes in exchange rate. Currency appreciation, when its value increases with respect to the value of other currency or the basket of currency. When the value of rupee increases compared to the value of other currencies in respect of other currencies, then we will say that the rupee has appreciated. Okay, so we have to remember one thing, that in exchange rate we basically talk about two currencies, right? So if the value of one currency increases, automatically value of another currency decreases. So if the value of rupee increases, value of dollar decreases. Okay, right. Next, currency depreciation happens when the value of rupee falls compared to the value of other currency. Okay, that is called as currency depreciation. So we have to remember one thing, that when one currency depreciates, other currency appreciates and vice versa. Okay, so home currency depreciation or foreign currency appreciation under floating exchange rate regime. The same thing is explained graphically here. See, here we're talking about home currency depreciation. From India point of view, home currency means rupee, right? Rupee depreciation. If rupee is getting depreciated, that means dollar is getting appreciated. When the value of dollar increases, when the demand for dollar is more than supply of dollar, automatically value of dollar increases and value of rupee decreases. And value of rupee decreases. You can clearly see here the demand curve of dollar has shifted from D to D1. There is upward shift. That means there is increase in demand. When there is increase in demand, value of dollars increases and value of rupee decreases. So this is an example for home currency depreciation or foreign currency appreciation. The same thing is given in the material also. It takes place when there is increase in home currency price of the foreign currency and home currency becomes relatively less valuable. Example, earlier I used to pay $1 equal to 79 rupees. Now I am paying $1 equal to 82 rupees. I am paying more means the value of rupee has depreciated. Okay. Next, effect of home currency depreciation. In what way it will affect? In what way home currency rupee depreciation will affect the economy? See, it will have these following impacts: cheaper exports and costlier imports. So when rupee value depreciates, exports become cheaper and imports become costlier. Because of this, what will happen? Exports increases, imports decreases. So net exports become positive and hence have a positive impact on the economic activity. Because of this, output increases. When exports increases and imports are decreasing, demand for domestic made goods increases. Output increases, real income increases, employment increases, inflation also increases, factors of production, terms of trade, all these things will have a positive impact. Public debt, international investments, all these will have all these factors will be affected. Okay, right. Next, home currency appreciation or foreign currency depreciation under floating exchange rate regime. It is quite opposite to home currency depreciation. Home currency appreciation, what means what? Value of rupee is increasing. When it will happen? When supply of dollars is greater than demand for dollars, value of dollars decreases and value of rupee increases. That means earlier I was buying $1 equal to 82 rupees. So now I will be buying it $1 equal to 80 rupees. That means I am paying less. Earlier I used to pay 82 rupees to buy $1. Now I am paying only 80 rupees to buy $1. That means when I am paying less, that means the value of rupee has appreciated. The value of rupee dollar has depreciated. Okay. So home currency appreciation, when it will happen? It takes place when there is a decrease in home currency price of foreign currency, and home currency becomes relatively more valuable. Okay, effects of home currency appreciation. You can see from the graph that supply of dollars has increased, right? It has shifted from S2, S1. Okay, so what sort of impact home currency appreciation will have on the economic variables? Imports will become cheaper and exports will become costlier. Because of that, net exports become negative. When net exports become negative, production decreases, employment decreases. It will have a negative impact on the economy. On the other hand, as imports become cheaper, domestic companies can import advanced technology, advanced machinery from abroad, and whereby they can reduce their cost of production. Okay, so this is the impact of home currency appreciation on the economy. Next, changes in exchange rate under fixed exchange rate regime versus floating exchange rate regime. That means what are the terms? What are when there is change in floating exchange rate, what are the terms we use? And when there is change in fixed exchange rate, what are the terms we use? Devaluation versus depreciation. What do you mean by devaluation? What do you mean by depreciation? When government reduces the value of rupee, it is called as devaluation of rupee. And because of market conditions, if the value of rupee decreases, it is called as depreciation of rupee. Okay. And next, what do you mean by revaluation appreciation? When the government increases the value of rupee, okay, that is called as revaluation. And when the market, and because of market transactions, if the value of rupee increases, it is called as appreciation. So simply stating, when it comes to fixed exchange rate regime, we use the term devaluation, revaluation. When it comes to floating exchange rate regime, we use the terms depreciation and appreciation. The same thing is given here also. Let us see. So devaluation, it is a deliberate government deliberately reducing the value of rupee. It's a deliberate downward adjustment by the monetary authority in the value of the current country's currency related to other currency group of currency or standard. The government deliberately reducing the value of rupee is called as devaluation. What do you mean by depreciation? It is a decrease in the currency value due to market forces. It's called as depreciation. Same in case of devaluation and appreciation. Deliberate increase or upward adjustment in the value of rupee is called as revaluation. Increase in currency value due to market forces is called as appreciation. So list of formulas are given here. We have already seen these formulas to a certain extent. Okay. So the next chapter is trade policy and trade negotiation. Okay. Let us see each concept one by one. First one, trade policy and its instruments. So what do you mean by trade policy? It includes all the instruments. It includes all instruments that government use to promote or restrict exports and imports. So in order to encourage exports and imports, or in order to discourage exports and imports, whatever the instruments that are used by the government are called as trade policy. Okay, so basically trade policy has all the instruments that are available to the government, which it can use from time to time, either to encourage or discourage exports and imports. Okay, and basically these policies form as base for trade negotiations. If the policies of both the countries are one and the same, there is no need to negotiate. But since the policies of the countries differ from country to country, they need to carry out negotiations and come to a common understanding. So when it comes to trade instruments, let us see what are the different kinds of instruments. These instruments can be divided into two types. One is price-related measures, nothing but tariff measures, and the one is non-price measures, nothing but non-tariff measures. So tariff measures and non-tariff measures. Again, when it comes to tariff measures, it divided into import tariffs and export tariffs. So all these are the list of import tariffs. Okay, when it comes to non-tariff measures, it can be divided into technical measures and non-technical measures. When it comes to technical measures, we talk about sanitary and phytosanitary (SPS), and when it comes to TBT, we talk about technical barriers to trade. Okay, so under technical measures, we have sanitary and phytosanitary and technical barriers to trade. When it comes to non-technical measures, we have non-technical measures. The list of non-technical measures are given here. Okay, let us see each thing one by one. Okay, right. So forms of import tariff. Okay, so first one is specific tariff. What do you mean by specific tariff? It is a fixed amount of money per physical unit. A fixed amount of money is imposed as a tariff. A fixed amount of money per unit is imposed as a tariff. Okay. So when it comes to specific tariff, we are not at all concerned about the value of the good. We are only concerned about the units, because your tariff is mentioned per unit, not for value. Okay. Example is given: a specific tariff of 1,000 rupees may be charged for each imported bicycle. Now the price of imported bicycle may be 10,000, 50,000, 1 lakh or 5 lakh. but you have to pay 1,000 per bicycle. Okay, per bicycle. But there is specific tariff. Next, what are the disadvantages of specific tariff? When it comes to specific tariff, the protective value varies inversely. What do you mean by protective value? Here, protective value means a tax in terms of percentage, or tariff in percentage varies with the price of the import. Sir, we did not understand the concept. Let me explain it. Let me take the same example. Okay, see, tax or tariff, import tax on bicycle is 1,000 rupees, right? Import tax on bicycle is 1,000 rupees. Let us assume that the value of bicycle is 10,000. If the value of bicycle is 10,000, this will be equal to 10%, right? Tax in terms of percentage will be equal to 10%. But if the value of bicycle is 20,000, then it will be equal to 5%. That means simply stating specific tariff will be in terms of percentage will be inversely related to the value of the good. If the value of the good keeps on increasing, then specific tariff in terms of percentage decreases. So there is an inverse relationship between the two. Next, ad valorem tariff. Here, the tariff is imposed on the value of the good, not on the units. Okay, example is given: a 20% ad valorem tariff on an imported bicycle of price 5,000. That means on 5,000 we have to pay 20%. Now this 20% will be fixed irrespective of the value, whether it's 5,000, 10,000, 5 lakhs, 20 lakhs, whatever it may be, you have to pay 20%. So simply stating, when it comes to ad valorem tariff, protective value of tariff is constant. Preserves means it is constant. Whereas when it comes to specific tariff, it keeps on changing. Okay, there is a difference between the two. Next, mixed tariff. Mixed tariff means what? It's a combination of both. Sorry, mixed tariff means here we will use both the specific tariff and ad valorem tariff, but we will apply only the tariff whichever is higher. The example is given there. Duty on cotton maybe 5% ad valorem or 30,000 per ton, whichever is higher. Okay, so we will calculate both the things, both the specific tariff and ad valorem tariff, and whichever is higher, we will apply that. Okay. Next, compound tariff. What do you mean by compound tariff? We will apply both ad valorem as well as specific tariff. Okay, first we will apply ad valorem tariff, then we will apply specific tariff. Example is given there. Duty on cheese is 5% ad valorem plus 10 plus 100 rupees per kg. So here we will use both specific tariff as well as ad valorem tariff when it comes to compound tariff. Okay. Next, technical and other tariff. What do you mean by technical and tariff? Here the tariff rate, tax rate changes with the technical specifications of the good. Okay, for example, I have bought a solar system from abroad. Now when I imported solar system from abroad, one rate of tariff will be applied on solar panels, another rate of tariff on the battery, and one set of tariff on the stand and other miscellaneous items. So here tariff rate changes with the technical specification. That is called as technical or other tariff. Okay. Next, tariff rate quota. What do you mean by tariff rate quota? Quota means limit here. Quota means limit. So what do you mean by tariff rate quota? Up to a limit, no tariff or very minimum tariff. But if you import beyond that limit, on that excess quantity, you have to pay very high rate of tariff. It is called as tariff rate quota. Up to a limit. For example, government has imposed a limit of 10,000 kgs. Up to 10,000 kgs, zero tariff or very minimum tariff, 1% or 2%. Okay. Most of the time it will be zero tariff. But if the company has imported 10,500 kgs, on that 500 kgs, company has to pay high rate of tariff. That is called as tariff rate quota. Okay. Next, most favored nation. So what do you mean by most favored nation? See, most favored nation, applied tariff, preferential tariff, bound tariff, all can be explained with a simple example. Okay. Basically, not explain these tariffs: most favored nation tariff, applied tariff, preferential tariff, and bound tariff. Okay, these tariffs are based on WTO. Okay, whether countries are WTO members or non-WTO members. When it comes to most favored nation tariff, generally, if you are imposing, a WTO member will impose a lower tariff on co-WTO members and higher tariff on non-WTO members. For example, on non-WTO members, a WTO member will be imposing 40% tariff, and on other WTO members, it will be imposing or promise to impose 30% tariff. This discrimination between non-WTO and WTO, it means basically being a WTO member, I am favoring other WTO members by imposing or promising to impose lesser tariff. That is called as most favored nation tariff. Okay, so import tariff on other members of WTO in a multilateral trade agreement without any discrimination. Okay, that is called as most favored nation tariff. Now, when it comes to bound tariff, let us go to bound tariff. So whatever the amount of tariff that I am promising to impose on other WTO members, that is called as bound tariff. So when it comes to most favored nation, I am favoring WTO members over non-WTO members. That is the distinguish. That is the meaning of that tariff. Okay. Now coming back to bound tariff, what do you mean by bound tariff? Bound tariff means the amount of tariff that I have promised to impose on other WTO members. For example, on non-WTO members, I am imposing 40%. But on WTO members, I have promised to impose 30%. This 30% promise of imposing of tariff on WTO members is called as bound tariff. That means I am bound to follow it. I can't impose beyond that. I can impose up to 30%, but not beyond that. Okay. Now I have promised to impose 30%, but I am imposing only 27%. So whatever the actual tariff that I am charging or imposing on WTO members, it is called as applied tariff. It is called as applied tariff. Okay. Now coming back to preferential tariff, what do you mean by preferential tariff? Among WTO members, I am doing huge amount of trade with 2 or 3 countries. Now, what I will do, since I am having huge amount of trade with these 2 or 3 countries who are also WTO members, but I am having huge amount of trade with these 3 or 4 countries, so 2 or 3 countries. What I will do, instead of imposing 27% tariff on them, just like other WTO members, I will be imposing only 15%. Because since I am having huge amount of trade with them, if I impose lesser tariff on them, they will also impose lesser tariff on my goods. So what I am doing, I am giving preferential treatment to some WTO countries. Okay, so because I have an agreement with them. Such kind of tariff is called as preferential tariff. So it is clearly mentioned here. Bound tariff means, so represents maximum level. Okay, and applied tariff means, okay, what we are actually applying. Okay, next, preferential tariff means lower tariff is charged on goods imported from a country for a preferential treatment. Okay, so this is the example that we generally take. Okay, so when you're explaining most favored nation tariff, applied tariff, preferential tariff, and bound tariff, we take the example of WTO and non-WTO members. So favoring all the WTO members by promising to impose lesser tariff is called as most favored nation. Whatever the amount of tariff that you have promised to impose on non-WTO members, on all WTO members, is called as bound tariff. You have promised to impose 30%, but you're imposing only 27%. That is called as applied tariff. You promised to impose 30%, but you're imposing only 27%. That is called as applied tariff. And among WTO countries, you have huge amount of trade. You're doing huge amount of trade with couple of countries. So instead of imposing 27%, you are imposing only 15% on these 2 countries. And they will also do the same thing to you. They will also impose only 27%. So this preferential treatment that you are giving to couple of countries, that is called as preferential tariff. Okay. And what do you mean by variable tariff? Duty fixed to equalize price of import commodity with domestic commodity. So the tariff that is imposed on an imported good to make sure that the price of imported good is equal to price of the domestic good, that is called as variable tariff. Now coming back to escalated tariff, what do you mean by escalated tariff, sir? As a good moves through the production channel, the tariff rate keeps on increasing. Simply stating, lower tariff and raw material, higher tariff on the finished good. It is called as escalated tariff. Escalated means increase. So as the state of the product keeps on changing, the tariff rate also changes now. Lower tariff on raw material, moderate tariff on work in progress, and higher tariff on finished goods. Now prohibit tariff. What do you mean by prohibitive tariff? The tariffs are so high that it prohibits any sort of import into the country. It is called as prohibitive tariff. Now what do you mean by import subsidy? Okay, so it is nothing but a negative import tariff. So basically, not to encourage imports, we will give subsidies. It is called as import subsidy. Okay. Now tariff as response to trade distortions. Because of certain transactions, the international trade between 2 countries get affected. Okay. Now, if one country finds out that the other country is taking advantage of this situation or taking advantage of its situation, it may respond against such kind of transactions. Okay, because these transactions are affecting the smooth trade between the countries. That basically stating one country is trying to take advantage of a situation which is going to affect the other country adversely. Okay, so the affecting party, basically the importing country. Okay, there are 2 countries. One is exporting country and one is the importing country, right? So if exporting countries, if trying to take advantage of a situation, and because of this, the importing country trade is getting adversely affected, business is getting adversely affected, the importing country can take certain steps. These steps are called as nothing but tariff as response to trade distortions. Now, when it comes to trade distortions, can be classified in two types. One is anti-dumping duty, and the one is export subsidy. Okay, let us see what is anti-dumping duty. When the dumping is found, anti-dumping duty is imposed on the additional import duty as additional import duty, so as to offset or reduce the foreign firms' unfair price advantage. Not only we will impose the normal import duty, but if the importing country finds out that the exporting country is dumping goods in my country, along with normal import duty, the importing country will impose additional import duty just to offset or negate whatever the advantages the exporting country has. Okay, let us understand what is dumping first. So it is very important. What is dumping? It occurs when manufacturers sell goods in a foreign country below the selling price in their domestic market or below their full average cost of the product. For example, the price of the product in China, exporting country is China, India is importing country. The price of good in China in terms of dollars is $1,000. But the same good is sold in India for $900. See, when you are exporting a good from one country to another country, basically cost will increase, right? But here it is completely different. The good is sold for $1,000 in China, but the same good is being exported and sold in India for $900. So simply stating, the price of the good in the foreign country is less than the price of the good in China. That is called as dumping. Or when the price of the good in foreign country is less than the cost of production in the domestic country, that is also called as dumping. In such a case, the importing country can take anti-dumping measures. Okay, so dumping can be of two different types. It may be persistent, seasonal, or cyclical. Dumping may also be resorted to as a predatory pricing. Okay, what do you mean by predatory pricing? Selling goods at very low prices. Why? To affect the competition in the market. Okay, next. And dumping is an international price discrimination favoring buyers of exports and harming the domestic producers of the importing country. So when domestic producers are getting affected, definitely the importing country has to take appropriate steps. Okay, next to B. B is nothing but countervailing duty. What do you mean by countervailing duty? If exporting country not encourage its exports, if it is giving subsidies to its exports, automatically the exporter can sell at lower prices in the foreign country. Now, this is an unfair advantage to the exporter. In order to counter this, the importing country will impose countervailing duty. It aims to offset the artificially low prices charged by the exporter who enjoy export subsidies and tax concessions offered by the government in their home country. Okay, that is tariff. But coming back to non-tariff. When it comes to non-tariff, so non-tariff measures. What do you mean by non-tariff measures? Other than customs tariff, and these affect international trade on goods by changing quantity traded or prices or both. Tariff means we're talking about taxes which affect prices directly. Non-tariff means we're talking about quantities traded which affect prices indirectly. Okay. So these non-tariff measures can be divided into two types: technical measures and non-technical measures. What do you mean by technical measures? They are product-specific measures such as measures related to characteristics of the product, production, process, and technical specifications to ensure product quality, food safety, environmental protection, national security, and protection of animal and plant health. So these measures are product specific and they are basically intended to protect the health of people, plant, and animal, protect the biodiversity. Okay. These technical measures are again divided into two types: sanitary and phytosanitary. Sanitary means we're talking about health and hygiene here. Okay. So these measures are taken to protect human, animal, plant life, and biodiversity from risk arising through additives, the chemicals that are added in products, preservatives, pest, contaminants, toxins, or disease causing organisms. So if the importing country feels that a imported good has a risk of causing harm to the people, or to plant or to biodiversity, then it can use these sanitary and phytosanitary measures. Example: prohibition of import of poultry from countries affected by avian flu. Avian flu may not affect humans, but if avian flu, it will affect the animals in the country, okay, birds in the country. So if a country is affected from avian flu, definitely we will not import any sort of poultry items or meat items from that country, because it may not affect the humans, but it will definitely affect animals. Okay, so in order to protect the health of the animals, we will ban import of goods from that country, import of meat items from that country. Okay, next, technical barriers to trade. What do you mean by technical barriers to trade? Here it covers both food and non-food. So sanitary and phytosanitary means we are only concerned about the food. Okay, here we're talking about both food as well as non-food traded products. Refers to mandatory, standard and technical regulation, that is specific characteristics of products such as size, shape, design. So whatever the things that are not covered in sanitary and phytosanitary are covered in technical barriers to trade. Okay, here we talk about both food as well as non-food items, and we are specific about the characteristics like, so imported goods should have these characteristics, and the importing country will define what sort of characteristics a imported good should possess. So the importing country gives specifications regarding size, shape, design, labeling, packaging, functional and production methods. Involves compulsory quality and quantity and price control before shipment from the exporting country. Example, food laws, quality standards, industrial standards, organic certification, eco-labeling and marketing requirements, all these things. Basically, these things are not covered in sanitary and phytosanitary, that's why they're covered here. Okay, next, non-technical measures. When it comes to non-technical measures, what are those? Trade requirements such as taxation policies. So these are not product specific, these are general measures. Okay, and these measures includes measures like taxation policies, shipment requirements, trade rules, custom formalities. So these non-technical measures can again be divided into hard measures, strict measures, and financial investment measures. Okay, now coming back to import quota. What do you mean by import quota? Government will fix a limit. Only up to that limit you can import, and beyond that you can't import. If you want to import more than that, you have to wait till the next year. The government has fixed a limit of 10,000 kgs. Only up to 10,000 kgs you can import in an year. Beyond that, you can't import. That is called as import quota. Now, import quota can be of two types. One is binding quota and the one is non-binding quota. What do you mean by binding quota? If the limit is set below free trade level, what do you mean by free trade level, sir? When there are no restrictions, whatever the quantity you were importing, that is called as free trade level. So when there were no restrictions, you were importing 20,000 kgs. You were importing 20,000 kgs. But as of now, government has kept a limit as 10,000 kgs. That is, this limit is below the free trade level, right? This is called as binding quota. And what do you mean by non-binding quota? Earlier, when there were no restrictions, you were importing 20,000 kgs. Now, government will fix a limit as 25,000 kgs. So basically, non-binding quota will have no impact on the trade, because the government has fixed a limit above free trade level, right? So you are importing on 20,000 kgs, a country is importing on 20,000 kgs, but government has fixed a limit as 25,000 kgs. But whereas binding quota, government will fix a limit below free trade level. So country is importing 20,000 kgs, but government has fixed a limit that you can import only up to 10,000 kgs. Beyond that, you can't import. That is called as binding quota. Okay. So binding quota can be again of two types. One is absolute quota or quotas of permanent nature, or seasonal quota or temporary quota. What do you mean by absolute quota or quotas of permanent nature? Government will impose this quota permanently, either in terms of quantity. Government will impose this quota permanently. It will define the quantity, only that quantity you can import now. And sometimes it will add some more points also. That is, not only quantity, but also it will specify the time during which you have to import. For example, here, government may fix a limit that you can import 10,000 kgs in a year, 1,000 tons of fish in a year. That's it. Now it's up to you. You can import these 1,000 tons of fish at any point of the year. But sometimes government, what it will do, it will fix the time also. In first half of the year, you have to import 750 tons, and second half of the year, you have to import 250 tons. Then you have to abide it. Okay, that is called as absolute quota or quota of permanent nature. Next, coming back to seasonal quota or temporary quota. Example for that, quota of 1,000 tons of fish can be imported any time of the year, but 750 tons seasonal. This is seasonal. Okay, right. Next, non-binding quota. As I already explained, what do you mean by non-binding quota? It has no impact on the international trade. Now, what do you mean by quota rent? See, quota rent is because of binding quota. Quota rent is because of binding quota. What do you mean by that, sir? When the limit is set below free trade level, it will create the scarcity of imported goods. It will create scarcity of imported goods in the country. When there is scarcity of imported goods, automatically the price of imported goods increases. When the price of imported goods increases, the importer, who is also a seller, will earn more profits than what he was earning earlier. So this excess profit, whatever the importer or seller is earning because of scarcity of imported goods, is called as quota rent. Okay, I hope it is very, very clear to people. Quota rent means nothing but because of binding quota, we are unable to import what we used to import earlier. So this leads to scarcity of imported goods. Earlier I was importing 20,000 kgs. Now I am able to import only 10,000 kgs. This led to shortage of imported goods into the country. When there is shortage of imported goods, automatically price of imported goods will increase because demand is same like that, right? But supply has decreased. Demand is greater than supply. Automatically price of imported goods will increase. Earlier I was selling at 10 rupees. Now I will be able to sell at 5 rupees. This 5 rupees is nothing but excess profit to me. So this excess profit is called as quota rent. Okay. Next to price control measures. What do you mean by price control measure? Here government will fix a minimum price for the good. That means you can't sell good below that price. You have to sell at that price or beyond that. Okay, so this price control measure can also be called as para tariff measure. That means it is almost equal to para tariff measure means it is almost equal to tariff. Okay, so basically government is fixing a price below which you can't sell. For example, we are importing a good from abroad for 20,000 rupees, but government will fix a price setting that you can import that, but you have to sell it at 25,000, not below that. So this 5,000 which is added by government is nothing but almost equivalent to tariff, right? That's what is called as para tariff measure. Next, non-automatic licensing and prohibition. Sir, what do you mean by non-automatic licensing and prohibition? For each import, you have to apply for license or permission. That is called as non-automatic licensing. Automatic license means once you have taken license for a period, you can import, you can keep on importing goods during that period. There is no need to take permission again and again for each import. But non-automatic licensing means you have to take permission for each import from the government. And prohibition. Sometimes government may prohibit import of certain goods completely. Examples are given there. Okay. Next, financial measures. What do you mean by financial measures? Out of your total profit, a certain percentage is to be used for purchase of domestic made goods only. So government may pass such kind of rule. That means if you earned 100 crores, government will pass a rule stating that 25 crores should be spent on domestic made goods on and 75 crores is up to you. Or sometimes government will pass a rule stating that if you want to import any sort of good from abroad, you have to pay 100% tax 3 months prior to the date of import. Now, we don't know whether we are going to import or not, but we have to pay. If you are thinking about buying an imported good, okay, you have to pay before itself, you have to pay 100% tax 3 months prior to the date of import. On the date of import, anything can happen. You may cancel the orders and anything can happen. But you have to pay 100% tax 3 months prior to the date of import. Such kind of measures are called as financial measures which are taken to discourage imports. Measures affecting competition. What government will do here? See, government will simply pass a rule stating that whatever the raw material that is to be imported into the country will be imported by government agency. Example, as of now, any party can import palm oil into the country, whether private party or government party. It does not matter. Okay, you have to simply take a license and keep on, and you can import palm oil from abroad. But the government wanted to support domestic palm oil growers or palm oil manufacturers, palm growers and palm oil manufacturers. So in order to protect their interest, what government is doing, it is simply passing a rule stating that from now on, palm oil will be imported through government agencies alone. So if someone wants to import palm oil, they can't do on their own. They have to do it through government agency. So basically, it is creating a obstacle. Earlier, we used to freely import. Now, government is creating an obstacle. The objective is to discourage imports. Okay. Government procurement policies. What do you mean by government procurement policies? See, from time to time, government takes up several infrastructure activities, right? Construction of several infrastructure projects. So if at the retreat, it needs raw material, other things. What government will say is that whatever the material that is required for these projects, I will purchase it from domestic companies only. I will not import these raw materials from abroad. Okay. So that is called as government procurement policy. In accepting public tenders, government may give preferences to local tenders rather than foreign tenders. There is a policy taken by the government. Whether it's right or wrong, it's a different story. But what government is saying is that I need to construct this national highway or I need to construct this dam. So whatever the raw material that is required for this land or dam or whatever the materials that are required for this dam, I will purchase it from domestic companies only, or the construction contract will be allotted to a domestic company only, not to foreign companies. So that is called as government procurement policy. So basically, government is favoring domestic companies over foreign companies. Now, trade-related investment measures. I have already explained it. Almost financial measures and trade-related investment measures are almost one and the same. Okay, when it comes to financial measures, we are talking about payment of entire tax, right? Okay, when it comes to trade-related investment measures, investment means here expenditure by producer. So example is given that 25% of the component of imported automobiles to be sourced domestically. Now you are manufacturing a car in India. Out of all the components, 25% of the components that are used in car are to be purchased from domestic companies only. Okay. Next, distribution restrictions. See, you will be allowed to import goods, but you will be allowed to sell those goods only through some shops, which has some certain facilities, special facilities. For example, kiwi fruit is allowed to be imported into the country, but the sale of kiwi fruit is allowed only through refrigerated facilities. Okay. So basically, by passing that rule, what we are doing, we are preventing kiwi fruits to be sold by roadside vendors. Okay. So this is called as distribution restriction. Now, restriction on postal services. Postal services are to be provided by domestic companies only. Okay, is another rule. Administrative procedures and formalities, licenses, administrative delays, red tape and corruption, customs clearing, frustrating potential importers, procedural obstacles, etc. So administrative procedure means government unnecessarily creating certain obstacles. Okay, such kind of rules are not required there, but still government is asking us to follow those rules. Objective is to discourage imports and make us more dependent on domestic made goods. Now, rules of origin. What do you mean by rules of origin here? Required by government. See, rules of origin means when a product is manufactured in different countries, in order to make imports more difficult, what government will do? It will ask the importer to submit a certificate of origin. Certificate of origin. Okay, for example, a computer, the different parts of computer are manufactured in different countries. Okay, CPU is manufactured in Taiwan, monitor is manufactured in China, keyboard and mouse are manufactured in Philippines. All these are imported by Sri Lanka, assembled there and exported to India. Till now we were importing computers from Sri Lanka. Now government wanted to encourage domestic computer manufacturers, so it has to restrict imports. The government will simply pass a rule stating that whatever the goods that are being imported into the country, they have to submit rule of origin. That means since different parts of the computers are manufactured in different countries, from each country we have to take the certificate of origin. Okay, so it creates a huge obstacle for the importer, because getting rule of origin, getting certificate of origin is not that easy, because government is involved, right? So we have to follow several procedures there. The same thing is given here. Required by government of importing country to determine national source. So government wants to know which part of the system is manufactured in which country. For that, what it is doing, it is asking the importer to submit a certificate of origin. Why the government is asking this? Because what government says is that I impose different tariffs on different countries. So basically, government is trying to create. Till now, that rule was not there, but suddenly, all of a sudden, government came up with this rule. Objective is to restrict the imports. Now, safeguard measures. When there is sudden increase in imports, in order to safeguard or protect domestic manufacturers, whatever the measures taken by the importing country are called as safeguard measures. So if there is a sudden increase in imports, definitely it will affect domestic manufacturers adversely. In order to protect the domestic manufacturers, whatever the measures taken by the importing country are called as safeguard measures. Now, embargo. What do you mean by embargo? It's a total ban imposed by government on imports or export of some or all commodities to particular country. That means we are basically isolating one country from the rest of the world. No country can trade with that country. That is called as embargo. Basically, embargoes are imposed by a dominant country, developed country, on less developed countries. Okay. Concept 4. So, export related measures. What do you mean by export related measures? These measures are applied by the government of the exporting country, and these include, just like import measures, these include both technical as well as non-technical. First one is ban on exports. What do you mean by ban on exports? So when there is shortage of goods in my country, it becomes completely illogical to encourage exports. So in such situation, what the exporting country will do, it will ban the exports. Example, when there is shortage of onions in the country, it will be meaningless to export onions to other countries, right? So I will ban the exports of onions to other countries. And export taxes. What do you mean by export? This is tariff measure, right? Export taxes. Tax collected on exported goods and may be either specific or ad valorem. These taxes reduce exports and lead to higher domestic consumption. This is tariff measure. Now, export subsidies and incentives. These are given to encourage exports. Now, what do you mean by voluntary export restraints? See, it is an informal quota administered by the exporting country to voluntarily restrict quantity of exports during specified period of time due to political reasons. These measures are basically taken to appease importing country. See, India is an importing country, US is an exporting country. Now, the Manufacturers Association in India approached the Indian government and asked Indian government to restrict imports for 2 or 3 years, because just now we are coming out of COVID, so we need 2 or 3 years to again regain our strength and be competitive with the foreign companies or foreign goods. So the Manufacturing Association approached the Indian government and explained all their problems. And they asked the Indian government to restrict the imports so that these manufacturing companies can again regain their strength economically. Okay, and they will be in a position to compete with imported goods in future. So for now, they need some protection from the government from imports. Okay, right. So what the Indian government will do, it will approach the counterpart, that is US government, which is exporting country, and it will request the US government to restrict its exports on its own. So Indian government is asking US government to restrict its exports on its own for a period of 2 or 3 years. Okay, and it explains all the problems that Indian manufacturers are facing as of now. And what Indian government says, if US is able to restrict its exports for these 3 or 4 years, after that Indian government will give some sort of benefits to US exporters. Now, US government do not want to lose Indian market. Okay, because Indian market is a rapidly developing market, right? So what US government will do, it will approach its manufacturing association and ask its companies to restrict its exports to India for a period of 2 or 3 years. After that, they can enjoy some benefits which are offered by Indian company. So basically, US government is doing this to appease Indian government, to maintain good relationship with Indian government. What will happen if US government do not accept to India's proposal or India's request? India has no other option but to impose tariffs on US imports. And when India start imposing tariffs on US exports or US imports into the country, obviously US will also impose tariffs on Indian goods which are being imported into the US. So it will start a trade war. So in order to avoid this, what Indian government is doing, it is requesting US government to restrict imports for a certain period of time. And US government, in order to appease, in order to impress Indian government, it will ask its manufacturer to restrict exports for a certain period of time, whereby the exporters of the companies in USA can enjoy some more benefits after 3 or 4 years. This is called as voluntary export restraint. So concept 5, trade negotiations. So what do you mean by trade negotiation? Generally, country is negotiating terms and conditions to have smoother trade. Okay. Generally, trade negotiations depend on trade policies. If all the countries have same kind of policy, then there is no need to negotiate. But since the objectives of countries differ from one another, the policies will differ from one another. Then there is a need for negotiating terms and conditions. So when it comes to trade negotiations, first we will see regional trade agreements. What do you mean by regional trade agreements? Grouping of countries, not necessarily of same geographical region, formed with the objective of reducing trade barriers between member countries. The objective of these trade agreements is to reduce the trade barriers among themselves, okay, among those countries. So taxonomy of regional trade. Taxonomy is classification here. Okay, so you can clearly see trade negotiations can be classified into 3 types. Regional trade agreements, GATT, which existed from till 1994, and from there on we had WTO, okay, World Trade Organization. Now again, regional trade agreements can be divided into 3 types: unilateral trade agreements, bilateral trade agreements, and regional trade agreements. Regional trade agreements are of 5 types. Okay, trading bloc, free trade area, customs union, common market, economic and monetary union. So when it comes to trading bloc, what does it mean? Free trade agreement internally and common external tariff. That means these member countries, while trading among themselves, for example, if three countries form into a trading bloc, when they're trading among themselves, they're not going to impose any sort of tariff on one another. But when these countries are trading with some other country, all these 3 countries will impose common tariff. Okay, so that is called as trading bloc. Next, free trade area. What does it mean? no tariff internally, but independent external tariff. So there is a difference between trading bloc and free trade area. When it comes to free trade area, if three countries form into a free trade area, while they are trading among themselves, there will be no tariff. Okay, but when they are trading with some other part, some other country, each country can impose its own tariff. Okay, there is no need to impose common tariff. Okay, that is free trade area. Customs union, again, no tariff internally, but common external tariff. Okay, almost equal trading block, but there are small differences between trading block and customs union. What is the difference between the two? When it comes to customs union, whatever the revenue that is earned by these countries will be pooled and will be distributed equally among all the countries. It is not the same when it comes to trading block. Next, common markets. Common market means no tariff internally, but common external tariff on both output as well as inputs. So here, not only we are focusing on goods and services, but also we are focusing on factors of production. So when both output and input, when both finished goods and services and factors of production are moving freely among these countries and no tariff is imposed among them, then it's called as common markets. Okay. Next, economic monetary union. What do you mean by economic and monetary union? Common macroeconomic policies, and these countries use common currency. It is called as common economic policies and currency among the group. Okay. So these are the different types of regional preferential trade agreements. When it comes to trading bloc, the member countries will not impose any tariff on one another, but when they are trading with some other country, they will impose a common tariff. Free trade area, same thing. When the member countries are trading among themselves, they will not impose any sort of tariff. But when they're trading with other countries, each country can impose its own respective tariff. There is no need to stick on to common tariff. Okay. Customs union, no tariff internally, but common external tariff, and whatever the revenue these countries have earned, they will share it equally among themselves. Now, common market. What do you mean by common market? Here, not only goods but also factors of production also move among member countries freely without any tariff. But when they're trading with some other country, they will impose common tariff. Okay. And economic and monetary union means these countries will generally use a common currency. Now, unilateral trade agreement. What do you mean by unilateral trade agreement? An importing country offers trade incentive to exporting country. See, unilateral means only one country. See, importing country on its own is offering certain incentives to the exporting country to encourage international economic activity that will improve the exporting country's economy. That is called as unilateral trade agreement. Okay. So USA on its own offering certain incentives to India. So India has not asked for those incentives, but USA on its own has offered certain incentives to India. Okay, that is called as unilateral. Bilateral means here we have two countries. Okay, rules of trade between two countries or two blocks or block or a block or and a country. Okay, so here the agreement will be between two countries or two blocks or a block and a country. Okay, it may be limited to certain goods or services or certain types of market entry barriers. Example is ASEAN is a block and India is a country. So the agreement between a block and a country is nothing but bilateral agreement. Regional preferential trade agreements. Agreements made among a group of countries to reduce trade barriers on a reciprocal and preferential basis for only the members of the group. So whoever have come into a group, whatever the countries have formed into a group, whoever have come into the group or whatever the countries that have formed into a group, they will reduce all the tariff barriers when they are trading among themselves. Okay, so such kind of agreements are called as regional preferential trade agreement. That means they are giving preferential treatment to one another. Okay, only the countries which are members of that group. Okay, right. Next, general agreement on tariffs and trade, GATT. So GATT was only a multilateral instrument governing international trade along with World Bank and IMF. Okay, so basically it's merely a contract. It does not have any existence or anything. Okay, it was made merely an instrument. Okay, which was governing international trade. Whereas World Bank and IMF are proper organizations, whereas GATT is simply an agreement between among countries. Okay, it did not have any proper structure or anything. Why GATT lost its relevance by 1980s? Because what are the reasons? It became obsolete, outdated with the emergence of globalization. So in those days, it was relevant. After World War II, GATT was quite relevant for that era. But by the time 1980s, 1990s, globalization grew into prominence. Okay, so GATT became obsolete or outdated. Next, trade in services, trade-related investment measures, trade-related intellectual property rights were not covered by GATT. All these aspects were not covered by GATT. World merchandises, goods, trade in goods, trade. World merchandises trade, goods trade increased by leaps and bounds. It increased exponentially. Ambiguities, confusions in multilateral systems. Liberalizing agriculture trade was not successful. Okay, GATT tried to liberalize agriculture trade, but it failed every time it tried to liberalize agriculture trade. Inadequacies in institutional structure. It did not have any sort of institutional structure. Okay. And it did not have any sort of dispute settlement mechanism. So, because of all these problems, GATT lost its relevance. Okay. In order to overcome these GATT problems in GATT, countries decided to establish an organization and they called it as World Trade Organization. The only global international organization dealing with rules of trade between nations. It accounts about 95% of the trade. Okay, so compared to the entire trade carried out in the world, 95% of the trade is carried out by the members of WTO. Currently has 164 members, out of which 117 are developing countries. So majority members in WTO are developing countries, and the 25 countries are negotiating membership. Okay, WTO agreements have to be ratified. That means whatever the agreements countries have signed in WTO are to be passed in their respective parliaments. Right. So WTO. So when it comes to WTO, it has objectives, primary objectives, and other objectives. Functions of WTO. Under functions, we have forums for trade negotiations, administer trade agreements, review trade policies. Forum means a place is provided by WTO where countries can come and negotiate. Okay, a platform. Next, once the terms and conditions have been negotiated and no agreements have signed, WTO will make sure that these agreements are properly implemented, administered. Next, from time to time, WTO will review the trade policies of these countries, resolve any trade disputes, helping developing countries in terms of trade. So, WTO will help developing countries in implementing these agreements. Now, coming back to structure of WTO. When it comes to structure of WTO, it has a three tiers structure, or three levels. Okay, the topmost level is ministerial conference, which meets of every 2 years. Okay, right. Under this, we have general council. This general council can act as trade. This general council can act as dispute settlement body and a trade policy review body. Okay, the general council, depending on situation, will act as trade policy review body and dispute settlement body. Under this general council, we have committees and councils on each item. It is committees or working groups, council for trade in goods, council for trips, trade related intellectual property rights. Okay. Next, council for trade in services, council for trade related investment measures, trade negotiation committees. That means on the general council, we have specialized councils or committees. Okay. So these councils will look into their respective areas. They will forward the information to general council, and general council in turn will forward the information to ministerial conference. Okay. And depending on situation, the general council may act as dispute settlement body or trade policy review body. Next, guideline principles of WTO. So what are the guiding principles? So basically, these are the principles basing on which WTO will work. Okay. So what are those principles? First one is most favored nation. Next one is NTP, national treatment policy. Next, free trade area, predictability, principle of general prohibition of quantitative restrictions, greater competitiveness, tariff as a legitimate measure, transparency in decision making, progressive liberalization, market access, special privileges to less developed countries, a transparent, effective, verifiable dispute settlement mechanism. These are the principles which guide WTO. Okay. Next, agreements. What are the agreements that have been signed under WTO or that are being used by WTO? Okay. These are the agreements which are signed in WTO or which are continuing in WTO. So first one is agreement in trade in services. Next, TRIPS, TRIMS, TRPB, TPRB, sorry, DSP, dispute settlement body, safeguard measures, SPS, TBT, sanitary and phytosanitary, TBT, technical barriers to trade, anti-dumping duty, countervailing duty, import licensing, pre-shipment inspection, agriculture, textile and clothing, unilateral trade agreements, that is government procurement, civil aviation. All these are the agreements that are being followed by WTO or existent in WTO. Okay, let us see some of them. Okay, right. So guiding principles. So some of the important guiding principles of WTO are: first one is most favored nation or trade without discrimination. Now, when we mention this, I hope you can understand what is the objective of this principle. Under the WTO agreement, countries cannot normally discriminate between their trading partners. You can't discriminate unless you have a preferential agreement. Okay. It means you have to impose a common tariff on all the WTO members unless you have a preferential agreement with that country. If a country lowers a trade barrier or opens up a market, it has to do so for same goods and services for all other WTO members. For example, India is giving some sort of concession for a particular good coming from USA, then it has to give the same kind of concession if the same kind of good is imported from other countries also. Okay, so this is called as most favored nation, not trade without discrimination. Next, when we can avoid such kind of principle. Okay, I mean to say ఇది కట్ చేయండి when we can అనేది. Okay, when we can కట్ చేసి. So in case of certain exceptions, we can ignore this MFN rule. Okay, if you have a preferential trading agreement, then we can ignore this MFN rule. Next, the national treatment principle. What do you mean by it? National treatment principle is complementary to MFN rule. That means both these principles go hand in hand. A country should not discriminate between its own and foreign products or service or nationals. Okay, once the goods are imported into the country, you have to give same kind of treatment to both imported good as well as domestic made. Next, market access. What do you mean by market access? To increase market access means making sure that the market of countries are increasing. That means countries are able to access more areas. Okay, that is called as market access. So to increase world trade through market access by converting all non-tariff into tariff. Okay, so by converting all non-tariff into tariff, we can have a proper control. Okay, on the obstacles created by the importing country. Okay, so by reducing these obstacles, we can make sure that countries are able to access more markets. Okay, why we need to convert non-tariff barriers into tariff barriers? See, non-tariff barriers is very difficult to monitor because importing countries can easily use non-tariff barrier as a protectionist measure. Okay, as long as it is a legitimate measure, it's not at all an issue. But if countries start using it as a protectionist measure, then it becomes very, very difficult to have control over non-tariff barriers. That's why WTO is focusing on converting all the non-tariff barriers into tariff barriers. Okay, so these are some of the major principles, guiding principles of WTO. Next, agreements of WTO. Some important agreements. So basically, WTO agreements, it is system based on rules. Okay, that means WTO will make sure that once the country have signed these agreements, whether they are implementing or not. It's a system based on rules. It covers goods, services, intellectual property, investment measures, and permitted exceptions. Okay, some of the major agreements are given here. Okay, so first one is agreement on agriculture. To improve agriculture trade includes specific and binding commitments made by WTO member governments in the three key areas of market access, domestic support, and export subsidies. So, in order to improve agriculture trade, okay, Countries have signed on these three areas, that is to allow other countries more market access, what sort of domestic support price that is to be domestic support that is to be given to these products, and export subsidy, to what extent export subsidies will be allowed. Okay. Next, agreement on textile and clothing. It replaced a multi-fiber arrangement. Agreement on textile trading provides that textiles trade should be deregulated gradually by integrating it into GATT principles over a 10-year transition period. See, as of now, developing countries are not allowing textile from other countries, majority of them. So what WTO wants to do is that it is giving 10-year period of time, 10 years time period to developing countries to gradually reduce the tariff that they are imposing on textiles and clothing. Okay, so transition period is given by WTO to developing countries. Now, customs valuation agreement. Aim is to make a reliable customs valuation and to harmonize customs valuation system globally by eliminating arbitrary. Arbitrary means randomly. So whatever the valuation system that is being followed by majority of the countries, you have to use the same valuation system. You can't change the valuation system arbitrarily. WTO will make sure that countries are not changing this customs valuation randomly or arbitrarily. Okay. Next, agreement on pre-shipment inspection. What do you mean by pre-shipment inspection? See, certain goods do not require any sort of pre-shipment inspection. Pre-shipment inspection means getting goods inspected before exporting. Okay, so the importer will define where these goods are to be inspected, and he will nominate a person who will come and who will nominate an agency or a person who will come and inspect those goods. Now, when there is no pre-shipment inspection on certain goods throughout the world, then one particular country cannot ask the person to carry out pre-shipment inspection on that particular good. For example, on steel, there is no pre-shipment inspection, okay, practiced by rest of the world. So India cannot ask an exporter to carry out pre-shipment inspection on steel because it's not a standard procedure that is being followed rest of the world. Okay. Importing country conducts inspection in terms of quality, volume, price, customs valuation, etc. of goods in territory of exporting country on behalf of importing country, customs office, and issues certificate. It provides a mechanism for solution of disputes between pre-shipment inspection agencies and exporters. Okay. Next, in case of any disputes between the pre-shipment inspectors and exporter, these agreements will provide the guidelines, okay, how to resolve those disputes. Now, agreement on trade related aspects of intellectual property rights. It specifies MFN and NTP for intellectual property such as copyright, trademark, graphical location, etc. It specifies procedures for intellectual property protection and settlement of disputes related to agreements. Okay. So as of now, this agreement is playing a very active role. Next now, understanding on rules and procedures governing the settlement of disputes. So the name itself suggests in case of any disputes, how these disputes are to be resolved, how dispute settlement board a body has to act. Okay, so dispute settlement. So DSU provides guidelines for dispute settlement. What does it provide? It provides the common rules and procedures for settlement of disputes related to WTO agreements. It strengthens dispute settlement procedures by prohibiting unilateral measures. See, if you are threatened by some exporting country, then the importing country cannot take unilateral measures. First, it has to approach WTO and explain what is happening in international trade and in what way it is getting affected. Okay, so no country can take unilateral measures. Establishing dispute settlement panel whose reports are automatically adopted, setting time frames for dispute settlement, and establishing the appellate body. So these are the points that are covered under rules and procedures governing the settlement of disputes. Now, trade policy review mechanism. What do you mean by trade policy review mechanism? From time to time, WTO should review the trade policies of respective countries. Okay. Next, plurilateral trade agreements. It is agreements on trade in civil aircrafts and agreements on government procurement. So, what do you mean by agreements on trade in civil aircrafts? Generally, this agreement on trade in civil aircrafts entered into force on 1st January 1980 to eliminate import duty on all aircrafts other than military aircrafts, because most of the components of these civil aircrafts are manufactured throughout the world. So if these barriers are not reduced when it comes to trade in civil aircraft, the cost of aircraft will increase, because when countries start imposing tariff on one another, automatically the cost of aircraft will increase. You know, to avoid that, these countries, almost there are 30 countries, I think, these countries came to understanding and signed an agreement stating that when we are trading parts of civil aircraft, it does not impose any sort of tariff on one another. Okay. Next, agreement on government procurement. It requires MFN and NTP in the areas of government procurement of goods and services and call for fair and transparent procurement procedures. The government should not differentiate or discriminate domestic company from foreign company. Okay, it should give equal opportunity to both domestic companies as well as foreign companies at the time of quoting any tenders, at the time of procurement of raw material. The fundamental aim of the GPA, that is Government Procurement Agreement on Government Procurement, is to mutually open government procurement markets among its parties. Okay, that means foreign companies should also be able to uh, apply or attend the tenders or quote for the tenders of government infrastructure facilities. Okay, ఇది కట్ చేసేది ఇది కట్ చేయండి. ఓకే, ఆ లైన్ ఏదైతే ఉందో కట్ చేసేయండి. So concept 10, Doha round of WTO. So what is Doha round? Doha round, that is Doha Development Agenda. It's the ninth round since the Second World War, officially launched at the WTO Fourth Ministerial Conference in Doha, Qatar in November 2001. Major modifications of global trade through lower trade barriers and revised trade rules most are covered in this round. The most controversial topics yet to conclude in this round is agriculture trade. That means in this round also, countries were unable to come to terms in case of agriculture trade. 25 years of WTO achievements. So, what are the achievements of WTO? Spectacular growth in world trade in goods and services. Since 1995, dollar value of world trade increased nearly 4 times. Real volume of world trade expanded by 2.7 times. Average tariff have almost halved, and that means countries have started reducing the tariff. Okay, from 10.5% to 6.4% during this period. Okay, so almost the tariff imposed by these countries have come down to nearly 6.4% on an average. WTO, along with improved communication, possibility of movement of components and allied services across multiple locations and manufacturing production across countries, the trade within these GBCs account for 70% of total merchandise trade. Okay. So rise of GVCs. So what do you mean by GVCs, sir? Global value chain. That means production happening at international level. Okay. So rise of GVCs enable rapid growth in developing countries with increased purchasing power and consumer choice. When the production increases, automatically income increases, purchasing power also increases. Member countries of WTO agreements enjoyed far-reaching reforms and market opening commitments which boost their national income. Obviously, fast when the production increases, automatically income increases. When income increases, poverty also decreases. So WTO was able to reduce poverty throughout the world. So fastest poverty reduction around the world. In 1995, 1 in 3 people living around the world fell below World Bank's 1.9 threshold for extreme poverty. Today, the extreme poverty rate is less than 10%. That means from 33%, it has come down to 10%, all because of international trade. Now, the major issues of WTO of Doha round are, so what are the major issues? What are the major issues? Latest negotiations of Doha round ran into problems and their success is doubtful. Most developing countries are dissatisfied with the WTO because most of the promises in the eighth round are yet to be fulfilled. Okay, so when the agreements or promises made in eighth round are not yet fulfilled, They are not confident that the ninth round, whatever the promises made in the ninth round, that is Doha round, would be fulfilled. Okay, lack of consensus or agreement among WTO members led to regionalism as a possible alternative. So, uh, since countries are not confident in the working of WTO, they started preferring regional trade agreements. Existing trade barriers are difficult to negotiate in the multilateral forum, but found it easier to discuss at bilateral or regional level. Okay, WTO means all the countries had come to agreement, right? So it becomes very difficult for all the countries to come to a common understanding. So what countries started doing? They started preferring bilateral regional trade agreements where there will be few countries, and it is very easy for these countries to come to a common understanding. The developing countries have raised a number of concerns such as real expansion of trade in three areas: agriculture, trade, textiles, and services have been dismal, not satisfactory. High tariff on vital exports of developing countries. That means developed countries are imposing very high tariff on goods that are being exported from developing countries. Escalated tariff levied by developed countries. That is a major issue. Next, special tariff concessions by developed countries on imports of developing countries because became less meaningful. Special tariff means we're talking about preferential tariff. Okay, so the gap between applied tariff and preferential tariff had narrowed down. So there is no meaning of having any sort of preferential agreement. For example, the applied tariff is 27% and the preferential tariff is 15%, then it is meaningful. But the applied tariff is 27%, and preferential tariff is 26 or 25%. It has no meaning at all. For the sake of 2% reduction, no country wants to enter into a preferential agreement, right? So, but developed countries are doing it with the developing countries. Developed countries, what they're doing in the name of preferential tariff, they are reducing the tariff nominally from 27 to 25. That's it. Next. Next, in recent times, WTO and global trading system are facing serious challenges in terms of unilateral measures and countermeasures by some member countries. Over the past 2 years, government introduced trade restrictions and protectionist actions affecting 747. Because of these unilateral measures and protectionist measures, the international trade got affected by $747 billion in terms of international trade. Rising uncertainties about market condition, postpone investments, weighing on growth and future potential of our economies. Many areas of trade, such as e-commerce, are still outside WTO. They're not covered under WTO. Okay. Next, we all know the trade war between US and China. US started taking unilateral measures on China, and China reciprocated it. So, in that, the WTO did not play any sort of important role, or the WTO failed to bring these two countries to a common consensus. Okay, so because of all these issues, developing countries started doubting the effectiveness and performance of WTO. Concept 11. Details of India's dispute at WTO as on 16/3/2020. Okay, so list is given where India is a complaining party. That means India is complaining against some countries. Okay, and point number 2 is nothing but where other countries are complaining against India. Okay, so a list is given. You can clearly see. Okay, so you can go through this list on your own. Right. So the next chapter is fiscal functions. So fiscal function is basically what are the functions that are to be performed by the government. Okay, all those things we'll study in this chapter. So concept 1, role of government in a market economy in the words of Adam Smith and Richard Musgrave. Adam Smith is a classical economist and Richard Musgrave is a modern economist. So these two sets of economists have different opinions regarding the role a government has to play in the market. Let us see the opinion of classical economists first. So role of government in the words of Adam Smith. Role of government in free market is minimum and performs only traditional functions. What are those traditional functions? First one is national defense, uh, highly beneficial public institutions, maintenance of justice and rule of law. So these are the traditional functions. There is national defense, providing defense to the country, running certain beneficial institutions, public institutions, okay, like police department, fire departments, etc., and maintaining law and order in the country. Along with that, the second additional function is taking up infrastructure works. Okay, see, these activities, why the government has to take up, because the private sector is not interested in taking these activities because there is no scope of earning any sort of profits in these activities. That's why it is left to the government to take up these activities. So this was the opinion of classical economists. The government should perform only these activities in the market. Since 1930, the Great Depression, State role, state means here government. Government role in the free market gained importance from traditional functions to economic functions. That means after 19th, the Great Depression, all the economists believe that government along with traditional function, it has to perform some more functions. What are those? These roles have been classified by Richard Musgrave into three. So this is Richard Musgrave introduced three-branch taxonomy of role of government in market economy. So according to him, government need to perform, along with traditional functions, government need to perform these three functions also. There is allocative function, distributive function, stabilization function. What do you mean by allocative function? What do you mean by that? Allocative function is concerned about achieving efficient allocation of resources. Distribution function is concerned about achieving equity and social welfare in the society. And stabilization function is concerned about maintaining stability in an economy. Whereas allocative function, distribution function are microeconomic functions, whereas stabilization function is macroeconomic function. Because when it comes to stabilization function, we are talking about maintaining stability in the entire economy. Okay, that's what is a macroeconomic function. When it comes to allocation and distribution function, we are talking about government intervening in those sectors where there is inefficiency and where there is inequality. Okay, so we're talking about one particular sector which suffers from inefficiency or inequalities. In such case, in those sectors, government will take up allocative function and distributive function. Okay, this is concept one. Concept two, resource allocation function of government. So what do you mean by resource allocation function that is performed by the government? Every economic system aims at efficient allocation of scarce resources among various resources. We all know that every country has resources, but these resources are very, very scarce. So every government or every economy will try to utilize these resources to the optimum level. Best use of available resources and no wastage. Optimum utilization means resources should be optimally utilized with less or no wastage. This occurs, unfortunately, this optimum utilization or full utilization of resources occurs only in perfect competition. In real world, perfect competition does not exist. Whatever the markets we have, all are imperfect competitive markets. So when it comes to imperfect competitive markets, resource allocation is done by both markets as well as government. So how market means we're talking about private sector. So how private sector allocate resources? It is based on supply and demand, nothing but price mechanism, interaction between demand and supply. So which resources are to be used and to what extent it depends on price mechanism, nothing but demand and supply. What do you mean by state resource allocation? How government allocate resources? Through budget. Through budget. Okay. Now, what do you mean by misallocation of resources in a market? See, optimum utilization or optimum allocation of resources is only possible in perfect competition. But in real world, perfect competition does not exist. Either we have imperfect competition, right? When there is imperfect competition, either there will be overutilization or underutilization. That means either it may lead to overproduction or underproduction, overconsumption or underconsumption. Apart from optimum, whatever the production or consumption levels we have, it is called as misallocation of resources. So if the free market fails to allocate scarce resources efficiently, then it will result either in underproduction or overproduction of goods and services. Where there is underproduction or overproduction of goods and services, it is called as misallocation of resources, leads to market failure. Reasons for misallocation of resources are reasons for market failure. What are the reasons for misallocation of resources and what are the reasons for market failure? The first reason is monopoly power. Okay, so what are the reasons? Monopoly power. Monopoly power means generally if there is only one seller in the market, he will try to sell goods at higher prices and produce less quantity. Next, markets fail to provide adequate quantity of public goods. Public goods are those goods which are meant for everyone in the society. Okay, so if sufficient quantity of these public goods are not provided, then also it leads to market failure. Market fail to provide right quantity of merit goods. Goods which are beneficial to society should be produced at an optimum level. That means, example, vaccine. Vaccine is a merit good because it is beneficial to society. So to what extent vaccines are required, to that extent we have to produce it. But unfortunately, in most of the cases, vaccines are underproduced because it's not that profitable. Okay, next, externalities. Externalities also leads to either overproduction or underproduction, overconsumption or underconsumption. What do you mean by externality? Consumption or production not only affects consumer and producer, but also affects a third person who is no way concerned with the transaction. Unfortunately, the effect on third person, apart from consumer and producer, the effect on third person is no way shown in the price of the good. Since it is outside or not covered in price of the good, it is called as externality. Once again, I'm repeating it, okay? Whatever the good is consumed or produced, it will not only affect consumer and producer, it will also affect the third party. See, whatever the good that we are producing or consuming, if it affects only consumer and producer, not a big deal. But unfortunately, it will not only affect these two people, but also affects the third party. There is nothing but society. Okay. So if I'm buying a car, whatever the pollution is caused by the car is not only affecting producer and consumer but also the third party. Okay, so this effect on third party or society or neighborhood is not shown in the price of the good. It is excluded from the price of the good. Since it is excluded from the price of the good, it is called as externality. And the last one is imperfect information. What do you mean by imperfect information? Okay, not last one. We have some more points. Imperfect information. When complete information is not available either with the producer or consumer, it may lead to irrational decision making. Okay, either the consumer may overconsume it or underconsume it. Either producer may overproduce it or underproduce it. Okay, so if optimum amount of information is not available with both the parties, then obviously it will lead to irrational decision making. Next, inequalities in income, inequalities in distribution of income and wealth. Definitely, when there is inequality in distribution of income, and automatic purchasing power will be affected. So it may not lead to optimum production of goods and services. Next, factor mobility causes unemployment inefficiency. See, there are factors, but they're not willing to move from one place to another place. So in some places there is overutilization, in some places there is underutilization. Next, common property resources. That means resources which are owned by everyone. That means anyone can use those goods. So most of these goods are free goods. That means you can use these goods for free. When goods are for free, automatically it will lead to overconsumption, overutilization, and will lead to exhaustion of resources, wasteful usage. Okay. So these are the reasons for market failure. The role of government in resource allocation. So what sort of role government has to play when it comes to resource allocation? Why the government has to play? Okay, so basically role of government resource allocation means why the government has to take up this resource allocation function. To improve economic performance through its expenditure and tax policies. See, if resources are optimally utilized, automatically it will improve the economic performance of the country. That's why government has to take up this resource allocation function. The second point is to determine what and who will be taxed, to determine what and who will be taxed and how these taxes will be spent. See, why the government has to take up this resource allocation function? Because it can decide which section of society is to be taxed at higher percentage and on what goods the government has to impose higher percentage. Okay. Next, provision of optimum mix of both public goods as well as merit goods. As these two goods are basically underproduced, government will decide to what extent these goods are to be provided in the society. Optimum mix. Okay. Resource allocation, reallocation of society's resources from private use to public use. So if there is no government, some goods will be restricted only for the private use. That means it will not be accessible to everyone in the society. So if government intervenes, it can make sure that even these goods or resources are available to the rest of the society who can't afford it. Okay, this is called as reallocation of society's resources from private use to public use. For example, if government is not there, farmers and below poverty line people may not be able to afford electricity. Since government is there, it is making sure that farmers are getting some sort of electricity. Okay, that means basically government is diverting resources from private to public use. Okay, so what are the instruments available to the government to carry out this resource allocation in the economy? Government may directly produce goods. Government, instead of depending on private sector, may directly produce goods on its own. Government may influence private allocation through incentives and disincentives. That means government may declare taxes, impose taxes, and give subsidies to affect the production carried out by private sector. Government may influence allocation in industry and commerce through its competition policies. So government may frame different policies. And with the help of these policies, government may influence the performance of the private sector. Government regulatory activities such as licensing, government may impose certain restrictions and frame certain rules and regulations in such a way that it may affect the performance of the private sector. These rules and regulations in the form of either licensing, controls, directives on location of industry. Legal and administrative frameworks and mixture of intermediate techniques. Mixture of intermediate techniques means combination of above mentioned techniques. And how the government can perform the allocative function? The last one is by maximizing social welfare. If there is increase in equality in the society, automatically everyone will demand goods. Everyone demand goods. So keeping this thing in mind, producer will produce goods. Okay, so as the social welfare increases, income of everyone will increase. When everyone has income, that means not only the rich but also poor has the income, then optimum amount of goods will be produced. Okay, government failure in allocation of resources. What do you mean by that? See, sometimes government is there to rectify the problem. Government is there to rectify any sort of inefficiency in resource allocation. But sometimes instead of solving the problem, government will create a new problem. In such a case, it is called as government failure. Now, if this government failure, if this problem is only restricted to wastage of resources, it is less serious. But this problem is not only leading to wastage of resources, but also causing adverse effect on the welfare of the people. It is a serious effect. Okay, the same thing is given here. Instead of eliminating market distortions or market problems, sometimes government intervention will generate market failure. It is there to solve the problems, but instead of solving the problems, it is generating the problem. Okay, it is causing the problem. This is called as market failure. It occurs when the government intervention in the market creates inefficiency. Government is there to solve inefficiency, but it is the one which is creating inefficiency. This leads to misallocation of resources, leads to market failure. Now, if it is only restricted to wastage of resources, it is less serious. Okay, but it is not only leading to wastage of resources, but affecting the welfare of society also. It is more serious. It is more serious. Okay. So, what are the possible sources of government failure? What are the reasons for government failure? Inadequate information. Government may not have proper information regarding what are the causes for problems, etc. Okay. Political self-interest. Government is always only concerned about its own interest. Conflicting objectives. Government has to look into multiple objectives. Okay. Sometimes these objectives are not compatible. They conflict with one another. Bureaucracy, corruption, and red tapeism. High administrative costs involved in government intervention. If you take cost benefit analysis, government feels that the cost is more than the benefit that they are getting from that intervention. Okay, so these are the reasons for possible sources of government failure. Conclusion: government should identify and evaluate the inefficiencies that result from market failure and potential inefficiencies associated with the deliberate government policies framework to readdress market failures. So government should not only look into the present problems, but it should also try to estimate what sort of problems they may face because of so and so policy. If all these things are there, properly planned out, then they can take appropriate steps and they can avoid government failures. Okay. Next, so with this we have completed allocative function, right? Now distributive function. What do you mean by distributive function? It is related to basic question: for whom should economy produce goods and services? It says, see, resources are scarce. Since resources are scarce, we can't produce whatever the goods required by everyone in the society. So government has to decide to whom what goods are to be produced and for whom these goods are to be produced, in what way these goods are to be distributed. Okay, so basically distributive function is all about distributing goods in the society in such a way that at least there is some sort of equality. The distributive function of the government aims at redistribution of income to achieve equitable distribution of output. If income is equal distributed, automatically everyone will demand equally. When everyone is demanding equally, all sort of goods will be produced in an equal or proportionate manner. So first, the government should focus on redistributing income equally. There is collecting from the rich and giving to the poor. In this way, a government will transfer money from rich to the poor. Income of poor also increases. They will also demand goods and services. So companies not only produce luxury goods, but also they produce necessaries and comforts. Okay. Next, providing equality in income, wealth, and opportunities. Next, advancing the well-being of members and providing security for those having hardships. Hardships means difficulties here. Okay. Point number B example is job reservations. Okay. Advancing well-being means improving the welfare, improving the standard of living of members. Okay. Advancing the well-being of members means improving the standard. Okay. And it will make sure that everyone should enjoy a minimum standard of living. Here, advancing means improving, the well-being means welfare, and government will make sure that everyone is enjoying a minimum standard of living. That means at least they should be above poverty line. Okay. So examples of redistribution function performed by government. Okay, or role of fiscal policy in reduction of inequalities. So how the government will take up this distribution function? See, above we have learned why the government has to take up. Okay. So what are its objectives? Now below we are going to learn about the instruments available to the government with the help of which it will take up the redistribution function. Okay. So first one is to public revenue. Progressive taxation. We all know what is progressive taxation. As the income increases, percentage of tax also increases. Okay. On the rich is combined with provision of subsidies to the poor households. So government will impose higher taxes on the rich and it will give subsidies to the poor. Indirect taxes are differential. Differential means what? Higher amount of tax is charged on the luxuries and lower or no tax is charged on the necessaries. Okay. So in this way, what government is making sure? It is making sure that it is collecting more and more tax from the rich section of the society. either directly or indirectly. Now, whatever the tax it has collected in that form, it needs to spend, and it will spend on the poorer section of society. How, sir? Through public expenditure, that is employment reservation and poverty elevation programs. Is nothing but employment reservation and poverty elevation programs. So government will take up several welfare programs whereby it will try to increase the income of the people. It will try to provide income employment to those section of society with the help of transfer payments. We all know what is transfer payments. Okay. Next, special schemes for backward areas and for the vulnerable section of the society. Land reforms, gender sensitive budgeting. That means women centric budgeting. Example for gender sensitive budgeting is women centric budgeting. So if the welfare of women increases, definitely it will have a very positive impact on the society. Okay, both economically as well as non-economically. That is called, such kind of policy making is called as gender sensitive budgeting. Okay, focusing more on the women section of society. Okay, next, free and subsidized education, healthcare system, pensions, etc. to people living below poverty line. Next, strengthening of human capital and enhancing employability. Basically, government implementing different schemes to improve the skill level of people. Pradhan Mantri Kaushal Vikas Yojana is one such example. Okay, combating against black economy and market distortions associated with parallel black economy. So government should make sure that it is able to restrict black markets. Okay. Now, case study. Comment on greater equity can be achieved through high rates of taxes on the rich. See, there is a notion that in order to achieve equality, government should impose higher taxes on the rich, and whatever the money it is collected from the rich, it should use it to, I should give it to the poor. In this way, we can reduce inequalities. So theoretically, it may be correct, but practically, it is very, very difficult to achieve it in this manner. Okay. See, what is the reason for that? The explanation is given here that high rates of taxes basically discourage rich from taking risk and doing business. Okay, because when it comes to entrepreneur class, most of those people are, almost all of them are rich, right? So if the government is imposing very high tax on the rich, basically what they will do is that they will stop taking any sort of risk, because they know that whatever the amount of money they might earn, most of that will be taken away in the form of taxes by the government, right? So those people will feel that why to take risk and why to pay that kind of taxes to the government. So they will not be able to take any sort of risk. Because of that, what will happen? Investment decreases, production decreases, employment decreases, income of people also decreases. See, government is taking this step to reduce inequalities. But when the production decreases, income decreases, basically inequalities increases. And when the income decreases, the tax amount collected by the government also decreases. So it has taken the step to increase the tax revenue, but what happened? The tax revenue has decreased. So forget about the new welfare schemes. Government may not be in a position to take up the existing schemes. So basically, these two are conflicting objectives. Okay, equity and efficiency. So government has to try to maintain a balance between these two. So whatever the things we may learn theoretically, they may not be applicable as it is in practical life. Okay. So government needs to maintain balance between the two. So with this, we have completed a distribution function. Concept 4 is stabilization function. So stabilization function. What do you mean by stabilization function? Economic crisis of 2008 and recent global phenomenon of COVID pandemic encourage economic crisis. The question cut cheseyandi. I mean to say concept 4 ఏదో చెప్పానో అది కట్ చేసేనా. Concept 4, stabilization function of government. Economic crisis of 2008 and recent global phenomenon of COVID pandemic induced economic crisis have highlighted the importance of macroeconomic stability. Basically highlighted the role of government, how government can play a very important role to maintain stability in an economy. Just imagine, forget about 2008-2000 crisis. During COVID, if governments throughout the world did not act appropriately, then we would not have come out of the crisis this easily. Okay, just in a matter of 2 years or 2.5 years, we came out of crisis, right? So all because of the active role played by governments throughout the world. Okay, so such kind of situations which are occurring regularly for every 10 years or 15 years or 20 years, either economic or non-economic, okay, increase the role of government in an economy. So basis for stabilization function of government. Business cycles are natural phenomena in economy and occur periodically. So economy will not be stable every time. So sometimes there will be boom and sometimes there will be slump. Okay. And market mechanism can neither prevent nor resolve the fluctuations caused by business cycles. That's why government has to intervene. Market mechanism, we are talking about private sector. Okay. So stabilization function of government can influence the performance of aggregate economy in terms of. So when it comes to stabilization, what are the aspects government will look into? Labor, employment, capital utilization, utilization of resources, both labor and capital are resources, right? So optimum utilization. Overall output and income. Okay, general price level, inflation, balance of international payments, receipts and payments of the country, the rate of economic growth, at what rate we are growing. Next, effects on instability in the absence of government intervention. If there is no government intervention, what sort of effect it will have on stabilization? Whether the economy will be in stability or instability. It will be instability, and moreover, the problems may aggravate and situations may become severe. It is what it is explained here. Instabilities may be prolonged for a long time if government does not intervene. The instabilities will prolong for a long period of time. It will affect everyone in the society, especially the poorer section of society. Stagflation. What do you mean by stagflation? Combination of two things, stagnation and inflation. On one hand, the unemployment is very, very high. On the other hand, the price of the goods is also very, very high. It's a worst case scenario. And it makes the problem more complicated. On one hand, you don't have any job. On the other hand, the price of goods is very, very high. It's a worst thing to happen. Okay, so the problem becomes more complicated and leads to contagion effect. We are living in a globalized economy, right? So if one country starts suffering from one particular effect, automatically it spreads to other countries also. So a national issue very soon will become international issue. That is called as contagion effect. Okay, so if government does not intervene, everyone will start suffering from these issues. So what are the two major components in stabilizing the economy? Government will either focus on microeconomic policies or macroeconomic policies, depending on situation. Okay, so an overall effect by balancing government expenditure, public revenue. This is nothing but macroeconomic policy. And if government feels that only by affecting one particular sector we can bring stability in the economy, it will take up microeconomic policies. Okay, so the same thing is explained below. Fiscal policy can influence performance of macroeconomy in terms of employment, price stability, economic growth, and external balance. Okay. So when we are in expansion phase, what is the problem we face? Inflation. And when contraction phase, what is the problem we face? Recession. Let us see the expansion phase. Okay. When it comes to expansion phase, generally the problem that we face is inflation. Why we are facing this problem? Because the amount of money in the economy is very, very high. So government has certain instruments to reduce the income in the economy. When the income decreases, demand decreases, and inflation also decreases. So what are the instruments available with the government? Taxes, government expenditure, public debt. Public debt means borrowings of government. Okay, borrowings by government. And budget. We all know what is budget. Okay, it's a statement of public revenue and public expenditure. So during expansion phase, government may either increase taxes or reduce government expenditure or borrow from public or may prepare a surplus budget. Surplus budget means public revenue is greater than public expenditure. Nothing but taxes will be higher than government spending. Okay. So by doing this, what will happen? The amount of money in economy decreases. So whatever the policy taken by the government is called as contractionary fiscal policy. So basically, contractionary fiscal policy is taken in expansion phase. And when it comes to contraction phase, they suffer from recession. Recession means what? Recession means lack of production. Why we are suffering from lack of production? Because the availability of money is very, very less. In such a case, government will reduce taxes or increase government expenditure or repays the public. Whatever the amount it has borrowed, it will repay the public. Basically, it will prepare a deficit budget. Because of this, what will happen? The amount of money in an economy increases. And such kind of, when the income increases, demand increases, production also increases. So basically, government will take expansionary fiscal policy during contraction phase. Right. The next chapter is fiscal policy. Okay, so what do you mean by fiscal policy? The policy that is taken by the government is called as fiscal policy. Okay, so in simple terms, let us understand what is meant by fiscal policy and what are its objectives. Okay, so fiscal policy involves use of instruments like government spending, taxation, and borrowings to achieve an objective. What is that objective? To influence both the patterns of economic activity, that is level of aggregate demand, output, and employment. Okay, so in order to influence these variables, whatever the instruments that are at disposal of the government, all these things are detailedly mentioned, how to use them and when to use them. That is called as fiscal policy. Now coming back to objectives of fiscal policy. Fiscal policy differs from country to country because objectives of countries differ from one another, right? So when the objectives differ, automatically policy will also differ. But there are some common objectives. There are some objectives which are common for every country. What is it? Achievement of full employment. That is full employment of resources. Next, price stability, control of inflation, acceleration of economic growth, rapid economic growth, and equitable distribution of income and wealth. Okay. These objectives are not always compatible. That means when there are multiple objectives, definitely there will be some conflict between set of objectives. For example, if we're focusing on economic development, definitely there will be effect on equitable distribution of income and wealth. Okay, so these two are conflicting objectives one another. So government has to maintain a balance between these two. Now, concept two: what are the instruments of fiscal policy? The opinion of Keynes school is that either inflation or recession, fiscal policy have powerful effect in altering aggregate demand, employment, and output in the economy through its instruments, whether we are in expansion or in contraction. Government, with the help of these instruments, government with the help of fiscal policy and the instruments available to it, can have a significant effect on employment, output, and other variables. So instruments of fiscal policy are government expenditure, taxes, public debt. Public debt means borrowings by government, and government budget. So let us see government expenditure first. See, government expenditure of three types basically: current expenditure, capital expenditure, transfer payments. The expenditure that is incurred on day-to-day activities or for the working of a department is called as current expenditure. The expenditure that is incurred on construction activities or infrastructure activities, that is called as capital expenditure. And whatever the amount of money government is spending through welfare schemes comes under transfer payments. Okay. The role of government expenditure as an instrument of fiscal policy. First one, direct impact of government expenditure generates direct impact. Basically, government expenditure has a direct impact. Okay. In what ways? When there is increase in government expenditure, definitely income of the people will increase in the form of transfer payments, and it will have an indirect impact. Indirect impact means we're talking about multiplier effect. If the government invests in one particular sector, income not only in that sector increases, but also it will get transmitted, that effect get transmitted to other sectors also. Okay. Next, government expenditure in rectifying inflation. Government expenditure will be reduced. It reduces income and excess. See, when during inflation, what the government will do, it will reduce the expenditure. When the government expenditure decreases, automatic income of the people decreases, and excess demand also decreases. Now, government expenditure in rectifying recession. During recession, government will increase the expenditure. How, sir? By taking up several infrastructure projects. It is nothing but initiating fresh public bus. This will increase the income of people. When income increases, demand increases, it will lead to expansion of economy or expansion in production. Okay. Now coming back to government expenditure in rectifying depression, how the government will rectify depression. When it comes to depression, government expenditure can be classified into two types. One is pump priming, and the one is compensatory spending. Now, what do you mean by pump priming? Basically, in pump priming is a technical word. So basically, it's nothing but servicing a pump. Okay, priming means servicing, pump means machinery. Okay. Right. The same concept is applied here also. When the economy is in some sort of trouble, that is in recession or depression, okay, what the government will do, it will invest a small amount of money in one particular sector. It will pump a small amount of money in one particular sector and hope that private sector will take up the further investment. So it involves one short injection or one-time investment of government expenditure into depressed economy with the aim of boosting business confidence and encouraging large private investment. So what is the objective of the government? If I invest a certain amount of money in an economy, it will initiate the economic process, and the remaining things will be taken up by the private sector. So basically, government is focusing on multiplier effect. It's a temporary fiscal stimulus in order to start the multiplier process. If temporary injection of purchasing power into the economy through a rise in general expenditure is financed by borrowing rather than taxes. See, already we are in depression. So government needs to increase the spending. So in order to increase the spending, it has to collect money, right? So now to collect money, government cannot depend on taxes because people don't have any money. If you even impose high taxes, people will not be in a position to pay any sort of money. So in order to fund its government expenditure, government should depend on borrowings rather than on taxes. Now coming back to compensatory spending. Even after investing a certain amount of money in one particular sector, if private sector is not showing any sort of interest, then there is no option for the government but to invest the entire amount of investment which private sector needs to invest. So when government spending is carried out with the intention to compensate for the deficiency in private investment, if there is shortage of investment or no investment by private sector, then it's up to the government to invest the entire money into the economy. Okay, so this is called as compensatory spending. Now coming back to taxes, most important sources of revenue from government. Okay, so for government, one of the most important sources of revenue is taxes. So during inflation, how the taxes will act, and during recession, depression, how the taxes will act. New taxes can be levied or existing taxes are raised to reduce disposable income. So when the government imposes taxes, what will happen? Increases taxes. In expansion phase, government will increase the taxes. When taxes increases, disposable income of the people decreases. When disposable income decreases, demand also decreases. Okay. Now, government needs to be cautious when it comes to imposing excess taxes, because if the government imposes taxes more than required, then it will have a negative impact on investment. Okay. Next, during recession and depression, government will reduce the taxes. Because of this, the income of the people will increase. The disposable income of people will increase. When the disposable income of people increases, demand also increases, production also increases. So this is the impact of taxes during recession and depression. Now, coming back to public debt. So public debt or public borrowing. So that what is meant by public debt or public borrowing? It's nothing but total past deficits minus total past surpluses. Now, forms of public debt, we have internal debt, we have external debt. External debt means borrowing from World Bank or IMF or some international organization. Now, coming back to internal debt means what? Internal debt means borrowing from own people in the country. It can be done in two ways. One is market loans and the one is small savings. Market loans means borrowing long-term funds and huge amount of money from the market. Small savings is borrowing from people through issue of national savings certificate and national development certificate. The role of public debt as an instrument of fiscal policy. During inflation, since people have more money, government is to reduce the money. So what government will do? It will borrow from the public. And during recession, whatever the amount it has borrowed earlier during inflation, now it will repay that money. So during recession, by repaying the debt, government will increase the money. Government will increase the money in an economy. So automatically, demand increases, production also increases. So these are the instruments which the government will use. The last instrument is budget. No, when it comes to budget, is nothing but statement of revenue earned and expenditures of the government in any year. So we have three types of budget. One is balanced budget, second one is surplus budget, and the third one is a deficit budget. Now coming back to balanced budget. Balanced budget means here revenue, public revenue is equal to public expenditure. Nothing but taxes is equal to government expenditure. So it will have no effect on the aggregate economy and prices will be stable. Okay. Now coming back to surplus budget. Surplus budget is taken during expansion phase. So what do you mean by surplus budget? Total revenue is greater than total expenditure. Nothing but taxes will be higher and government expenditure will be lower. So it will reduce when taxes increases and government expenditure decreases. The income of the people will decrease. When income of the people is decrease. When income of people is decreasing, automatically decrease the demand. So there will be negative effect on demand when this budget is taken during inflation phase. So what is the effect of the surplus budget? Since government has more amount of money, it can repay its debt, right? So reduces national debt. Now, deficit budget means public revenue is less than public expenditure. Nothing but taxes will be low and government expenditure will be high. Because of this, income of the people increases and it will have a positive impact on demand. That means demand decreases. Such kind of policies taken during deflation or recession phase. What it will have on effect? What sort of effect it will have on the economy? Basically, it adds to the national debt. Okay. Now, some additional information is given. You can go through that additional information. There is every possibility that he may ask a problem on this additional information. So, what is revenue deficit? So what is revenue deficit? What is budget deficit? Okay, what is fiscal deficit and what is primary deficit? This is an additional information. Okay, next. So instrument multiplier of fiscal policy. So when it comes to fiscal policy, what are the different multipliers we talk about? First one, we talk about the government spending multiplier, which can also be called as spending multiplier, Keynesian multiplier, fiscal policy multiplier. It represents the multiple by which change in GDP in response to change in government expenditure and investment. That means whenever there is change in government expenditure and investment, there will be greater change in GDP or national income. This greater change is nothing but multiplier. How we can represent the same? Okay, first of all, there is an inverse relationship between MPS and multiplier. Okay, we have already seen it in Keynesian theory. Okay, now how to write government spending multiplier? See, government spending multiplier, investment multiplier almost one the same. Only denomination will change. Okay, when it comes to government spending multiplier, the formula is delta y by delta g equal to 1 by MPS. Nothing but 1 by 1 minus MPC equal to 1 by 1 minus B. Okay, now coming back to tax multiplier, it represents the multiple by which GDP increases in response to the decrease in taxes. So there is an inverse relationship between taxes and GDP, nothing but income. We all know that. If the government increases the tax, there will be decrease in GDP. If the government decreases the tax, there will be increase in GDP. So there is an inverse relationship. We have taken one particular assumption here. Here, tax will affect consumption alone. It will not affect any other variable. So when it comes to simple tax multiplier, what is the formula? Minus MPC by 1 minus MPC by MPS. Why we have mentioned minus symbol? Because when there is increase in taxes, to that extent, consumption decreases, right? So the same thing can be operated like this. A balanced budget multiplier means what? The government budget is said to be balanced when change in government expenditure is equal to change in taxes. So the balanced budget multiplier is always equal to 1 as a sum of government spending multiplier and tax multiplier. So when you sum up government spending multiplier and tax multiplier, the balanced budget multiplier will be equal to 1. So balance budget multiplier equal delta y by delta g plus delta y by delta y t, sorry, delta y by delta d equal to 1. So how we got 1? You can clearly see in the material. Okay, next types of fiscal policy. Basically, we have two types of fiscal policy. One is non-discretionary fiscal policy or automatic stabilizer. Second one is discretionary fiscal policy. Now, discretionary fiscal policy is again divided into expansionary fiscal policy and contractionary fiscal policy. Now, what do you mean by discretionary fiscal policy and non-discretionary fiscal policy? Let us understand first non-discretionary fiscal policy because it's the most common thing. If this non-discretionary fiscal policy fails to stabilize the market, then we will go through discretionary fiscal policy. Okay. So, what do you mean by non-discretionary fiscal policy or automatic stabilizers? These are built-in fiscal mechanism that operate automatically. That means these policies are already there in the economy. The government have assumed that such kind of problems, that there is possibility that we may face such kind of problems or so and so problem. The government is anticipating well in advance what sort of problems they may face, and keeping those problems in mind, government has come up with different policies. So these are built-in fiscal mechanism that operates automatically to reduce the expansion contraction of the business cycle. So they are there in the economy, and if things happen as expected, these policies will activate automatically and stabilize the market. Examples for non-discretionary fiscal policy or automatic stabilizers are personal income taxes, corporate taxes, and transfer payments. Example for them is progressive taxation. If the income increases, we will be paying higher taxes, and if the income decreases, we will be paying lower taxes. So already we have progressive tax system, right? So there is no need for government to again take up a separate policy to adjust the income or stabilize the income. Okay. Now, when this non-discretionary fiscal policy fails, we need to go to discretionary fiscal policy. What do you mean by discretionary fiscal policy? Discretionary means deliberate, willful action. So deliberate policy action by government to change the level of expenditure and taxes to influence the level of national output. So when non-discretionary fiscal policy fails to act, then government has to deliberately take a policy whereby it will try to use its instruments to affect the national output, employment, and prices. See, during COVID times, normal budget failed to stabilize the market. So government has to take a policy out of the budget or apart from the budget. Okay. So expansionary fiscal policy and contractionary fiscal policy are used to cut fluctuations. The first one, non-discretionary fiscal policy or automatic stabilizers. What do you mean by that? Any government program automatically reduces fluctuations in GDP is called as automatic stabilizer. So example for that one is personal taxes, corporate taxes, transfer payments are important automatic stabilizers. So these instruments will try to stabilize the economy. Role of automatic stabilizers during inflation. During inflation, the economy expands, employment and income rises, leading to higher tax payments. Okay. So when income increases, automatically we will be paying higher taxes. And when already people are earning more, there is no need for government to spend more money, right? So government expenditure gets decreased. Automatic transfer payments also decreases. Thus, rise in taxes and fall in government expenditure will lead to less disposable income, demand decreases, inflation also control. So conclusion. Automatic stabilizers work through limiting the increase. So what does automatic stabilizers do? They will make sure that income does not increase any further during expansion phase. Already income is high, so it will make sure that income does not increase any further during expansion phase. Now, opposite will happen during recessionary phase. The role of automatic stabilizers during recession. During recession, incomes are reduced, leading to lower tax payments. During recessions, incomes are reduced, leading to, so during recession, people income decreases, right? When income decreases, we will be paying lower taxes. When income of the people decreases, government expenditure in the form of transfer payments increases. So on one hand, taxes have decreased. On other hand, transfer payments have increased. So altogether, disposable income of the people increases. When income increases, demand increases, consumption increases, production also increases. So conclusion, what is the conclusion? Just like automatic stabilizers during expansion phase, during recessionary phase, automatic stabilizers will make sure that our income does not fall any further. Already income is low. It will make sure that income does not fall any further. Okay, right. So effects of automatic stabilizer on multiplier when GDP increases. See, if there is automatic stabilizer, then multiplier would be less than what it should be. If there are no taxes, then the multiplier will be very, very high. But if there are taxes, what happens at each level, whatever the people earn out of that income, they have to pay certain amount of tax. When taxes are there, automatic disposable income decreases, demand also decreases. So multiplier will be there, but it will be less than what it should be. So the automatic stabilizers will reduce the size of multiplier. Example, as GDP increases, automatic stabilizer reduce the increase in spending in each round of multiplier, making it less final increase in GDP. Okay, that means there will multiplier, but it will be smaller than what it would have been. If there are no taxes, whatever the amount we have earned, we might spend that entire money, right? But if there are taxes, first we need to pay taxes, only balance will be used for spending. So certain amount is reduced in the form of taxes. So automatically your demand decreases to a certain extent and multiplier also decreases to a certain extent. Okay. So that is the point that we need to remember here. Next, role of expansionary fiscal policy to eliminate recessionary gap. In what way expansionary fiscal policy will act in reducing recessionary gap? See, recessionary gap, generally we suffer from recessionary gap during contraction phase, right? So what is recessionary gap? Actual demand is less than what it should be. When actual demand is less than what it should be, it will lead to underproduction. When actual demand is less than what it should be, it will lead to underproduction. When there is underproduction, it leads to recessionary gap. Now, what the government has to do, it has to increase the production. So, classical economists came up with one set of opinion, and modern economist Keynes gave a different explanation. What classical economists said is that they completely focus on supply side of economics. See, recession means there is underproduction, right? When there is underproduction, there will be unemployment. When there is unemployment, what classical economists have assumed is that if there is unemployment, if there is higher unemployment, when the production decreases, unemployment increases. When there is higher unemployment, workers will be willing to work for lower wages. That is a kind of assumption taken by classical economists. When workers are willing to work for lower wages, automatically cost of production decreases, profits increases, production also increases. So in this way, we can overcome recessionary gap. This expression was given by classical economists. They completely focus on supply. But Keynes objected to the explanation given by classical economists. What Keynes objected is that, see, whatever the concept that was given by classical economists is correct theoretically. What they said, since workers are willing to work for lower wages, cost of production decreases, profits increases, production also increases. But what sort of goods are to be produced? We are simply stating that cost of production decreases, profits increases, and production should also increase. That what sort of goods production should increase? That means we should not forget one basic principle. Production depends on demand, right? So whatever the goods that are demanded high, those goods will be produced more. But in classical economist explanation, they completely ignored the fact that they completely ignored the demand aspect. So Keynes took that into consideration. So what Keynes has said is that, see, during recession phase, if government increases the income of people through transfer payments and reduces taxes, automatically disposable income of people will increase. When the disposable income of people increases, demand increases. Basing on this demand, companies will produce goods. So automatic production will also increase. In this way, we can come out of recession. That is what given by Keynes. Okay, now role of contraction of fiscal policy in combating inflation. See, inflation generally we suffer from inflation in expansion phase. What is the basic feature of expansion phase? Income is high. When income is high, automatically we demand more. That means we will demand more than what we should be demanding. So actual demand is more than demand at full employment level. Okay, so when demand is more than what we should be demanding, automatically prices of the goods will increase. Sir, why can't we increase output? Because already we are producing at full employment level. We can't produce beyond that. Resources are fully utilized. So whatever the output that we are producing, there is the maximum level of output. So why is the maximum amount of output or maximum quantity of output that we can produce? Now, because of increase in demand from AD1 to AD2, okay, the price of the goods have increased at that output. So this Y will become real GDP and this Y1 will become nominal GDP. This increase is only in terms of price but not in terms of quantity. Okay, so that is called as inflationary gap. That is called as inflationary gap. When there is inflationary gap, what Keynes is saying is that the only thing that the government should do is that reduce the government expenditure and increase the taxes. When taxes increases and government expenditure decreases, income of people will decrease. When income of people decreases, demand decreases. That means we will move from AD2 to AD1. AD2 to AD1. So in this way, when we move from AD2 to AD1, automatically we will move from Y1 to Y. So we can control the inflationary gap. Okay. So concept 4, that is last concept. What are the limitations of discretionary fiscal policy? Recognition. What are the problems that we face when it comes to discretionary fiscal policy? See, the first problem that we face is recognition lag. Lag means delay basically. Government fails to recognize the problem in time. When there is failure in recognizing problem in time, automatically there will be failure in decision making, there will be failure in implementing a decision that is taken, and obviously there will be failure in feeling the impact of the decision that we have implemented. Okay, so all these are the problems. Now, fifth problem is it is practically difficult to reduce government spending on various items such as defense, social security. Theoretically, we can say that in expansion phase, government needs to reduce the expenditure. But in reality, it is very, very difficult to reduce the expenditure. Okay, even when we are in expansion phase, because these expenditures are very, very essential and they are very, very urgent. Next, what supply side economists are saying is that Fiscal measures also cause disincentive. For example, if the government is increasing taxes, it may act as disincentive on the part of investors to invest. So when the investment decreases, production also decreases. So this is what supply side of economists are arguing. Government may have instruments, but if we keep on using these instruments, it may act as an disincentive to investors. Okay. And the last one is crowding out effect. Sir, what do you mean by crowding out effect, sir? Crowding out effect may generate when money from private sector is crowded out to public sector. See, funds, availability of funds are very scarce in an economy, very limited in economy. Already private sector is competing for those limited amount of funds. Along with private sector, if government sector also starts competing for those funds, demand for funds increases. When demand for funds increases, automatic interest rate also increases. Now, government can pay any rate of interest, but unfortunately, private sector cannot afford high rate of interest, because if the interest rate increases, profit margins decreases. So slowly what will happen, private sector will not be willing to borrow money from the market because interest rates are very high. So funds will move from private sector to public sector. So because of this, it will lead to shortage of funds with private sector. When there is shortage of funds with private sector, what will happen? Investment decreases, production decreases, and slowly private sector will exit from the market. See, that is what we say. Government should act as complementary to private sector. It should not compete with private sector. If the government start competing with private sector will not survive in the market. It will be pushed out of the market. This pushing out of the market is called as crowded out. This pushing out of the market is called as crowded out. The same thing is explained here. So impact of crowding out effect is also given. You can go through that. You can understand it easily. So basically, when there is scarcity of resources, there will be competition. When there is competition, only one party will survive, other party will be kicked out of the market. This kicked out of the market or pushing out of the market is called as crowd out. Here we are talking about competition between government and private based for resources which are scarce. Okay. Next, we have demand side policy and supply side policy. What is the difference between the two? If you want to affect the economy within a short period of time, we use demand side policy. Long term, supply side policy. Basically, if demand side policy fails to affect the or stabilize the economy, we will use supply side policy. So demand side policy, as the name suggests, it manages aggregate demand. It will try to increase the demand recession, reduce the demand in inflation. When it comes to supply side policy, it will increase aggregate supply in long run and increase demand to ensure. So basically, when it comes to supply side policy, it will try to increase supply, whereby by increasing supply, it will try to increase the demand. So how, sir? When supply increases, automatically that means there is increase in production, right? So income increases, demand also increases. So expansionary fiscal policy is in case of recession, and contraction fiscal policy in case of inflation are examples of demand-side fiscal policy, where these two policies will try to affect the demand of products. Okay. Government spending on infrastructure, education, research and development, tax incentives for innovation, entrepreneurship are the examples of supply side fiscal policy. Okay. The next chapter is theories of international trade. So in this chapter, we are going to learn in what way international trade is much better than or superior to internal trade. Okay. The first, in explaining these advantages, several economists came up with several theories. The first one is mercantilism. So explain the mercantilist view of international trade. What do you mean by mercantilist view of international trade? So this policy was followed by great European powers during 17th century and 18th century. What does it mean? So it simply means this theory is based on zero-sum game. What does it mean? One country's benefit is equal to other country. One country's gain is equal to other country's loss. That means basically the exporting country will be benefited at the expense of importing country. Okay, that means only one country is benefited here. So more gold and silver a country accumulates, richer it becomes. National wealth automatically increases and power also increases. That is the concept they followed now. In order to increase gold and silver, what this country started doing, what this powerful European country started doing, they started exporting goods and services. In return of goods and services, they started accumulating, they started taking precious metals. Okay. So maximizing exports to earn more precious metals and minimizing imports by imposing high tariffs. Okay. So trade is a zero-sum game basically. One country's gain is equal to other country's loss. That is what we said. Okay, that was a concept followed by most of the countries, and according to them, this was the theory for international trade. In order to increase our wealth, we have to export more. Okay, and in this concept, only exporting country is getting benefited at the expense of importing country. But later on, economists, what they said is that international trade means both the countries should be benefited, right? Not only exporting country, but importing country should also be benefited. So keeping this thing in mind, different economists came up with different theories. The first theory was given by Adam Smith. The theory is called as theory of absolute advantage. Okay, what do you mean by theory of absolute cost advantage here? Adam Smith supported unrestricted trade, as trade is not a zero-sum game. He is the first economist who tried to prove that trade is not a zero-sum game. That means it should be beneficial for both the parties, mutually beneficial for both the parties. So what are the assumptions taken to explain his theory? Nations should differ in their ability to produce goods. That means the ability of countries will differ from one another. Okay, one country may be efficient in producing one kind of good, another country will be efficient in producing another kind of good. Each country has an absolute advantage in production of one good only. Okay, and countries who specialize in production export of a good in which they have specialization or advantage. Okay, so basically to explain his theory, we have to, the Adam Smith has taken 2 into 2 model, 2 countries, 2 commodities, and one factor. They are only focusing on labor, not on capital. Okay, so he has taken one example here. We are taking 2 countries and 2 commodities, and you can clearly see that country A has absolute advantage in production of wheat because it is able to produce more kgs per hour compared to country B. And country B has absolute advantage in production of cloth because it is able to produce more cloth per hour. Okay. So from the above table, what we can conclude? The same thing that whatever I just said now. Okay. So what Keynes is saying is that since country A has absolute advantage in production of wheat, it should produce and export wheat. And since country B has absolute advantage in production of cloth, it should produce and export cloth. So both countries will be producing 2 different goods and importing the opposite goods. Okay, so that means country A will be exporting wheat and importing cloth, and country B will be exporting cloth and importing wheat. Okay, so by this trade, by doing trade in this way, both the countries will be mutually benefited. How, sir? When country A is exporting 6W for 6C, that means it is exporting 6W to get 6C. Okay, domestically it is getting only 4C, right? So internationally it is getting 2C more. So country A is benefited because it is getting 2C more. But when it comes to country B, okay, domestically in order to get 6W, it has to give 30C. Domestically, in order to get 6W, it has to give 30C. But international trade is giving only 6C to get 6W, right? That means it is saving 24C. That means both the countries are able to save in terms of resources. That means both the countries are benefited. Okay, so this is the concept given by Adam Smith. Yes, it is not appropriate or cut because he's only focusing on one factor and he's taken some vague assumptions. But it paved the path for remaining theories. Okay, let us see the merits and demerits here. A mutually gain are not equal. Yes, gains are not equal for both the countries because some countries specialize in one kind of good, another country specializes in another kind of good. Okay, by specializing and trading freely, global output is maximized. More of the both goods are available to consumers in both the countries. If both the countries specialize and trade, then both cloth and wheat will be produced more in the entire world, and both sets of goods will be available in more quantity for both the countries. Okay, next, demerits. It is too simple model to consider. It does not recognize practical barriers to international trade. Labor is considered as the only factor input. There is a major problem here. It is very simple and we have considered only labor here. We ignored capital completely. It does not consider a situation where one country has absolute advantage. See here what we have taken assumption. One country has absolute advantage in one good, another country has absolute advantage in another good. But what happens if one country has absolute advantage in both the goods, another country has absolute disadvantage in both the goods? Such kind of situations are not covered in this theory. Okay, and basically we are focusing only on the supply side. In the theory, nowhere we have discussed about the demand. Okay, there is a major demerit in theory of absolute cost advantage. To overcome the problem, some problems given in the to overcome. Okay, so to overcome some problems in theory of absolute cost advantage, David Ricardo came up with theory of comparative advantage. So what is theory of comparative advantage in the words of David Ricardo? So here also, just like Adam Smith, he took 2 into 2 model, that is 2 countries and 2 commodities and one factor. Basically focused on one factor. What David Ricardo said is that when the country has absolute advantage in both the goods and another country has absolute disadvantage in both the goods, still they can take part in trade and both the countries will be benefited. How is it possible, sir? When a country has absolute advantage in both the goods, a country should produce and export that good in which its absolute advantage is very, very higher. Okay, that means comparative advantage is higher. And when it comes to other country which has absolute disadvantage in both the goods, that country should produce and export that good in which absolute disadvantage is lower. That means comparative disadvantage is lower. absolute disadvantage is lower. So in this way, both the countries can participate in international trade and both the countries will be benefited. To explain this model, he has taken an example. You can clearly see here, wheat 6 kgs per hour and country B 1 kg per hour, and cloth 4 yards per hour and country B 2 yards per hour. So we can clearly see that country has absolute advantage in both wheat and cloth. But you can see clearly that when it comes to production of wheat, country A is more efficient than production of cloth, because when it comes to production of wheat, country A is 6 times more efficient than country B. And when it comes to production of cloth, country A is only 2 times more efficient than country B. So since the efficiency in production of wheat is more, country A should focus on producing and exporting wheat and importing cloth. When it comes to country B, it is more inefficient in wheat and less inefficient in cloth. So country B should focus on producing, exporting cloth and importing wheat. Okay. So if a country A exports wheat and country B exports cloth, still both the countries will be mutually benefited. The same thing is explained here. Okay. So if country A exports cloth, it will get 2C. But if country A exports wheat, internally it is getting 4 cloth for 6W, right? 6 wheat, right? But if it exports 6W, it is getting 6C. So it is getting 2C more, 2 cloth more, international trade compared to domestic trade, country A. Now coming back to country B. When it comes to country B, within the market, if it wants to get 6 wheat, it has to give 12 cloth. But in international trade, in order to get 6 wheat, it will give only 6 cloth. That means it is able to save 6 cloth here. Okay. So once again, I'm repeating. When it comes to internal trade, in order to get 4C, country A has to give 6W. But in terms of international trade, if it is giving 6W, it is getting 6C. That means it's getting 2C more international trade compared to domestic trade. Coming back to country B. If country B wants 6W, it has to give 12C. But when it comes to international trade, if it wants 6W, it needs to give only 6C. That means country B is also able to save 6C compared to internal trade. That means both the countries are getting benefited, right? So this is called as mutual gainful trade. What is the conclusion here? Based on labor theory of value, which is quite unrealistic, because it is just like theory given by Adam Smith, it is also unrealistic theory, because here we are considering only labor as a factor. That is a main drawback for these theories. Okay. Now coming back to next theory, which is given by Haberler, called a comparative advantage. Here we are focusing on opportunity cost. We are focusing on opportunity cost. So theory of comparative advantage in the words of Haberler. So concepts use opportunity cost. It is a value of foregone options. We all know what is opportunity cost. Opportunity cost may be computed on how much units of one commodity to give up to produce one more unit of another commodity. The nation with lower opportunity cost in the production of a product has a comparative advantage. So basically what Haberler is saying is that country can produce both the goods, but wherever opportunity cost is lower, the country should focus on producing that good and exporting that good, and it should import the other good. If the opportunity cost is lower, it should focus on that good, it should produce that good. And if the opportunity cost is higher, it should import that good. Okay, right. So the same thing is given here. So same table I will take, same table whatever we have taken in above, that is table given by David Ricardo. Okay, right. So you can clearly see that if country A wants to produce wheat, then opportunity cost is 2 by 3 plot. And if country B wants to produce wheat, the opportunity cost is 2C. That means country A has lower opportunity cost compared to country B. So country A has comparative advantage over country B in production of wheat. And when one country has comparative advantage in one good, automatically other country will have comparative advantage in other good. Okay, so this is the point that we need to focus on. So simply stating, if the opportunity cost of production is lower, we should choose that good, produce that good and export that good. Now, what are the limitations here? It emphasizes on the supply condition excludes demand. Just like above theories, we are only focusing on production, what goods are to be produced, but we are forgetting whether there is demand for those goods or not. Okay. The theory does not examine why countries have different cost. No one is saying why these countries have different cost. The theory does not answer the question, why does a nation have comparative advantage in the production of a commodity and comparative disadvantage in production of another commodity. So there are some unanswered questions because of which some economists came up with some other theory. So concept 5, Heckscher-Ohlin theory of trade. So this theory was given by basically Heckscher and Ohlin. Okay. So for the first time in economics, when it comes to explaining international trade, we are considering two sectors. We are considering both the factors. So here we will use 2 into 2 into 2 model. That is 2 countries, 2 commodities, and 2 factors model. Okay. The silent features of the theory. What are the silent features of the theory? Three important features. So Heckscher, basically in this theory, we are going to learn both Heckscher-Ohlin trade theorem and factor price equalization theorem. So what does this theory mean in simple terms? Let me keep it in simple terms, okay, so that you can understand it easily. See, we have 2 countries. In both the countries, we have both the factors, that is labor and capital. But one country is labor abundant, another country is capital abundant. So country which is labor abundant, it should focus on goods which use labor intensive production, and the country which is capital abundant, it should focus on goods which use capital intensive technology. For example, India is a labor abundant country. Okay, and America is a capital abundant country. Now India should focus on shoes, which is a labor intensive good, and USA should focus on laptop, which is a capital intensive good. Okay, India can produce both laptops and shoes, but it should focus on shoes. USA can also produce both laptops and shoes, but it should focus on laptops because capital is more in USA, so it can produce laptops at a cheaper rate compared to India. And when it comes to India, labor is more in India, so it can produce shoes at a cheaper rate compared to USA. Okay, right. So India will be focusing on shoes, and USA will be focusing on laptops. Okay, so when demand for shoes in India increases, automatically resources in laptop industry will move from laptop industry to shoe industry. So when resources are moving from laptop industry to shoe industry, automatically there will change in demand supply of resources. For example, in shoe industry, we basically need 50 labor and we basically need 100 labor and 50 capital. Okay, we need more labor and less capital, right? When it comes to laptop industry, we use, so we have, this is 100 labor. When it comes to laptop industry, we use less labor and more capital. Now, when India is focusing on shoes, producing shoes and exporting shoes, automatically profit in shoes will increase compared to profit in laptops. So slowly resources will move. So that means everyone wants to produce shoes. So resources will move from laptop industry to shoe industry. I can clearly see that required labor is more in shoe industry, but only 50 labor is being released into the market. So that means demand for labor is more than supply of labor. Shoe industry needs 100 labor, but we are getting only 50 labor from laptop industry. So demand for labor is more than supply of labor. When it comes to India, demand for labor is more than supply of labor. When demand for labor is more than supply of labor, automatically wages will increase. Earlier in India, since it's a labor abundant country, wages were less. Now slowly wages are increasing. Next, again, shoe industry needs 50 capital only, but we are getting how many capital here? 100 capital from laptop industry. That means supply of capital is more than demand for capital. Because of this, interest rates will decrease. Earlier, before international trade, since India is a labor abundant country, interest rates were high. Now interest rates have come down. We can clearly see that before international trade, whatever the factor prices were high, now they are decreasing, and whatever the factor prices were low, they are increasing. Because of this, same thing will happen in USA also. So because of all these things, what will happen at the end of the day, factor prices in both the countries will become equal. That means wages in India will be equal to wages in USA, and wages interstate in India will be equal to interstate in USA. When wages in India and USA are equal, interstate in India and USA are equal, then what will happen? Then it does not matter whether you're producing goods in India or USA. That is explained by Heckscher and Ohlin theory. It is also called as factor price equalization theory. Okay. So last theory is new trade theory. So what do you mean by new trade theory? So what does the theory say? Developed in 1970 to understand why developed countries and big countries trade partners. So what does this theory say? Why developed countries and big countries trade partners are when they are trading similar goods and services. So till now what we have studied is that one country will be producing one good, another country will be producing another good. But what economists have found out there, even though we are producing cars, still we are importing cars from other countries. Okay. So when we are producing a good, why we are importing the same kind of good or similar kind of good? Okay, there are two reasons for it. One is economies of scale and the one is network effect. When goods are produced in large quantity, automatically price of those goods decreases. So a country can afford to sell these goods in other countries. So as a firm produces more of a good, its cost per unit decreases and serves domestic as well as foreign market. So by doing so, when the price of the good is less, it can sell not only in the country but also in other countries. So by doing so, it can increase the market size, market access, and earn more profits. Now, what do you mean by network effect? Network effect means what? The way one person value of goods and services is affected by the way of that good or service to others. Okay, network effect means basically bandwagon effect. When more number of people are using one particular good, automatically the value of that good increases. So no need to struggle hard to publicize that good, because when more number of people are using that good, automatically people will come to know about that good and will start using that good. That is called a network effect. Nothing but we are talking about brand value here. These are the two reasons. Because of this, there is movement of goods from one country to another country. This was given by modern economists. Okay. So what are the arguments of new trade theory? Because of large economies of scale network effect, exports of a country increases more. Countries with advantage will dominate the market and form monopolistic competition. Okay. So what are the difference between theory of comparative advantage and modern theory that is given here? Okay. So the basic difference between country is compared to cost when it comes to theory of comparative cost. And when it comes to modern theory, explains the causes of difference between comparative cost as well as here modern theory means so concept 7. Concept 7 Concept 7. Compare the theory of comparative cost and modern theory. Here modern theory means we're talking about Heckscher and Ohlin theory. Heckscher and Ohlin theory. Okay. Right. The difference between the two. When it comes to theory of comparative cost, we are focusing on the difference in comparative cost of the countries. When it comes to modern theory, we are focusing on difference in resources. Okay, one country may be abundant in one type of factor and the country may be abundant in another type of factor. So based on labor theory of value, that is theory of comparative cost. When it comes to modern theory, it is based on money cost, which is more realistic. So automatically when there is difference in availability of resources, it will definitely have impact on factor of cost. When factor cost changes, automatically price also changes. It is more realistic. Foreign trade is distinct from domestic trade. Here also foreign trade is special case of inter-regional trade. It is normative. Okay, prove gains from international trade. It is positive based on facts. Modern theory is based on facts and concentrate on the basis of trade. Okay. Next, difference between internal trade and international trade. We all know what is the difference between the two. Risk level will be higher, currency difference involved countries, more number of countries are involved, more number of government restrictions, licenses, etc. And why internal trade is a special case of international trade? Why international trade is a special case of inter-regional trade? Okay. Basically, what does it mean? Each region is suitable for the production of those goods that are relatively abundant supply of inputs. So if India is labor abundant, it is favorable for one kind of product. It is favorable. It can produce. India can produce one particular type of product at a cheaper rates. Concept 9 cut chase. Concept 9. International trade is a special case of inter-regional trade. What does it mean? Okay. See, international trade is special case of inter-regional trade. Each region is suitable for the production of those goods that has relatively abundant supply of inputs. So if a capital is abundant in India, then India should produce capital intensive goods. And if labor is abundant in India, then India should produce on labor intensive goods. Okay. A region is not suitable for producing those goods that are relatively scarce. So India is not favorable producing capital intensive goods. Why? Because capital is very, very scarce. So if India starts producing capital intensive goods, then automatically cost of production will increase. Hence, different regions have different capacities to produce different commodities. We all know that each country specializes in one particular type of good based on the availability of resources. Difference in factor endowment is the main cause of international trade as well as inter-regional trade. Factor endowment means factor availability. So this is the main reason why different countries specialize in different kinds of goods. The immediate cause of inter-regional trade is that goods can be bought cheaper in terms of money. So India can produce laptops as well as US also can produce laptops. But rather than producing laptops on our own, we can buy these laptops from USA at a very lower rate. In this way, we can save money also. It means we instead of wasting the resources by producing laptop on our own, we can buy it at lower price and save the money. The cause of difference in relative price of good is a difference in the amount of factor endowment that we all know. Different countries have different availability of resources. Okay, so this is the chapter. This is about theories of international trade.